My name is Mike Frank, and I'm the director here in Hoover's Washington, D.C. office. So welcome to our office. And a side note, if you would like to be on our mailing list for all our various events, please leave your name and email address with one of our young interns outside, and we'll make sure that we don't spam you, but we will inform you of upcoming events. This is a great topic that we're doing jointly with Becker Friedman. And one quick note that why I'm interested in the topic, before coming here, I spent a couple years working on the House for the House Majority Leader and had a ringside seat to what happened in October of 2013 with the government shutdown. And I guarantee you that if people in the markets and who make real decisions with money had any inkling of how discombobulated that whole process was, I think there would have been much worse fallout than there actually was at the time. It was ugly, and it's recurring, and this is a very, very important topic to be addressing today, the consequences of some of the dysfunction you get in government and the uncertainty that it inspires. So, Lars, I'm going to turn it over to you and for our first panel, and welcome. This is a great collaboration. Come on. Oh.
So I guess I'm here in two capacities. I'm the director of the Becker Friedman Institute. We're very pleased to have this inaugural collaboration with the Hoover Institute. Of course, we find this to be a very, very exciting topic and one that's very important going forward. And, it's not always a great topic as far as the press is concerned. We find this as a really intriguing research challenge, something that we'll understand better in the course of the next 5 to 10 years. So we tend to be somewhat more patient than others. I just want to also indicate that the Becker Friedman Institute, we love to host academics. We host up to 40 visitors a year, and so any of you interested in short-term visits to our institute, we're glad to have you come to Chicago, and I hope you'll follow the wide variety of events which we do at Chicago and elsewhere like this one. So this event is, as I say, is a very exciting one. We're very pleased to have Steve Davis and John Taylor kind of really provide the intellectual leadership in creating this. And so I look forward to a very exciting day today. I guess we have some rules for these sessions, and it's my understanding that the rules are we're going to let the speakers talk for about 20 minutes. We'll have discussants talk for about another 12 or so minutes, and then at that point in time, we'll turn it over for the audience. We hope to have a lot of very interesting and stimulating informal conversations because, part of the rule of conferences like this is to nurture new discussions and collaborations and fruitful ways to think about problems going forward. So with that in mind, why don't we look to the first session. The first section is on economic policy uncertainty in the credit channel. The presenter is going to be Michael Bordeaux, and the discussant will be Charlie Calamares. So let me turn it over to Michael.
So it's great being here. And I think this topic of policy uncertainty and uncertainty in general is extremely important. And I got into this. I spent a sabbatical at the Hoover 5 years ago, and I met Nicholas Bloom, and I started, getting very interested in this, and it related to things I'd learned from Milton Friedman about the importance of uncertainty and policy uncertainty in coming out of the Great Depression. And so this is sort of where I came, the original light bulb, and then. The other thing I'd like to say is I'm a visitor to the Federal Reserve Bank of Dallas, and I've been going there for a few years. And 3 years ago I went and I met Christopher Koch, who's sitting over here, who's a young person who just joined the bank, a banking economist, just got his PhD from Oxford. And we started talking, and I got this brainwave. I said, I bet you that that policy uncertainty is really important in affecting the real economy, coming through the lending channel, coming through bank lending. So we went to his office, we just started looking at the data, and things just started popping up. Okay, now, the paper came out of that after 2 years of work, a ton of crunching by Chris and by John Duca at the Dallas Fed. So this is where this comes from. Other people have thought that uncertainty was important. There's a quote from Ben Bernanke. He's really focusing on fiscal policy uncertainty as being, he thinks, is a very significant problem for business firms forecasting. And there's another slide here from Dennis Lockhart. Okay, we don't have quotes on financial regulation uncertainty, which I think is also extremely important. Okay, so it's like, this is not a new idea. A lot of people have talked about it, but we tried to attach some empirics to it. So the questions that we ask are: does economic policy uncertainty affect aggregate lending? So that's the first question. And secondly, which was the question that I had originally posed to Chris. And then there's a question that comes from the cross-section, and how does it affect the credit growth of individual banks? And so does this hold up both over, across all banks, or does it hold up, what are the effects on different kinds of banks, different sizes of banks? And also, of course, banks which have different characteristics, big banks, banks with, they're heavily capitalized versus banks that aren't. And then the last question is, okay, if it has an effect on bank lending, what about the effect on the real economy? I thought it would be pretty significant, and we find that it is. And so what we find is the results of the paper are that economic policy uncertainty, as measured by various indexes done by Baker, Bloom, and Davis, okay, that using those indexes as well as other measures is negatively related and significantly related to total and C&I loans, okay? It's also related to total loans and all bank loans, looking at the individual level, okay? And then the last takeaway that we find is that it does have significant effects on the real economy, especially in the period since the crisis. And so we had two ways of getting at this. One was by looking at VARs, and the other was by using the methodology of a paper in the JME by John Bassett and others, which looked at bank credit standards, okay, sort of as a proxy of the effects. And by using this method and relating policy uncertainty to that, we find that it's pretty significant. It comes up to the total effect from the VARs is about 1% of GDP. If you do it through the bank lending channel coming through the Bassett paper and that approach, it's 0.5% of GDP. So this is a big number. This is for the period sort of since the crisis. Okay. So this is just some pictures to show you what we're talking about. So you can see that if you just normalize across business cycles, that bank lending in the recent recession since then has really dropped a lot. That's the red line. You can see it's below what you would expect. So you can see that it's you just see this in the data. This is a picture which again sort of is a picture that tells you everything. This is showing you the number of pages of bank regulations. Of regulations, and it's just been going up and up and up and up. Okay, but you can see how much it's gone up. Regulation of the financial has gone up in the recent period. Okay, this slide uses these Baker, Bloom, Davis indexes and shows you relates their index, which was based on newspaper on looking for keywords in newspapers as well as in other measures. It shows you just how this index spikes during important events. Okay. And then it shows you that policy uncertainty tends to be correlated with recessions. It tends to peak at recessions. So there's a huge literature There's a huge literature on the bank lending channel. There's a huge literature on there is a not such a huge literature, but a literature on measuring economic policy uncertainty. So these are the key papers, and the credit channel goes back into the 90s. It was, in fact, into the 80s, and Bernanke had a lot to do with it. And so we have some of these articles, the Baker and Bloom and Davis, and there's a recent paper by Sidney Ludvigsen and colleagues, which has a different measure, sort of macro uncertainty. And then there have been a number of papers done by Bloom and Baker, et cetera, that show that economic policy has significant effects on investment and on the real economy. So we just list these papers. So what do? We look at data. We look at time series data over the period from 1961. So it has an historic element to the present. And we look at the cross-section. We have quarterly, for the time series, we have quarterly aggregate credit growth, real GDP growth. We have the federal funds rate, the real federal funds rate, and we adjust it for the period since QE. And so there's a shadow federal funds rate that's been worked out by Zia and Wu, and so we account for that. And then we use the EPU measures of Baker, of Davis, Baker, and Bloom. And they have a number of measures, and we try all of them. But what we do, the measure that we use in most of our work is a measure that's focused on these news coming out of newspapers. Reason we do that is because they have an historic series that goes back to the early 60s. In fact, they have a series that goes back to the 1930s. So that's what our main results are based on. Okay. So this is just a picture again of this is a cross-section picture that sort of shows you the evolution of credit growth across the sample period from the 60s. The thing to notice is at the end here, it really drops. It drops below any other recession we've ever had. Okay, so the bank loans really dropped in the crisis and thereafter, and it's come back, but it hasn't come back the way it had come back before. That's the first picture from this. This is another way of cutting the data, looking at the median and interquartile range of the cross-sectional distribution. And again, I mean, you see that you get the same pattern, even though you cut the data slightly differently. Okay. So what we did with the cross-sections, we took the same time period from 1961 to 2014. We have balance sheet data from all commercial banks in the country. And then we have we do a regression, and the left-hand side, the dependent variable, is total loan growth at the bank level. So it's total loans minus allowances for loan losses. We do a dynamic panel, and then we have these controls. So we control for the total assets of banks. We control for their capitalization. We control for the amount of cash they have and how much securities they're holding on their balance sheets. It's fishy here. Okay, well, okay. Doesn't seem to want to stay there. Okay, so this is just showing you the data, the distribution of cross-section of commercial bank credit growth. Okay. All right. Okay. I think we're going back. Okay. And so we have these four bank level controls. As I mentioned, we demean them. We take the means out, so they're deviations from the mean, and we normalize them. Okay. And now I'm going to show you some of the results. Back one. Okay. So this is the time series approach, and so we use an an autoregressive distributive lag model. And what the model shows you is, oh, this is the problem. See, that's what happens when you're the first person. You find out that you find out the equipment isn't even right. Okay, so you've got bank level, you got bank change in bank loans, and then it's lagged, and then you've got these two other types of variables. M are the macroeconomic and regulatory controls. So in that M variable, we have measures of the real federal funds rate. We have controls for regulations. We have Reg Q. We have the Carter credit controls. We have Dodd-Frank. So we have dummies for that in there. And then we have the last variable is the index of EPU using the Baker, Bloom, and Davis work from the NBER from 2015. And basically what we expect to find is that the coefficient, this gamma coefficient, we expect to find that it's going to be negative, and we hope that it's going to be pretty significant. Okay. For the cross section, same story, but we organize the data differently. This is a cross section type of regression. And we've got the same variables. So in the brackets, the first bracket are the policy variables, and then the EPU, and then we have all these controls: assets, equity, cash, securities, and they have lags of these things. Okay, and again, what we expect is a negative correlation for the EPU term, and we're agnostic about some of the other results. Okay. So this is the first result that we get with respect to time series. This panel just shows you. This is just summarizing a lot of regression tables in the paper, but basically it shows you that the economic policy uncertainty variable comes in very strong. On the left-hand side, we have it with no controls. Okay, the coefficient's 32.68 minus, and then when you add in controls, it's pretty robust actually. It sort of holds up depending on the type of controls you add in. And the last column we throw in regulations, non-regulatory, and regulatory controls. We also have a measure of consumer expectation. It still comes in. In fact, it comes in stronger. Okay, so basically it holds up. It holds up when it's unconditional. It holds up when it's conditional on economic activity and policy. It holds up when you've added in all these controls and when you add in consumer sentiment. Okay, so the results are pretty stark. Okay, we do the same thing for the cross section. Okay, and the key thing to look at, and I'll amplify it in a second, is the top row. And again, we do all these different models. We account for it's unconditional, and then adding in all these controls. And again, we get a result that's pretty close to the coefficients are almost the same, and they're negative, and it holds up, you know, across specifications. Okay. So we find that the negative effects hold up for a representative bank, and this is the representative bank means it's the median of the size distribution. Its capitalization ratio is the average cash ratio and the average securities ratio. Okay. Then what we do is we use the cross section to look at different classes of banks, and here we get some interesting results. One thing we find is that it's worse. I mean, the effects are greater for bigger banks. And so we take out the 4 biggest banks. We find that the effect is quite a bit bigger. We find out that if you're well capitalized, the effects of policy uncertainty are less, and the more cash you've got. Again, 5 minutes, that's okay. Okay, maybe I'm moving too slow. Okay. Okay. What we also do is we look at a number of measures of a number of ways of checking for the robustness of our results. So we look at whether it matters whether you're looking at the data including the Dodd-Frank or before the Dodd-Frank period, the type of loans you're looking at, commercial and investment versus others. Okay, we use another type of policy uncertainty measure, okay, associated with Ludwigson and others. It's macro uncertainty. And basically we find, you know, we're going through this here, we find the results hold up, okay, no matter what you do. Okay. So I'm not going to dwell any more on that for purposes of time. And so the last thing we do is, what's the effect on the real economy? Okay. So we do two things. We first estimate a simple VAR, and then we use another paper that's been in the literature based on lending standards, and then we try to look at the effects on EPU, looking at the effects on lending standards, which in turn is picking up the effects on output through a credit channel. Okay, and so we find that it's quite significant. The results, as you can see, lead to their results show that you get a 0.8% decline in GDP, and we find that a lot of that has got to do with EPU. Okay, so again, this just shows you the effects from our VARs of an increase in EPU. It's a very simple VAR with output, with credit output prices and the Fed funds rate, and then the EPU. So you get the results that you get these effects as expected. This shows you what happens when you get the size of shock that occurred after 2007. Okay, and again, you get a very big effect. Okay. And then the last thing we do is we look at this model by Bassett. They have a diffusion index, which is based on a bank panel coming out of the senior loan officers survey, and that's sort of a measure of credit standards. So what we do is we take their measure, we run a regression which includes a bunch of controls, the federal funds rate, leading indicators, et cetera, and a bunch of aspects of bank instability, and we throw in the EPU index. Okay, and we find that it comes in very strong. We find that our expectations are that it's going to have that the EPU index is going to have a negative effect on the credit standards, and we get that result, and this is the regression at the bottom, which shows you how significant it is. It comes in quite large. The coefficient is 0.655. Translating that into simple English, the back of the envelope calculation shows that you get an 80-point rise in EPU after the crisis. Okay, that translates into a 0.05 increase in the credit standard. Okay, that then translates into a 0.5 percentage points of real GDP. And so you can see this is the picture of the size of the shock coming through credit standards. Okay, so and so the effect is, you know, if you just do the VAR, it comes out as like 1% of GDP. That's a big number. Okay, and half of that is due to policy uncertainty. That's the takeaway, empirical takeaway. So what are our conclusions? Well, okay. So the findings I've already gone through. The higher EPU is associated with lower bank lending, and it works for both cross-section and time series. If you're highly capitalized, the problems is less. Okay, and the big banks, it's a big problem. Okay, so what are the policy implications? So the policy implications that I take, which sort of cuts through, is not quite what is in the paper. Okay, but I think is very relevant to us in this conference and Hoover, is when you have these non-systematic policy changes. Okay, you've got the kinds of changes in regulations that occurred with Dodd-Frank, the kinds of policies that were followed by the Fed during the crisis. Okay. That creates a lot of uncertainty, okay? And some of it comes through the bank lending channel. Dodd-Frank, I think definitely had a big effect. It may be transitional, okay? And maybe that'll go away when the system adjusts. But I think the last sort of takeaway that I want to leave for you is that you need to make regulation, financial sector regulation, and monetary policy a lot more predictable than it is. I mean, and what we're really picking up is a huge increase in discretion. And so to put things in a way that John Taylor would his language, I would say that if we had more rules-based policy, we would have done a lot better. Okay, so thank you.
Let me begin by thanking the organizers for inviting me. This is a really great conference, and this is an exciting paper. If any of you are PhD students, or if you know any PhD students, you might have them read this paper as an exercise in showing that despite what you read in most journals, actually, not all economics articles written today are boring. But I don't mean that as a joking comment. I mean that as a very serious comment. This is a very big discovery in this paper. There's a lot of discoveries, Steve's work and other people's work in this area. There are lots of discoveries going on in the area of what you might call political economy, trying to quantify uncertainty, and thinking about how it matters for economic performance. And it's exciting to think that we, at this age of economics, we have such new and interesting things happening. My main focus in this paper, because I don't have any problem with any of the findings, they're very carefully reported, they make a lot of sense, and it's really ideal for a discussant if I can figure out how to use the clicker. That's the hard part. Oh, I did it. I'm not sure which button worked, though. That's the problem. So this is ideal for a discussant because the authors don't talk about the mechanism. They don't talk about what is the microeconomics that's actually creating this effect. And although in Mike's discussion he talked a little bit about regulatory uncertainty of banking, that's almost assuredly not the mechanism that's driving this effect, because this is a broad policy uncertainty measure, and it's applying, as he pointed out, early and late in the period, and there wasn't a lot of regulatory uncertainty about banks that's happening throughout this whole period. So this isn't about the simple story you might think, which is, oh, when you beat the bejesus out of banks and tell them that you're going to do a lot more and you haven't decided what yet. That sounds familiar to the current sort of episode. That of course they decide to stop doing a lot of stuff like lending. That's too simple an explanation for these findings. I'm sure that that's part of the contribution to these findings in the recent period, but that's a recent story. That's not a story about the last 50 years. So I think what's interesting is to ask, what are the micro foundations of this more broadly, using broad measures of policy uncertainty to understand loan supply. And I have good news for you. There's something called the banking literature. And the banking literature has been talking about models that make it very clear what the mechanism is here. And so I will not be embarrassed by the fact that a lot of my name is attached to some of these, but I will just tell you that yes, I've been working on papers that actually have this as an implication for the last 20 years. So let's go through what is the main point of departure that explains why policy uncertainty and lots of other things should matter for bank loan supply. And the key point of the modern banking literature, which I'm going to point to Gorton and Pinocchi's contribution, my own with Charlie Can in 1991, that what these authors are pointing to is a kind of credit rationing in financial intermediation, or a risk intolerance, by which I mean that banks, when they raise money, have to raise it mainly from debt and mainly from very low risk debt. The people who fund banks are very insistent, not just that they get paid a rate of interest that compensates them for bearing risk, but that the risk that they're taking is very, very low. That's been true of banks for about 2,500 years, since the first things we would recognize as banks were created in Athens. So banks fund themselves with low-risk debt. They have risk-intolerant claimants. And what that means is that when the asset risk of banks goes up or the leverage of banks goes up, banks have to shrink their lending supply because lending supply is the main way that banks take risk. So it's a risk management problem. Bank funding is a risk management problem of having to deal with risk intolerant suppliers of funds called depositors in today's world. It's really that simple. And so now what we're going to do is talk a little bit about, I'll talk very little about some of the evidence of this from the 1920s and 1930s in one of my papers. I have a bunch of papers from different periods that look at this. But I would just want to emphasize the theoretical grounding for this is very broad, and the empirical evidence for this mechanism is very clear. And let's just do a little bit of, oops, I'm hoping this is right. Okay. So the way that this works is banks target low default risk. What does uncertainty do? Well, one thing uncertainty does is it reduces the market value of banks' equity, because uncertainty tends to reduce the market value of all equity. And that means that the equity to asset ratio of banks goes down. That means leverage goes up. So the first thing to notice is if uncertainty affects the market value of leverage, then it makes loan supply fall because it makes banks' leverage go up. And then the other thing uncertainty does is it causes the standard deviation of returns of loans, the implied variation on the returns of the risky assets in the bank, it causes that variation to go up. So both, when you have greater uncertainty, both the leverage of banks goes up because their market value of equity falls, and their uncertainty goes up because the sigma of loans and therefore the sigma of assets goes up. And so it's obvious, it's immediate that if banks are targeting a certain level of default risk, when uncertainty rises, it works through both the leverage and the riskiness of assets to make loan supply have to fall. Why? Because that's the way that banks restore low default risk. So loan supply is the instrument banks use to react to changes in their leverage ratio, exogenous changes that produce rises in their leverage or increases in their riskiness of assets, and the way they respond to that is to reduce their loan to asset ratio. And that isn't the only thing they do, but it is the main thing they have done for certainly the last couple hundred years in all observed banking systems. So this is a very standard result that they're getting, although no one has ever talked about the uncertainty measure, and so it's a completely new result, but it fits the microeconomic literature perfectly. Now, what's even better is that they did what my referee report would tell them to do, that if this is the right mechanism, then it should be true that the interactions should show what they found, which is banks in the cross-section that have relatively high cash to assets ratio or a relatively high equity to assets ratio should have a mitigated response. So I'm going to show you that graphically, but it's kind of obvious, right? That if you are facing a shock that's affecting your default risk, forcing you to contract your loan supply because of an elevated default risk, if you happen to be a bank that in the cross-section had higher cash and lower leverage, and therefore lower default risk, you would be less subject to the effect of that shock. So let me just point out, this is the Black-Scholes model. The Black-Scholes model gives you a sort of topographical map of the default risk of debt. On the horizontal axis, we have the standard deviation of asset returns, which is basically, assuming banks on the asset side are holding cash plus loans, that's basically the loan to asset ratio multiplied by the standard deviation of loan returns. Okay? And then on the vertical axis, it's the equity to asset ratio, again, in market value terms. And this is a topographical map. As you climb here, you're climbing risk hill. The actuarially fair risk-neutral default premium on debt rises as you climb this hill from the 1 basis point ISO risk line to the 50 basis point, et cetera, et cetera. So banks basically, let's say they're targeting a 1 basis point risk of default. And let's say that large banks, to be consistent with your finding, are especially targeting low default rates. Then when they suffer a shock, they get pushed in this direction. And when they get pushed in this direction, if that's contrary to what the depositors want, the banks have to respond by restoring that low risk. And the way they do that is by cutting their loan supply. So if you are in the cross-section, you're over here, meaning you have higher cash or higher equity, then when the shock comes, it pushes you this far. It doesn't push you very far. Whereas if you start over here, so the point is, in the cross-section, we expect to find that banks that started off, luckily with higher cash ratios and higher capital ratios cross-sectionally, would be less subject to having to react to the shock. This is from my own paper on looking at this during the Great Depression from 2004. And you can see here's the implied risk-neutral probability default risk on the deposits. And this is 0.0 basis points. In December 1929, because of the first shocks of the Great Depression, 33 basis points, less than 1 percentage point. And this is on average for New York City banks. But you can see that New York City banks are responding to these shocks. And by the time they get to 1940, they're back to about 2 basis points, 1 basis point in 1936 default risk. But how are they responding to it? Look what's happening to the loan to assets ratio. During the boom period in the 1920s, loans to assets is growing from, loans to cash assets is growing from 2 times cash assets to 3 times cash assets. By the time you get to 1940, it's 0.3. In other words, loans went from 75% of assets to about 25% of assets. That's a real contraction of loan supply, because that was the control variable to target this. Very simple. The banks were also, of course, contracting their dividends hugely because they were trying to find ways to increase their net worth. None of these banks went to the stock market because it's much too costly to raise equity in this kind of environment where people don't know how bad off you might be. Okay, this is looking at the same model in Argentina, and the point here is that depositors discipline banks. I didn't show you that regression for the Great Depression paper, but let's just show it to you for the Argentine paper. So if your bank, these are the 3 key variables. This is a measure of your leverage. These are measures of your asset risk. One has to do with how risky your loans are. The other has to do with how high your ratio of loans are relative to assets. And basically, depositors punish you if your equity ratio falls, they withdraw from you, or if your loan risk on either of those 2 measures rises, depositors leave you. In other words, banks have to target low risk, and if they don't, they lose deposits. So I think I've convinced you, I have 2 minutes left, I've convinced you that there's a clear model out there. It starts with the simple fact that banks raise funds from risk-intolerant sources, and that can explain why banks respond to uncertainty. Now, you can test this to see whether this uncertainty measure is operating on bank lending through measures of the market value of equity ratio of banks or the sigma of assets of banks, and you can back those measures out for publicly traded banks. So that's something that might be interesting to do as a sort of test of what's the mechanism here. And I'd also want to emphasize that I've been telling a story that's somewhat similar to the authors about exactly what Mike started off with, which he referenced Milton Friedman's point. In 1939, if you look compared to 1933, the total amount of loans in the U.S. economy was about the same in 39 as it was in 33. But from 39 to 41, December 39 to December 41, loans grew by about 20 percentage points. And my own story about that has always been that once it became clear that World War II was going to happen and that the U.S. was going to be mobilized for supplying Europe, that downside uncertainties became much less important. And so that's exactly the motivation. What's funny is that's exactly the motivation that gave Mike the idea to get started on this. And I do think that episode is worth studying. I've been thinking about talking about it in more detail myself. Using precisely Steve's measure or some other measures. Now there's another, my final comment is there's another measure of uncertainty that I'm starting to work with that my 2 colleagues at Columbia, Paul Glasserman and Harry Mamaysky, invented, which is called unusualness, or statistically it's called entropy, which is a measure of the uncommonness of current word flow. It does a great job predicting the VIX. It predicts the VIX in, by the way, in the presence of lagged volatility and implied volatility. It still has content. It's a measure of how much the things that are flowing in the newspapers are strings of words that we don't tend to see much. So it's a measure not just of policy uncertainty, but of economic uncertainty very broadly. So on their menu of things to do, they might also look to see whether this measure lines up with some of the other ones. Those are all my comments, except to congratulate the authors on a really interesting paper. Thank you.
So let me just start by giving Michael a few minutes to respond, and then I'd like to open it up to a broader discussion.
Well, first of all, I'd like to thank Charlie. Is it on? Oh, anyway, I'd like to thank Charlie. These are great comments, and actually, just listening to him, I get ideas for maybe the next paper. So it's terrific. I'm not a banking economist. Okay, I'm not going to tell you what I am. I'm not a banking economist. So it was very helpful to me to get some more of this information. So my colleague Chris Koch here, maybe do you have any comments to make?
I don't know. I mean, I just like the one graph about regulatory uncertainty and how it changes immediately after recessions, which is like slide 4, which I think measures this latent state. I mean, it's not a direct measure of the bindingness, but it shows that there's something going on. And yeah, I love to try to get this.
Okay, so I'm going to open this up to questions. I'm going to use my prerogative to ask the first one, and then I'll turn over the audience. So when I see quantitative results like this, trying to measure quantitative impact, which I think is very interesting, I sometimes think I find the questions being addressed not as clear as it ought to be. So when I'm talking about the impact of regulatory uncertainty, it could be that, first of all, there's this endogenous component which people have talked about, and the question is how is that being accommodated for? If I'm looking at VAR evidence, if I look at VAR coefficients, is it just the level of the uncertainty that I care about, or is it the surprise movements in the uncertainty I care about? And when I'm quantifying impacts, I have to take that into account. So what's the endogeneity component and the kind of more, what's the nature of the experiment? Am I just changing things in some surprised way, or am I making permanent changes? And I guess the further question is, I'm a big fan of of these uncertainty measures, but I could imagine situations like regulatory uncertainty whereby it doesn't get resolved over a fairly long time period, and newspaper articles drop off the map because there's no new information about this its resolution, but it's still very much in the minds of the actors in the economy that things haven't been resolved. And how do I think about those problems?
Yeah. Let me turn to Chris on the first question, and I can answer the second.
No, I mean, I love this. I mean, it's very hard to resolve any endogeneity problem with that. It's, as you say, in a sense, this wording is a filter on a latent state. And you're arguing, yeah, it potentially is an A shock rather than a delta A. Like it's a permanent shock. And it's very hard. I mean, even the VAR ordering, it's very hard to have plausible cross-equation restrictions. So, well, I take it. I mean, yeah.
Because I thought the way I was also listening to your question, Lars, is it would be nice to have, let's say, a VAR model, just to start us in our thinking, that has exogenous economic uncertainty and policy uncertainty sorted out, orthogonalized somehow, and then looking at how they react to each other over time. And, for example, you mentioned that recessions tend to be times when policy uncertainty is high. That sounds like an endogenous response to policy uncertainty, right? And so it would be nice to take the fundamental economic uncertainty, disentangle it from the policy uncertainty, and look at the dynamics between the two. And I thought that's what you were getting at. Yet another thing.
The information problem, I think that is interesting, and I know I just, and I've always wondered about, how much real traction you get from newspapers. Okay? And you're right that you get these keywords and then they drop off, but it doesn't necessarily mean that the problem's gone away. So I think that's a problem.
Go ahead. Yes.
Warren Coates. Thank you both very much. Extremely interesting, both of you. But I want to follow on Charlie's comment about disentangling policy uncertainty from economic uncertainty. And most of what Charlie had to say, from your work, did not differentiate between the two. Mike, the indices that you use, could you tell us just a little bit more about what distinguishes them as policy uncertainty rather than general economic uncertainty? Yeah, I mean, because this separation is a really interesting, important element.
Yeah, I mean, I guess Steve is in a way better position to talk about that. One is based basically on like textual tuples in major newspapers, and the set of newspapers declines as you go further back in the past. That's what we use. And then there are other measures like the dispersion of forecasts regarding CPI, government purchases, or expiration of tax codes. We've used a couple. Then we only used the news one. I mean, a simple way would probably be to take like this measure of uncertainty and regress it on the Ludwigson one, and then take the residual to be the true economic policy uncertainty. But I don't think that's as simple. I mean, you really have to think very hard about last Peter's point.
It seems like in terms of the regulatory uncertainty, you should be able to use the regulatory rulemaking process much more directly. So looking at Dodd-Frank, you have a date of enactment, you have several deadlines put in the regulations, you have dates of draft regulations, notice and comment, and then final resolution, lots of variation across all of those things. And so it would seem like if you're really interested in the regulatory uncertainty, you would want to do that more directly.
Yeah, I accept that. That's a very good suggestion. Thank you.
So I think there's an even deeper sort of problem with endogeneity that goes beyond just disentangling economic uncertainty from policy uncertainty. So think of like a fire, right? So there's a fire in DC, and now there could be two worlds. One is like the president is coming to try and put the fire out, and it's not clear whether he's going to succeed. And the other world is like we have a rule that the president can't intervene. So then it's very clear that DC is going to burn down. So in some sense, so there's endogeneity in terms of like disentangling news about the mean and disentangling news about economic uncertainty versus policy uncertainty. And what I'm sort of a little less, so you guys seem in your language very clear that you about sort of assigning causality to one of these things, and I'm a little kind of so I'm a little wary of sort of like so people in this room sort of can probably figure that out, but I'm sort of a little bit worried about like sort of the how strongly you're coming down on these issues. So can you talk a little bit about, I mean, maybe there's some stuff you've done with the VER and so forth.
Chris, you want to get that?
So maybe I didn't quite get the point. So you say there's an explicit response function that responds to a recession?
Well, it's
and
very clear. So you have a financial crisis, and that activates regulators. Regulators, instead of regulating like toys, they're now going to regulate banks.
But that should be predictable, so you can make a forecast as a private agent or a firm on like in some way how it affects your future productivity or something like that. I guess that's what we're arguing, that you should have this state contingent plan exactly that you point out, that is more rule-like and gives you predictable future outcomes.
The point is that EPU is going to pick up all of these things.
Yeah, that is, I mean, that's what I mentioned. I mean, I see Lars Peter's points perfectly. It's very hard to disentangle. I mean, nobody throws a dice and says that's economic policy uncertainty. Let's just, that's really thinking about these cross-equation restrictions that we might need to impose to think about a truly exogenous measure.
Can I jump in here?
Okay. Three comments. Am I doing something here? I think. Let me try.
Can I turn this off?
They don't like your index.
Yeah, really.
This is the first session. These things happen.
One thing in just the causal interpretation of the VARs. I mean, the language I prefer, because the causal inferences are tricky, is to say something like, given the variables in my VAR, an innovation in EPU foreshadows something else. Okay, I think that's what that's basically what the VARs are telling you about, absent bringing a lot more structure to bear and some additional identifying assumptions. That's kind of point one. Point two, I think the endogenous response of these EPU indexes to recessions is not quite so straightforward as some of the previous discussions suggested. There's certainly a cyclical component to these, but the big run-up much of the big run-up in EPU in recent years came well after the financial crisis was resolved, well after the recession was over. Okay, the EPU was very high in 2010, 11, 12, early part of 13. Now you can still say that some consequence that was a response to the recession, but it's not the kind of response we saw in earlier recessions, and it suggests something else was going on. It was possibly the financial crisis had, because of its depth and severity, had different consequences than other recessions. The third point is, and maybe this is what Tarek was getting at with his fire example, I wasn't sure. The relationship between economic performance and policy uncertainty is not some fixed law of nature. It itself is a function of the institutions that are in place and the policy-making regime and so on. I mean, I think this is something John Taylor has emphasized in the monetary policy context. Another context in which it's clear that the institutional regime that was established prior to a shock like the Great Recession made a difference is you think about trading arrangements. The pre-existing, there was a set of bilateral, multilateral trade agreements that were in place prior to the global financial crisis that was much more developed and extensive than what was in place in the early 1930s. And I think to some extent that probably constrained the extent of trade-related policy uncertainty that arose in the wake of the financial crisis. So this whole nexus between bad shocks, overall uncertainty, and policy uncertainty is actually quite a subtle one that involves many elements and not just simple endogeneity versus exogeneity at a point in time.
One small technical comment, which is why do you not do bank fixed effects in the cross-section analysis?
We actually do, there's even quarterly dummies.
Okay, perfect. Okay, so and then the second one is actually following up on all this. I was wondering whether this, regulators are targeting certain banks, obviously, right? And especially with this result that large banks are affected more. I was wondering if regulators target large banks because they know, this whole too big to fail kind of argument, wouldn't you expect a larger impact on large banks?
If I can just, I didn't mention it, but I wasn't surprised from the standpoint of the theoretical models that the large banks would be particularly susceptible because they're the ones who make use, particularly in today's environment, of a lot of uninsured wholesale funding. So, for example, the large banks are the main players in the LIBOR market, most obviously, but also in repo. So there may be a story about why large banks, because of the markets they operate in the presence of deposit insurance, are the ones who are relatively susceptible to this market discipline effect. Sorry to jump in.
Somebody back there.
Maybe I can try without microphone.
Oh, sorry, there's that guy and there's a guy.
Thank you. Ramachandran. I have a question about the way you gather the data are from balance sheets, which are accounting data. And the concept of credit, I was wanting your clarification. Are you thinking of it as a flow or as a change in stock? And if it's a flow, there's a lot more that's taking place outside the banking system, which may be compensating but may not for shrinkages in the bank lending.
What do we do, Chris?
I mean, yeah, there's the whole issue about shadow banking, securitization, shifting stuff off the balance sheets. But this is really like a long view of it. Like you have a panel that spans almost half a century of bank level data, and in fact, the effects are even there in the 70s, even though the asset concentration was massively smaller. We have a paper on dynamic power laws in banking if you're interested. So we don't address that. it's very hard to gather systematic data on shadow banks and heterogeneity in shadow banks. So, valid point. At the top of my head, I wouldn't know how to address it given what I know about the data that's out there.
But we have some priors on the shrinkage in savings during a recession, don't we?
Yes.
That during a recession, savings as a flow reduces, and therefore credit as a flow should also be lower.
Yeah.
Okay. So in that sense, it's a little consistent, but it is not. But you're using entirely balance sheet data. That's the part that.
Yeah, but I mean, if any of the savings are channeled through the banking system, you could also look at the deposit side. I mean, obviously, people save in various different, and over this half the century, a lot of portfolio allocation at the household or firm level probably changed a lot. So I mean, that's another potential to look at the deposit side.
I was listening to the comment and thinking that's a real opportunity to do something, so let me just be very specific. Suppose that you use the EPU measure as an instrument for bank loan supply, which is the regulated sector, and then you have as the dependent variable shadow bank lending. So you would actually expect there to be a negative coefficient on the instrumented banking lending because the shadow banks aren't as subject to the policy uncertainty, right? So it may not be true because it may be broader uncertainty, but you could certainly do things that would see whether there's another endogenous response out there to this. That would also identify whether it's regulatory uncertainty or monetary policy or something else that would apply to both.
So this chart up here, as I look at it, there's this explosion at the first part. It's a 10 times increase from about 3 to 30. And then there's a fairly steady sort of 10% increase, and then there's this third explosion. So it's quite striking, it seems to me. So the question is, that seems like that major kind of shift from a large increase to stability to another large increase should show up somewhere in the bank loan data. And the question is, does it? Is there something, it's a different frequency than you're looking at, but it seems to me that's an important level, it's a level effect. It's not so much an uncertainty effect.
So it could be the uncertainty coming out of it, but also just the fact that you've increased regulations and that. We didn't sort that out, but I think it seems like it might be there, Chris.
Can I just ask a clarifying question? It's just the average length of call report filings? Is that what this is?
Yeah, I mean, look, this should be taken with a huge grain of salt. The idea is just to illustrate a point that people have rarely looked at. I had an RA look at like 50 years of regulatory reports. I even had them count items every 5 years. It's true for items even more than for pages. There's obviously technological trends driving this, computational power and so on and so forth. But what I think is key about this graph, and it's kind of a latent filter on a latent state, if you like, is these increases after recession. Whenever there's a recession, I mean, there's all these technological factors going on, we believe that. But I just found it as an interesting stylized fact. I wouldn't make more, wouldn't say anything about causality here. I just think it's an interesting fact about bank regulation that people.
Mechanically, it's just average.
That's just the number of reports, the number of pages in a call report. Obviously, it's easier to fill these today than in 1965, but I think it's just something interesting. It's a very interesting graph, but I wouldn't make anything more causal out of it.
Back there.
Thank you. Backing up for a minute to the conversation about policy uncertainty versus other types of uncertainty, one thing I think is often lacking in these uncertainty-related discussions is who exactly is uncertain. And I think it's completely plausible that you could tell a story here where policy uncertainty affects the banks, but the borrowers are responding to a different type of uncertainty. I'm doing some research now on textual uncertainty in the news, and I actually find when you're looking at newspapers that your average person is reading, there are much bigger uncertainty spikes in 2001 and 2003 with September 11th and with the Iraq invasion than there are the financial crisis. So the news that the borrower side of this are receiving is not necessarily the same thing. How many people do you think even know what Dodd-Frank is? So when we're talking about policy uncertainty, we're probably talking about a very specific group that's uncertain, and there may be another side to what we're seeing here that isn't related to that.
Right, but what we're trying to do is identify the loan supply channel, credit supply channel, and that's where, at the end, when we use that the credit standards proxy, is we're trying to get at the credit supply channel. So that's a supply side story. So it's not, the fact that people are nervous. It's the fact that banks are tightening up. Okay, so I think that may be important, but what we're trying to get at is what's going on in the banking system. Yeah.
And the cross-sectional variation
Yeah.
of the banking system is really convincing there. If it were a loan demand side effect, it wouldn't have differential cross-sectional implications for banks depending on their cash ratios and their capital.
Well, can I follow up on that point? One thing you don't do, and you could do, and would strengthen this inference, is you don't make an effort to condition on loan demand. And these banks differ in their geographic footprint a lot, the national ones, which means that you can think of constructing an empirical model of what drives bank loan demand, and using that model, you have the micro data, so you know where the banks are making their loans. You know the geographic distribution across states of their loans, and you can then condition for each national bank its bank-specific, time-specific loan demand shift based on where it's been operating in the 2 previous years in terms of its loan. Condition that out, and then isolate this effect. Which you've inferred these bank characteristics as, and Charlie I think has concurred that they're driving differential bank loan supply responses across banks, but you haven't really established that you've conditioned out the possibly differential bank loan demand shifts that might happen to be correlated with bank characteristics.
Right.
And you could do that.
Yeah.
First of all, we have bank-specific quarterly dummies, but that is a very low, high frequency. You might want to have a more low-frequency bank idiosyncratic business cycle, if you like, the beta vis-a-vis the credit demand that each one is facing. The only problem is, that you have is distributing the bank activity across spatial regions. Like you have a big break in '94, you have the interstate branching restrictions. I did that in a paper, and it's very hard to allocate spatial activity to banks throughout this long sample. You can do it at the very end of the sample for the last 10 years or so, but then you don't have too many business cycles for identification purposes. But yeah, I agree with you.
More questions? No? Okay, one more. To the left.
Yeah, I know.
Forgive me if I'm repeating something that came up before, but Charlie, in your comments, the contraction as a result of uncertainty in banks' lending quantity could come from the mechanism. It strikes me that there could be 2 possible mechanisms. The first is that the variance that it becomes more difficult to assess the risk of particular prospective borrowers. Just the range is larger and it becomes much more difficult, and they focus on those with this much larger boundary of uncertainty have higher expected returns, and that's just a smaller set. The second is that uncertainty about economic conditions affecting this bank in general just leads it to want to contract. It wants to change the ratio of loans to assets. So it simply cuts down on loans across the board. They seem to me to be different mechanisms. And do you have any sense of which would be dominant in the results of your research?
Well, I don't have a neat, clean way of doing that, but that's why I mentioned sort of thinking about the market value of equity channel versus the standard deviation of loans returns. So just from any kind of consumption-based asset pricing model, if we had, let's say, a shock that's producing a
a general, just call it, an equilibrium, the risk premium goes up that people require in the stock market, and that's causing the market value of bank equity to go down. And if the market value of bank equity matters, that will have an effect, irrespective of any concerns about the performance of the bank borrowers.
The assessment.
Right. So you could think about, and I wouldn't want to go too far with that, but you can think about whether it's happening through the actual decline in the equity value or the increase in the standard deviation of returns to the loans, which is also backed out of equity volatility. We don't want to go too far and take it seriously that I'm going to be able to distinguish these. But in principle, I think you could say maybe. This is more Lars's area than mine, maybe. What do you think? You ready to do it?
Yeah, no problem. One last question.
Yeah, this is a more general question about the EPU index. It goes up and down, and a lot of people say, oh, it's come down, and growth is still miserable, that kind of thing. So the question really is this a climate, I think Steve uses this term, is it sort of climate or weather? Are these long-term effects? And I know that what your regression coefficients say, but they don't tell me a lot about the frequency and that kind of thing. Can you get from working through the data, do you have a sense of what this is about in terms of it's going to be high for a while even though the EPU number comes down?
Christian? What you can do is you can do like a two-state Markov, and they don't perfectly align with NVR recessions. They're kind of after the recessions always. I don't know. Yeah. You probably know all.
I'll just say one brief thing. To make the separation John described is challenging because most of the EPU variation in the time series is pretty short-lived. Then there are some episodes where that's clearly not the case. So the run-up in EPU from basically the Great Moderation period to the period from 2008 to 2013 is quite persistent, and you see that kind of thing in some other countries too. Europe is happening in the Eurozone area. There's been an even more persistent run-up in the underlying level of EPU that is unlike what you would see in the previous 20 years or so. So I don't think we have very many episodes in the time series data that involve persistent shifts in the underlying level of EPU. Most of the identification power when you're running things like VARs is coming off of these short-term movements.
Okay, well, that we want to thank both the presenters and adjourn for coffee. So welcome to the second session. The second paper is going to be on going to extremes, politics after a financial crisis. And the presenter is going to be Moritz Schulerek, and the discussant will be Jesus Villaverde.
Perfect, great. So yes, thanks a lot for having me. It's a great pleasure and honor to be here. I'm going to present a joint paper, Going to Extremes, Politics After Financial Crisis, joined with Christoph, who's here on the podium, and Manuel, who is in Berlin right now. Congratulations also to the organizers, because I think this paper follows up really nicely on what we just discussed in the first session. So maybe we get some insights into, the drivers of EPU and what history and what the political economy, the political side has to add to that question. The motivation and where we started, it's pretty simple, is the observation that something has happened in recent years in politics across countries in Europe here. Long-standing two-party systems falling apart in some European countries, the rise of, let's call them new kids on the block in the political scene that make some impact. So the question we're asking is there something systematic about the link between financial instability, financial crises, and a rise in political, let's call it extremism or radicalization, fragmentation of the political landscape. We'll get to these terms and define them better in a second. So on like going to the economics of it, clearly there is a big debate about the role of uncertainty in driving, sort of slowing down the recovery from the financial crisis, being sort of a driver of aggregate fluctuations in the economy. And among all the conflicting explanations, uncertainty or shocks uncertainty have been discussed prominently. Our question here is if we sort of draw on the broad canvas of economic history, and we're going to talk about 140 years here, and we're going to talk about 15, probably 20 countries, is there something systematic that we can say about political extremism or rise in political uncertainty in the wake of financial crisis? What we're going to ask is, just wait a second, I was told, and it will work. Do I point this somewhere? Here we go, the questions. So 2 questions. First question, does the political landscape change systematically after financial crises? And the second question we're going to address in this paper is, does governing become more difficult? Is there evidence that crisis resolution is harder and policy uncertainty more pronounced in the wake of financial crises? What we're going to do is, as I mentioned, we turn to quantitative economic history, which is, what I've done in my previous research, and Christoph as well. And we coded a large new data set covering 800 general election results in 20 countries since 1870. And sort of the general sort of gist of the paper will be we sort of we merge these new coded data on election results with financial crises. I'm going to see how, in the wake of financial crises, political outcomes change and in a systematic way. That's what we merge them in 100 financial crises and see what comes out. What do we find? There's 3 core results, and we summarize them in the following way. The first one is what we call hard right turns. We find robust evidence that after financial crises, politics turn to the right. The far right, the extreme right, is by far the biggest sort of relative beneficiary of a financial crisis. The second result is we apply various measures of governance and fractionalization, is that governing becomes more difficult. That might be one of the other sources of why EPU is maybe heightened in these episodes, because crises are associated with things such as shrinking government majorities, greater fractionalization of parliaments, and also like increasing street protests and other forms of political voice. Third, these effects, and I guess that's one of the surprising results, these effects appear really specific to financial crises. So we test that against a normal recession, so i.e. recessions that are not associated with a financial crisis. And we test that against what we call, or what Barrow and others call, like severe macro disasters. These are recessions that are equally severe as the recessions that we typically see after financial crises, but don't have that financial component. Think about natural disasters, think about terms of trade shocks, etc. Yeah? And despite, in this last test, financial crisis is still different. The political aftermath of, there's something specific about financial crisis. Okay. Here we go. Data, I'm just going to go briefly so you know what I'm talking about. We have, the time period is going to be 1870 to 2014, so that's more than 140 years. You see the list of countries. We have a list of systemic financial crises, since both Mike and Charlie are in the room, and there's always some debate about when do you date a financial crisis. Let me just say, maybe some of these dates are debatable. Maybe we introduce some noise into our empirical analysis. It is this dating is an attempt to use an IMF definition of a systemic financial crisis, which also includes the need for government bailout. So this is not a list of banking panics. This is like, the idea is major financial institutions are in trouble. The government sees itself, sees the need to intervene, be it through insurance or through issuance of safe, or introducing capital into the banking system. So this is building on Mike's work, Reinhard Rogoff, Levin Valencia, and partly our own work. Then all the macroeconomic data come from the work that I've done with Alan Taylor and Oscar Jordan in recent years. Give you a sense of what are the variables. There's government vote shares, opposition vote share. We code far right and far left vote shares. So this has really been a big exercise of coding election results, the outcomes, going through individual parties, saying, okay, who's extreme right, who's extreme left. I'm going to tell you a little bit about the sources. You see them here. Barry, Eichengreen, Kevin O'Rourke have done similar work for the interwar period, so we use their work. Fractionalization is a measure of the probability that two representatives in a parliament picked at random will be of different parties, so it gives you an idea about how dispersed in a way the political body, the parliamentary body is. Number of parties, again, gives you an idea of like how dispersed the beliefs in the population are and how they vote. The next list of far-right parties, let's just go one back here. I'm still haven't answered. Where does it pick up? Over there? Or where do I point it to? Over there, okay. Anyways, okay, quoting far left parties. There is, there's an issue that political scientists debate about the new right extremists and the old right extremists. We go through, sort of various stages in making sure, going through various sources, double checking, consulting additional country-specific sources to make sure we sort of really pick up extremist far left and far right parties. Okay, there is a list here on the next slide. It always takes a while. Is the list of financial crises. Some of them are larger, some of them are smaller, maybe there's some noise. But let me come to our, my goodness, okay. What we're going to do is we start with some historical narrative evidence, and I'm going to present you some broad stylized facts. In the second step, we're going to run a very kind of standard event study, fixed effects panel regression on sort of post-crisis deviation from country-specific averages. And the third part is going to be a little bit more demanding on sort of on the empirical side and the technical side. We're going to run dynamic local projections. Think of those as like impulse responses. Think of the crisis as an impulse to the sort of political system, and what we're going to track is sort of the cumulative effect that a crisis has on various political measures, such as extreme votes for extreme parties or fractionalization of parliaments, a number of parliaments. So there's a little more texture here, there's more control, there's economic controls, and it gives you sort of the dynamics of what is going on as opposed to just sort of the simple averaging in the event study. Okay, this is, it's standard event study regressions, and these are the, oops, again, too fast. These are the local projections, so we're going to project some outcome variable, fractionalization, number of parties, or extreme votes on a set of economic control variables. We're going to have fixed effects for all the countries. And what we're interested in is like how the intervention, how the treatment of a financial crisis changes the future expected path of key political parameters. So we're interested in this conditional post-crisis path here over a 5 or later 10-year period. Okay, be careful just to press once. There we go. Let's start with electoral outcomes. If you look sort of broadly at the historical narrative, there is not only in the 1930s in Europe, which is obviously a country I come from, one of the famous or infamous examples for political radicalization, but even if you look, for example, across Scandinavia and the aftermath of the banking crisis or the real estate banking crisis many of these countries had in the late 80s and early 1990s, this is the birth hour, if you will, of some of these, right-wing parties, such as the Danish Progress Party or the Swiss People's Party, which is still, or the Lega Nord in Italy, which is still with us. So there's some narrative evidence that, electoral behavior swings after financial crisis. Obviously, 2007, 2008, the rise of UKIP. In Germany, in truth, the alternative for Germany, there is sort of prima facie evidence that politics changed. And the first, probably the way to see that stylized fact is the easiest way to see that stylized fact is the following. What we show here is we show the vote share of far left and far right parties. That's on the left-hand side. The pre-crisis vote share of far left and the white bar, and the far right, the black bar, and the total of the two. And you compare on the left-hand side the pre-crisis with the post-crisis outcomes on the right-hand side. What you see is, yes, there is, if you look at the gray bar, there's an increase in extreme vote shares in post-crisis periods, but it's almost exclusively coming from the black bar, namely from the increase in votes for extreme right parties. Yeah? And we call it in the paper, we talk about sort of as a tragedy of the left. So, financial system is sort of, capitalism is weak and the financial system is in the doldrums. Even then, people do not go for extreme left parties. A little bit more sort of nuanced way of showing the same result. No, just one is to run these event study regressions that I mentioned, and we do that for the full sample, for the pre-World War II sample, and for the post-World War II sample, and you get we highlighted in red. We give you some significant stars showing that essentially after financial crises, the vote share of the extreme right is elevated, but that of the vote share of the extreme left does not see any significant gains. You see here observations with roughly 1,500 1,600 in total, 400 elections, 400 observations pre-World War II, and about the bulk of it is post-World War II. Again, remember, this is a 20-country sample, so relatively broad. I promised you to look at the dynamics of these events, and that's what these local projections show you. So the way to read them is the year 0 is the year of the financial crisis, and then the red line with the confidence intervals in gray, if you can see them, tells you how the vote share of extreme right parties, in this case, sort of accumulates over time relative to the level it had at the beginning of at the outbreak of the financial crisis. Yeah, and you see both in the pre-World War II sample and the post-World War II sample, there's a significant increase of roughly 30% over time. Mind you, the vote shares are low to start with, but there's a significant 30 to 40% increase over roughly a 5-year period in the years following the financial crisis. What about fragmentation, fractionalization of parliaments, and sort of things that make it harder to legislate and maybe increase policy uncertainty because you don't get either things not done or there's just many more voices that take part in the process. Let's start again with the government vote share. So the idea being the vote share of all the parties that make up the government is reduced. You have larger opposition, and we see that panning out in the upper right table. Post-crisis, especially post-World War II, government vote shares fall quite strongly. Opposition vote shares rises. Fractionalization measures of parliament, which I mentioned, that's that measure that 2 representatives picked at random will not be of the same party. They rise as well. So there's more people, more diverse opinions in parliament, potentially making governance more difficult. And the number of parties in parliament rises as well. Does this, hold on, what's the time path? Similar picture, you've seen this. I'm going to speed up a little bit to give you, to come to the last part of the presentation. But government vote shares falling, opposition vote share rising, number of parliaments rising after a little bit, fractionalization going up almost immediately. How is this linked to, sort of maybe a true measure of political or policy uncertainty? How is this linked to major government crises, to increased executive turnovers? And we see, like going through this, higher government vote shares are indeed, or read it the other way around, lower government vote shares are associated with more frequent government crises, and fractionalization is also associated with more government crises, high executive turnover. So these effects that we see from these event studies translate into like really measurable outcomes in terms of political instability, such as government crises and high executive turnover. Street protests, be quick. Maybe the bar chart gives you the main story. Street protests, be it violent riots, with strikes increase as well, and that's maybe not too surprising. Next question is, how long do these effects last? Just going through here. And the answer we find in the paper is it takes roughly a decade to get back to normal. If you look at the upper panel, this is the far-right vote share. You see after 10 years that you have this initial spike, far-right vote shares increased by 30 to 40%. In this sort of in the local projection, after roughly 10 years, we're back to where we started. Similar-ish for the government vote share. There's some difference between pre- and post-World War II outcomes. Fractionalization measures, if you look post-World War II, again, after roughly a decade, they're back to where they started. So, if we date 2008, we are potentially, like in the last, if you take that as a forecast, we're potentially in the last stretch of that problem. So let me use my, maybe not, maybe use my last 5 minutes here to come talk to a point that will probably would have been one of the first comments. Don't we see that in a normal recession as well? Isn't it just the response of the electorate to hard economic times? How do you know this is specific to financial crises? And what we do, the sort of the general idea of this paper is very much to the general idea of this paper is very much to present stylized facts, give a first sort of cut of the data, introduce that data set, and tell people, well, in this, as Josef Schumpeter once said, we do not only need statistics to explain things, but also you need them to know what we need to explain. And so, I think the gist of that paper is very much in that presenting stylized fact, but maybe getting a little bit at what's going on and why financial crises are different. What we do is compare financial crises to normal financial recessions that are associated with a financial crisis, compare them to normal recessions, and to recessions that are very severe but are not sort of linked to a financial instability event. Yeah? So benchmark 1 here, all normal recession without a financial crisis. Benchmark 2, a subsample of particularly severe non-financial recessions, which we call, following Barrow, essentially call macro disasters. Yeah? The definition of our macro disaster is going to be, we want to see in the recession an annualized peak to trough percentage decrease of real GDP that's higher than that decrease in an average financial recession. Yeah, so it's a recession that's as severe or more severe actually on the real economy than your typical financial crisis is. Okay, here's an example of what we do. So we have these following financial crises. These are financial crisis years for the United States. Some of them are, we match them with business cycle peaks, and some of them are associated some of these crises are associated with a recession. These are the red lines. So this is what we call financial crisis recessions. Recessions associated with financial instability, systemic financial instability events. Then we have normal business cycle, just normal business cycles. We call them normal recessions. And then we have these blue ones, the macro disasters, which are very severe recessions, but not linked within a close window to a financial crisis. And we're going to do this for all the countries. So we have a Brie-Borchardt business cycle dating algorithm. We're going to date business cycles for all the countries, match them up with financial crises, and say, well, this is a financial crisis recession. This is not a financial crisis recession. This is a severe recession that's at least as strong or as bad as a financial crisis. Yeah? And we're going to check if the results we find in terms of polarization, extremist vote shares, hold up across, are specific to financial crisis, or whether we also find them in normal recessions. Okay, these are the dates. Let me fast forward 1 year. Okay. Far right votes. What we have now is 3 lines: financial recession, normal recession, and non-financial macro disasters. Again, highlighted in red are the effects in financial crisis recessions. And what you see here is interesting. I think the most interesting part, we see some of that in normal recessions. We look at the second or the third row, a normal recession. Also in normal recessions, far right votes increase a little bit, but the effects are far stronger in financial recessions. And then we run these tests whether the responses in financial recessions and in normal recessions are similar, and we in most cases can clearly reject that. You see the same for the post-World War II sample, much stronger effects in financial recessions, generally also more highly significant. And interestingly, in non-financial macro disasters, we find none of that. So and that brings me to the conclusion, if we think about the implications of that, very similar stories: government vote shares, fractionalization, and street protest. Also, different financial crisis recessions are different. If that brings me to the conclusion, so if we think about what makes financial crises different, there is the effects are not observable in either normal or financial recessions. We find these hard right turns. We find that government becomes more difficult. But what are the implications? Well, there is something that sets financial crises apart. Financial crisis slumps are different, and the politics associated with them pose particularly challenges and put a strain on governance when it's needed most. We also think that our results show that the danger that politics go off track is very real. The fragility of democracies that we potentially see right now is not only a 1930s story, it's more general. And that preventing financial crises also, or regulating the financial sector well also has sort of a broader political economy implication of, being safeguarding political stability. Well, thank you very much.
Thanks a lot. Thanks for the organizers to invite me to discuss this paper. And the motivation for the paper is relatively straightforward. We have accumulated over the last few years, starting with Reingard and Rogoff, evidence that the recovery from financial crisis can be slow. The empirical case is not so straightforward as sometimes is claimed, and Michael has written a very nice paper this year about it. But just for the sake of the argument today, let me assume it is in fact the case. There has been 3 mechanisms proposed in the literature of why this is the case. The first one is it comes with the territory. Financial crisis is associated with a big destruction of equity, of households and firms, and it just takes time to rebuild. The second argument relates with the zero lower bound of nominal interest rates. Financial crisis probably lower the real interest rate below zero. The zero lower bound on nominal interest rates prevents the real interest rate to be where it should be, and it takes a lot of time for the economy then to readjust to the new situation. The third channel, where I have done some research myself, emphasizes the effect of bad policies. In particular, the effect that associated with financial crisis, you can have a lot of fiscal uncertainty. And this year I had a paper in American Economic Review about fiscal volatility shocks that makes that point. The paper I have to discuss today goes a little bit beyond what we do and offers what I think is very nice evidence that in fact policies matter and bad policies matter. And the causal mechanism for those bad policies is the role of political fragmentation. Let me give you the punchline of the discussion since I don't have much time. I really like this paper. I'm from Penn, so we are not a department that tends to say positive things in general about anything. So the fact that I'm saying I like it really means I like it. This is not cheap talk. I really admire the ability of the authors of the paper to put together a quite impressive panel data set of elections, financial crisis, and other economic outcomes. And I went a little bit ahead of myself. And I think that I agree with them, and I'm convinced by their evidence that the empirical finding that financial crises are followed by political fragmentation. Nevertheless, I think there is a couple of things I would like to add to the paper, and all those comments are going to be in the spirit of making a paper which I think is very nice, even better. Those of you who know me a little bit know that if you start asking me about electoral politics, I can talk for 50 hours. If you ask me about electoral politics plus econometrics, then I can talk for 100 hours. But yeah, well, this will be like a filibuster. In some moment, I will need to go, to the gentle's room, and that will be the stop of it. But in the interest of time, I'm going to focus on 2 things. The first one is going to be the robustness of the finding that the main winners of electoral fragmentation and financial crisis are extreme right-wing parties. And the second one is talking a little bit about possible reverse causation. So if you go to Southern Europe and you look at countries that have really, really been affected by financial crisis. Here I'm thinking about the 4 major European economies that have entered into a memorandum of understanding with the European Union: Ireland, Portugal, Spain, and Greece, and Italy, which is kind of in the middle. And look at what has happened in these countries. There has been no movement towards the right at all. The convention I'm going to follow in my presentation today is, in the slide, I'm always going to use the name of the party in its own language, and then I'm going to try to say it in English. The reason for that will become a little bit clearer later, because otherwise sometimes in translations into English something is missed. So for instance, you look about Ireland. We ourselves has actually gained quite a bit. There is a new party called Anti-Austerity Alliance. Extreme right over there has gone from being around 6.9% in 2007 to nearly 20%. In Portugal, you have the left bloc from 6.4 to 10.2. The Unitarian Democratic Coalition from 7.6 to 8.3, which is quite remarkable. These guys are the communists. Since they don't want to call themselves communists, they come up with some, BS name. The fact that they have stopped their decline over time is actually quite remarkable. In Spain, it's probably the clearest of all. There used to be a left-wing bloc called United Left. Now there is something super complicated called Yes We Can Together plus confluences. I know, it's crazy. That has gone from 3.8 to 21% of the votes. In none of these countries there has been any win whatsoever by the extreme right. The only place where there has been a little bit of win is Greece, where Golden Dawn has gone from to 7.0. But who are the real winners? The real winners are Syriza, that went from 5.0, being a very, very small country, party to 35%. They are actually the party in government. Italy, you have Lega Nord, the Northern League, and you have the Brothers of Italy. Yes, they are in parliament. Actually, they haven't done so well during these years. And then you have the Five-Star Movement. I will say a little bit more about these chaps later on. You actually code them as extreme left. So if I just follow your coding, this is not a win for the extreme right. So, how does this reconcile with the main finding in the paper? Well, I think that a lot of what people have in mind is, first of all, the experience of the Weimar Republic in 1933, which I think really colors of understanding of many of these situations, and experiences like Alternative for Germany, the National Front, the UK Independence Party, the Party of Freedom in the Netherlands, the Swedish Democrats, or the True Finnish in Finland. But the interesting thing is, if you look at the experience of these countries, except perhaps in Finland, the crisis has been quite mild. Sweden has been in expansion. Germany hasn't been doing so bad. Even France or the UK haven't done that terribly bad during this financial crisis. Countries with big financial crisis, the left has gone up. Countries with mild financial crisis, the right has been going up. So how can this be? Well, maybe it's just that this is what econometrics is about. There is a lot of stuff going on in econometrics. Maybe there is something interesting going on. So let me talk a little bit about coding of parties, coding of elections, and the coding of financial crisis. With respect to the coding of parties, I could go country by country, and I could tell you electoral history about each of them. Forgive me if I focus in Spain, because it's something that I know quite well. In fact, some of my family has been running in this type of things, so, it kind of gets close to home. The authors, when they look at the Second Republic elections, 31, 33, and 36, they code Falange Española and the Basque Nationalists as the extreme left, extreme right, and Catalan Nationalists as extreme left. Yes, Falange Española was a extreme right party. It was a tiny party. It was quite irrelevant. The real hardcore extreme right in Spain at the time was Renovación Española, which was actually the party subsidized by Mussolini. And they were the party that organized the rebellion against the Republic in 1936. Since you are Germans, these guys are the Deutsche Nationale Volkspartei Spanish version. Even perhaps a little bit more to the right. Comunión Tradicionalista, are these guys extreme right? If I show you this is a meeting of the party. That looks quite extreme right to me. Okay? Then you classify the Basque Nationalists as extreme right. Again, this is one of the problems of translations. I guess that you are probably referring to EAG PMV, to this particular party. Calling them extreme right is a little bit extreme. These guys were actually later allied with the People's Front and the Republican side during the Civil War. Catalan nationalists were quite a mixed lot, and the main Catalan party at that moment was Lliga Catalana. Lliga Catalana actually allied itself with Franco, so I will not particularly call that extreme left. More examples of what I think are, for instance, these are parties that have obtained parliamentary representation in Spain in the elections since 1977. The most famous of all was Herri Batasuna, but some of them were on the extreme right, some of them were on the extreme left. None of these things are coded in the paper. But this is not only about Spain. Again, calling the Five-Star Movement extreme left wing, I don't know, we have some Italians over there, they may have their own opinions, but at least it's something that can be debatable. You code the People's Party in Portugal as extreme right wing. These guys are in the same European parliamentary group that the CDU, that the German Christian Democrats. They are just a plain vanilla Christian Democrat party, maybe a little bit more conservative because they are super Catholic, but nothing particularly extraordinary. The paper at the same time doesn't code as extreme right, for instance, the Union for the Defense of Traders and Artisans and all the other political movements created by Pierre Pugat, which was kind of the mentor of Jean-Marie Le Pen in the 1950s. These guys were actually quite important in the electoral politics of the Fourth Republic, the Party of National Solidarity in Portugal. Coding of elections. The last elections that the paper includes are the elections in Ireland in 2001, in Portugal in 2001, Spain in 2001, Greece in 2012. Most of the big increase in the extreme left parties has been in the next series of elections. Why? Remember, crisis starts in the US in 2007, but in Europe it takes around 1 year and a half to really start kicking. The first round of elections after 2011, the traditional party system still can't defend itself because it has only been for like 1 year and a half, and you can say like, oh, come on, give us a little bit more breathing time. The electorate really gets very pissed off a little bit later. In fact, that's exactly what happened in Germany. During the first election, right after the start of the 1929 crisis, the NSDAP starts going up, but the big breakthrough is a little bit later. And I think that if you coded more recent elections, it could change a little bit. Then there is also, of course, the issue of coding of recessions. For instance, I understand why you are coding it in the way you are trying to code them, and I understand you are trying to follow some type of algorithmic approach, but you call 2007 a financial crisis event in Spain, but you don't call 2012 a financial crisis event. First of all, I think it's the same event. It's just it lasted a very long time. But this is the New York Times. This is Hoover. I hope you will still give me coffee after that. But, this is June 9, 2012, Spain to accept rescue from Euro from its ailing banks. What happened in Spain in 2012 was a financial crisis. And something like that you could say about Portugal, Ireland, etc. Very minor points. You quote 1935 in Spain as a non-financial macroeconomic disaster. Certainly you mean 1936. You also quote 1894 and 1909 as recession years. They were not. They were actually expansion years. We can talk about. That's kind of a small detail. Anyway, so let me finish the discussion. How much time I have left? Okay, perfect. So there is perhaps an alternative to interpret the results. This is not as much about your empirical results, but about the interpretation that we give to your empirical findings. And it starts by the observation that perhaps is the case that financial crises are themselves the product of internal policy developments. And that's a point I have made with Tano Santos at Columbia University and Luis Garicano at London School of Economics in a paper in the Journal of Economic Perspectives in 2013. And we try to go over in detail about countries and try to argue that it was the political changes and the changes in the party system that led to the financial crisis. Okay? And in some sense, what happens when the financial crisis burst is that a lot of tensions that have been building in the system kind of come to the fore. And the way in which these particular tensions accumulated and how they open tends to forecast whether or not you are going to lean right or you are going to lean to the left. And you are going to have different situations where you can go in one direction or to the other. There is a beautiful classic study by Gregory Luebert called Liberalism, Fascism of Social Democracy, Social Classes and the Political Origins of Regimes in Interwar Europe, that makes a lot of these cases for interwar Europe, and in particular explains, for instance, how the reaction to the big financial crisis of 29 was turning to the right in Germany or in Austria, but turning to the left in Scandinavian countries. And in fact, Tano Santos and I are working now on a monograph that we are provisionally calling the Euro, an institution too far, that tries in some sense to bring to modern day a lot of these ideas of Luebert and other authors. And what we are trying to say over there is something slightly different. The new parties that have come to power in Europe that have gained a lot of electoral tractions are parties that build over historical cleavages of constitutional decisions in those countries that had not been taken. There were constitutional forks in all these countries, and the mainstream parties took one fork. There was always a little bit of a party on the other side, and now that you have a financial crisis, people are looking back at them. So take a case of we ourselves in Ireland. As all my English teachers taught me when I was a small kid, 22 plus 4 is equal to 1. Those are the guys who want an Ireland of 26 counties, not an Ireland of 22 countries. What is the Blocco d'Esquerda? Well, in Portugal, after the, how do you say in English, the Carmation Revolution or whatever, the Revolución dos Claveles. There is a second attempt of coup d'etat by the very left-wing army officers. That coup d'etat is defeated. The Blocco d'Esquerda are the heirs of that option. And in fact, even one of the founders was one of the main generals involved on this thing. In Spain, these guys were just the guys who were always against the constitutional consensus of 1978, and Syriza are the heirs of the provisional democratic government that had been defeated in 1949. So I think that I fully agree. This is a great paper. I want to emphasize it one more. It's really a truly fantastic paper. I think that with a little bit of work in thinking about the small details about coding and maybe being a little bit more nuanced in some of the interpretation of these results, this should find a very nice house in a top journal. Thank you.
So let's start by letting the authors respond to Jesus.
Well, first of all, thank you very, very much for this fantastic discussion. So on many points, I fully agree in the sense like with the detailed coding. So on the interwar, we were a little bit lazy. We took the existing study by Hoover and Brunhardt, and I very much look forward to integrating your comments there on the far right as well. The 5-star we had this discussion, of course, among authors, right? Long discussions, and we decided to not call it extreme, but far right, although the title in the end was extremes. But we take an agnostic approach, or we try to take and encode kind of the consensus approach. And I've just seen another new study that codes the 5-star movement as one of the most liberal of the far right, far left movement. So there's a debate, you can or cannot include it. What we took as a criterion, that's important, is whether the party is fundamentally anti-system, whether it wants fundamental changes to the political system and economic system and how things are organized, and that I think is to a large degree also true for the 5-star. So, I mean, those things at the end of the day are debatable. Importantly, the paper, all the results remain if we kick out the Eurozone crisis, 2008, or the Great Depression. And that's, I think, an important result. This is a systematic finding, not only related to the big known events, the Nazi rise and the recent populist uprise, but it's a general fact. And just some example, some of these parties that are now entrenched in the political system in Scandinavia, Switzerland, Italy, were in fact founded in the course or went into parliament for the first time after these regional financial crises of the early 90s, late 80s. So in that sense, and those were, all of them were these parties of the new right, so the Sweden Democrats, New Democracy, the Danish, Progress Party. In Germany, we have the famous example of the Alternative for Germany, where they were founded as a protest party against the Euro rescue mechanism. So there's a direct link between the two. And that also, to some degree, solves this reverse causality issue, because if the party didn't even exist, so there can be seen that political system get disrupted in the sense that new parties come up and they are successful. On the far right versus far left, it's true the examples you give, and to be sincere, we expected just a general far or radicalization. We didn't. And that was the result of this coding exercise. And I'm sure even if we recode some of these examples, we'd still get that result. In fact, last week I read an article in The Economist reporting the coding result from some Swedish political scientists, and they also show that the far right has been the big winner of the last 10 years, and the far left is now picking up. So there is an increase there too. So you're right. Mm-hmm. But still, we're talking about 2 or 3 times as much. So think of UKIP and all these. So and you don't even need econometrics. So in the paper, really try to be careful in the sense that we report the summary stats, then we do more or less, and then we do the more more rigorous regressions, and even just the descriptives show you that this far right is a bigger winner. So in that sense, that was a surprise to us as well. There are other examples. We were all like, well, what about Greece? But that seems to be more of an outlier. Or maybe you're right if we would include, the recent elections, which we didn't because we're really tired of coding. Maybe you would get a little more pronounced results for the recent post-war.
I agree with a lot of those things, but I think it makes sense. It's very difficult not to think about Syriza, an alternative for Germany, as not the two faces of the same coin.
Yeah.
So you have a big financial crisis in Greece. So there is people in Greece that say, "Hey, we don't want to pay," and there is people in Germany that say, "We don't want to pay that either." The theory is, since one are the debtors, one are the guys who have the money. Well, one of themselves position themselves on the left wing, another one on the left wing, and I think that's a very nice thing about Luebert. book that he says you should not expect going more to the left or to the right. It will be the objective condition of the distribution of cleavages within each country that would lean in one direction versus the other. And just because if your sample, you have more countries where the cleavages tend to the right, we should not take that as a general result. More than a statistical one, but that's I don't want to go.
So let me, go ahead.
Just maybe trying to offer a sort of consensual reading of the Euro crisis. I think if you look back at the global financial crisis and the political reaction in Europe, the instant reaction was a move to the right. Maybe not to the far right, but if you look at Cameron, you look at Merkel, you look at even what happened in Spain, like the big winner of the first round after 2007, 2008 was the right. And I think what you rightly point out, that in later stages of austerity politics that took place against the background of that, let me call it sort of more conservative, traditional,
mainstream
approach that the Eurozone took to resolving the crisis. I mean, they tried at least. That like the radical or the gains of the left wing make sense against that background. There was sort of a second round reaction to what was originally, I think, at least a move to a relatively conservative treatment of the crisis in terms of fiscal austerity, fiscal policy, and the institutional setup of the union.
Okay, so let me just start off with one question, then turn it over to the audience. You talk a lot about the kind of political outcomes following financial crisis. How about the policy outcomes? I mean, do we know whether kind of this change in the political composition is leading to good and bad? I mean, there's kind of a suggestion here it's leading to bad policies. Do we know? Do we have direct evidence on that? And we know why this is bad.
So that was another big point of discussion, of course, and we looked and looked and looked, and there is just no good, ready-to-use data set, and we're just at some point stopped in thinking about. We discussed for quite a long while whether we should code measures of legislative efficiency, right? So how many laws are passed, how many laws are blocked, whether there's fractionalization. So that
we care about what kind of laws, not just the total volume.
I know what you mean. But I'm just saying we try to get closer to actual policy outcome. We then decided that, we're going to show the government turnover and crisis dimension, but that is probably something to be done in future work. It's very hard, to actually code something as good or bad politics.
Look, let's open it up.
My first question is one that Moritz has heard before, but it's about the identification of financial recessions. So, I didn't read this paper carefully, so I didn't see the whole list. But I bet you there are a bunch of those events that aren't really financial recessions. Like U.S. 1984, what happened then? Is that your coding for the S&L crisis?
Yeah.
Or maybe like, is it that big bank in Chicago? I mean, it'd be interesting to see, because most Fed people or anybody would say maybe not. And then 1906, I think it should be 1907. And Canada, I'm going to have to say this. I always do.
No.
I don't think there were any financial crises or financial recessions, and you've got a whole bunch. So
1907, 1923.
they were no 1923. The home bank failed. One little bank
1907?
in 23. It failed in Winnipeg.
But the government implicitly assumed the.
No, the government had nothing to do with it. It was a takeover by the by the banking system. Anyway, so I bet you that's a very small issue. I want to get to this point about about the 1930s. And Chris said you take it out and you still get the same results. I'm suspicious of that. Okay, I bet you there's a way of coding for severity. I mean, I cannot believe that the kind of right-wing parties that we're talking about in post-World War II can be in any way comparable to the parties in Spain, Italy, Germany, Japan, blah, blah. Okay, I mean, there's something different about that period. So even if you statistically take it out, I'm still skeptical. I guess that's what I would want. I would really want some more work on that.
I want to raise two sort of methodological suggestions. putting aside the question, and I agree with Mike, I have a lot of problems with your coding of crises, but more constructively, the reason I have problems with your coding of crises is because there's no coherent meaning to what a crisis is in your data sample. Why? Because there are three different things that are crises, and they should have very different political outcomes. Okay, what are they? Number one, a panic where there's no government intervention and where there's no big depositor loss or bank failure of any significance. So, for example, even in 1893 in the U.S., the losses of depositors as a fraction of total deposits of failed banks was 0.1%, whereas in the Great Depression it was about 3%. In the 1918 episode, which you code as not a crisis, it was after 1918, after World War I, especially 1920, that's 1% loss of deposits. So actually, so what is a financial crisis? So it's three things. It's a time when banks are insolvent, but nobody suffers because the government bails them out. That's Spain. Or it's a panic in which not too many banks fail. 1907 in the U.S. Or it's when huge number of banks fail and there's huge losses to depositors. That's it. And now in your database, these three things are all the same. Do we think they're going to have similar political consequences? Of course not. So I think this is a really important thing to be able, and then we won't argue so much about whether this thing that's a nothing in Canada is equivalent to the Great Depression, right? Because we'll have three different kinds of episodes. The other comment I would make is I didn't understand the regression analysis because, in light of your discussants comment. So are you looking at difference or level effects in terms of party? I would expect you to say, did the financial crisis cause a change in political parties from the status quo? Not just, was there a movement right? Well, if this is a delegitimization, if the state is most importantly about creating these institutions, and financial institutions are a big part of the state. And so if there's a big financial crisis, it's delegitimizing the existing political equilibrium, which is what you are getting at. Mm-hmm. Well, so we don't want to think about this as a level effect, irrespective of who was in charge before. So I don't understand that. Am I right that your regression analysis is not looking at this in terms of a difference, but looking at it just in terms of level? Like, crisis means you move to the right, or shouldn't it be crisis means you change?
Okay, I get it. I have two questions. One is, what do the pre-trends look like, or the within crisis trends you always show after? Mm-hmm. And the second one is, and this will not help you in identification, but I think looking at the mechanism, I think it's very interesting that you have consistent data on riots and demonstrations, and it would be interesting to see whether those go up first before the election outcome reacts. But because you could imagine that right-wing votes are a reaction to a chaotic situation, right? Like people look for the strong man, and then this kind of thing happens.
Where does France fit in your exercise? As Jesus alluded to, Pierre Poujade is the first, if you will, initial function, or the first derivative of the Front National. If you look at the Front National, let's say 2002, when Jean-Marie Le Pen is on the second tour against President Chirac, it is at a time when France is actually doing well macroeconomically. And if you then look at 2000, in fact, if you even go back before, as Jean-Marie Le Pen starts to pick up in France, what you actually have is the Communist Party and the Parti Socialiste actually win a landslide majority, both in the Senate and l'Assemblée nationale, even though there is what could be defined as a financial crisis in France. Obviously, there's a question of severity. So I wonder whether France is an anomaly in your exercise, or there is something which made you not take into account the massive discrepancy between what takes place in France with the Front National, its rise, and the findings of your study.
So I guess a lot of these theories about sort of the rise of the right are about crisis of legitimacy. And I'm not sure if you've seen this, like in the trust literature, they've come up with ways of like backing out from the GSS trust in different countries going back to like 1920 or something like that. You could presumably do something, well, probably not in this paper, but you could presumably do something about like that for trust and elites, which might be the omitted variable that's really kind of driving this move to extremes.
I'm going to let you respond to at least the first set of questions here, so we can.
Maybe I'll go briefly. And I agree. We agree to disagree on some of these crisis definitions, and at some point we should just all sit down with Carmen and can come up with the list of financial crises. I mean, at the worst, we introduce some noise into our data. I agree that crises are very different, and they take a different. They come out with different. Political consequence. Although part of the reason, and this goes to Mike's second question, part of the reason we always do this full sample pre and post World War II split is because that helps us at least judging the robustness. Because most of these post World War II crises then take place in a regime of deposit insurance. They tend to be solvency crises, and we get relatively similar results as we do for the whole sample. And this is your point well taken. These 19th century crises are different animals to what we have now, and this also taking the 30s out and focusing again and again on the post World War II results. And they look very similar, and Christoph named a few of these examples: late 1980s banking crisis in Scandinavia, and other crises in the 80s that sort of seem to paint a relatively consistent picture. But the last point before I hand over to Christoph is, I think like the gains of this right versus left thing is maybe the most interesting, and most journalists have picked up on that because they thought this is great, we can predict the next election. But it's not the main. I mean, it's one part. It's not the main part. And I think these fractionalization measures, the shrinking government vote shares, and it goes a little bit to your question as well. I think there is some plausibility there that this actually makes the policy process more difficult and increases uncertainty.
Maybe to Mike's point. I mean, point well taken on the extremism and the severity of that. Of course, I mean, the Nazis are in no way comparable to these new right. I mean, they are comparable to some degree, but it's a very different level here. That doesn't mean that the result of dropping, however, the interwar post, like the 1930s, yields unreliable results. It's more like an interpretation of do you really want to put together these kind of extreme rights of the pre-World War II and the new right of today? You can debate that, right? Maybe we want to, in fact, code a populism data set, the populism variable, or something like that. But then, you already said that maybe the extreme right is not. I mean, that at least it's the one that most is most debatable in the paper. I mean, how does France fit in? Well, we have one graph in the paper showing that Front National in the European election of 2009 won 5%, and in the one in 2014 won 25%. Sure, that has to do with the new leadership, right? But we're talking about a 20 percentage point increase there. And there's quite some, our interpretation would be, sure, I mean, there's a lot of noise in this data, and there's a lot of rise of right-wing. This is not the ultimate explanation for explaining right-wing voting, right? This is not what the paper tries to do. We're just showing that beyond the well-known example of Nazi and, of the interwar and the populist rise in the recent years, there seems to be a systematic pattern that crises are related, are followed by these shifts to right-wing voting. That is, I think, the point, and France in that sense fits in. There is an increase, even in this recent crisis, but that doesn't mean that we can explain, why they entered in 2002, et cetera, right? So I think it's not a complete anomaly. Trust in elites, well taken. That's a very good suggestion. I think that, I think the next step will really be to understand what the channels are, right? What is driving this? This is to much degree, as you said, also documentation exercise. This is a new facts that we show, and then the question is, is it trust? I mean, that's one hypothesis. Another is that people react differently to financial crisis because they think financial crises are inexcusable events that are the result of policy failures, which could be a result of the elites, but it could be something that the political system at large is under, is under question because they didn't manage to prevent that crisis.
We also got redistribution. There are crises.
Yeah, there could be debtor-creditor conflicts as well. So it might not be trust, it might be debtor-creditor conflicts that are different after financial crisis than in non-financial crisis. It could be inequality effect. So there could be all sorts of channels. And I agree this would be a very interesting approach, but yeah, it's not so clear. That, I guess. And then pre-crisis trends, we for some of the variables, we use, in fact, as dependent variable, the deviation from trend. So riots, these street protests, they have strong trends in the data. To take those out, we use deviation from trend. That makes the results a little hard to interpret, but at least it eases some of the concerns that this is all just picking up trends. So we try to accommodate that. The suggestion on looking at what happens to riots just before election, that's very, very interesting. We haven't done it and could be done. Yeah.
So we have time for, let's say, 2 more questions.
Thank you. I noted that you said that you adjusted for suffrage in the paper, and certainly there were several countries where the number of voters doubled after suffrage was put in. So how did you actually go about making that adjustment?
And then one last question right here.
Yeah, so you talk a lot about votes shifting to or kind of shifting right to a large degree, but I mean I could also very much think of a model in which for some reason, either through the coding or because of something kind of systemic about more right-wing parties, that like their policy positions are somewhat more elastic than the left. If you think the left could be some more stable coalition or long-standing coalition of like communists and environmentalists, and pick your groups by country. I mean, if the right wing is kind of able to capture this new like single issue voters that are created after a big disaster or a financial crisis, they can easily, for whatever reason, shift to being anti-immigration or anti-banking or anti-trade or something like that. I mean, you could also think of just the platforms shifting a huge amount, and so I think that's I don't know if it's possible to capture some measure of that. Either the creation of new parties being somewhat different than a rise in share of a party that's been around for 50 years and has a lot of kind of constituents and interest groups already affiliated with it.
Take the last word.
Start with the
suffrage. So suffrage, very simple. We just take the share of voters in the total adult population between 18 and 90 or 100 something. So that's just a share, and we control for it, and it's not significant, doesn't change importantly. So that's our way to account for it. One might add dummies for structural breaks and something, but we didn't do that. We just took the share.
And in addition, if I may say something over there, actually you are doing the right thing, because the literature in political science documents that women, especially at the beginning, they tend to vote much more centrist. So by doing it in the way you are doing it, you are biasing a little bit against your theory. So I will argue that you are doing econometrically the right thing.
Yeah, I think the second question is the suggestion is well taken. We can look at that. I think, like generally from what also we take away, I guess, from this extended discussion and things again, everyone is to like the channels underlying that, be it the trust, be it like as Christoph suggested, like there is literature on how do people react to natural disasters. And the reaction seems to be more towards the community, more towards redistribution, because these disasters are not man-made. People seem to see financial crisis somewhat as man-made disasters as a result of policy failure, and the reaction seems to be very different. You want to blame someone. You want to. I mean, there's probably also there's a connection to anti-Semitism. Maybe there are many channels to explore for some of these strong results. I mean, there's definitely dissatisfaction with bailing out the bankers and rewarding the fat cats, if you will. There is there's a desire for a strong hand, however small that hand might be, but there's a lot to say, and we have to go further.
Okay, I'd like to thank all the speakers for the interesting session.
My name is Stephen Davis, and I'm going to chair the afternoon sessions, and I'm very happy to see you all and to continue this exciting conference. So Just in case you weren't here for the morning, the format is speaker gets about 20 minutes. The discussant gets about 12 minutes, and then we'll have an open discussion. First paper is by Hannes Mueller, Institutions, Volatility, and Growth. Go ahead, it's all yours. As soon as we get the slides up.
Yeah, thank you very much for inviting me. I'm very honored to be here. This is a paper with joint paper with Tim Besley at LSE. And I'm very grateful that we got invited because it's neither on elections nor uncertainty. But I think I'm kind of around this bunch of topics. So I think that's why I'm here. So democracy consists of at least two sets of institutions. One is selecting the executive, and this is, famously, and most research focuses on this, is elections. And the other set of institutions, which we call checks and balances, govern the extent of the power that the executive has. And these two things often are reformed at the same time, but they're not the same. And what we are interested here is the effect of executive constraints. So we are interested in the second part of democracy, right? So the checks and balances part. And what we say as it's a theoretical statement, I'm going to try to motivate it later empirically. What we say is that, this probably prevents policy activism. There's a lot of debate in the US about, Congress blocking initiatives by the executive. And so that's kind of the downside maybe, or the upside depending on which part of the political spectrum we live in. But it's definitely a general thing. And this can be good or bad for growth, but it certainly reduces political risk because nothing happens. Okay, so this is the kind of the standpoint that we take theoretically, and it's very annoying. It's very annoying, obviously, that you have these constraints if you're trying to push through policies, but we should all be aware that this is also a big safeguard against crazy action. Okay, so I think this is important in the context of the countries I'm going to talk about now. So if investors dislike political risk, so I'm not talking about uncertainty, but more risk, like where kind of you have a notion of what's going on, then executive constraints make countries more attractive for investors if this is true. Ceteris paribus, obviously. So I'm going to talk about related literature. I'm going to talk about executive constraints because I guess most of you have not delved deeply into this issue. And then I'm going to talk about investment flows and executive constraints, how they come together, and then I'm going to talk about the learning model. So the question here is basically, can we show that investment increases with executive constraints? And then, a bit more ambitiously, can we kind of trace it back to this channel? Okay. So there's a lot of literature. I'm going to be very, very superficial here. One thing that we took away from literature on trade is the estimation technique we're going to use, as pseudo-Poisson framework. And the reason we do this is that what investment flow, international investment flows kind of are very erratic. They have kind of huge inflows in 1 year in the sector and then zero for some time. And this is very similar to what the trade literature also faces. There's a big literature in macro that talks about, developing countries seem to have this pattern where they grow a lot for some years and then they completely collapse. And what we're going to offer is kind of an explanation on the political institutional side for this. There is a big literature on democracy and volatility. This is really a big literature. What we are trying to do is we try to say, look, let's try and look at particularly a part of democracy, of this package of institutions, and theorize about it, and then try to motivate an empirical exercise on the basis of this theory. And then, it's well understood that political risk leads to lower investment. So I'm probably in this audience, I don't have to talk a lot about that. And then it kind of is, in the very end, the last slide, I'm probably not going to get to this, but this is kind of the careful note at the end of the paper. It's probably true that one size does not fit all. So countries react very differently to the adoption of a certain institution, and our model will allow us to talk about that heterogeneity. It will give meaning to that heterogeneity. Okay, so the use of institutions as a constraint on power is a very old idea. We're definitely not the first ones to make that point. And being in the US, I was looking at this Frenchman who was kind of commenting on what he saw was the time of great endeavors, institutional changes in the US, and you see, some of you might think this is a very good idea in the current scenery. So, the jurist, so the judicative branch, keeps the executive from implementing erratically kind of, fashionable things. John Stuart Mill was describing very similar things in England at around the same time. So this is, at least that old. How are we going to implement this idea? We're going to measure executive constraints through the variable xconst in the Polity4. And Polity4 is a big industry, basically, of going to countries and coding all their institutions on 5-6 dimensions and giving them a score, which is, of course, a crazy exercise, but that's the best we have. We have to start somewhere, and I'm definitely going to defend all the codings of Polity4 here. So they coded from 1 to 7, and kind of what they try to capture is the extent of institutionalized constraints on the decision-making powers of the chief executive. What is this? In practice, what this usually is in Western democracies is a legislature or an independent judiciary. Okay, so that's a classic checks and balances view. There's other options, though. In China, for example, the ruling party in a one-party state has some power over what the executive can or cannot do. Council of nobles, or in military in the coup-prone polities. Okay, so you think of Turkey. The executive cannot do always what it wants because there's this counterbalance to that power. Okay, so the strong executive constraints, we need a dummy, and what we're going to do is we define it at this highest threshold. So this is obviously dubious. I'm going to try to defend it. It doesn't matter that much. It kind of depends a bit on exactly what cutoff you take, but we take the view that the strongest cutoff makes sense, and what we really say, what this says is that the parliament or the judiciary has, in its level of activities, has as much power as the executive in that area. So they can really do their own thing in these areas, right? So it cannot be coerced into doing what the executive wants. So I think that's a pretty good thing to look at. So just to give you an idea of what kind of countries we have that switch, because I'm going to identify everything of the switches from weak to strong executive constraints, and I'm going to say when you go from 6 or lower to 7, that's when you switch from weak to strong. So you see Thailand switches back and forth, and Turkey switches into this and stays until very recently. The coding stops here. It will be very interesting to see how Polity4 codes the recent changes in Turkey. So our data comes on the investment side now, and data comes from the Dutch Central Bank. And it is quarterly data from 1983 to 2012. I'm going to aggregate it to the sector and year level, mostly to avoid lots of zeros. And we focus on positive flows. We need to do this because we cannot deal with negative flows in the Pro framework. And so we do also robustness checks with the OECD and UNCTAD data. And you might ask, like, why do they even use the Netherlands debate data as a default? And the reason is that the coverage is actually quite amazing in this data. It covers a lot of countries and very far back. And right now we have 33 switches from weak to strong, and so it's very few switches, right? So we need that. We really need that coverage. We really need data that goes far to the past and across many countries. And then, of course, the big advantage is to have sector-level data, so you can actually control for sector country fixed effects, so you can really try to identify stuff without kind of being too concerned about compositional effects here. Okay, so this is a first look at this data. This is really crude. I've made two groups of countries. One is that has always been in strong executive constraints, and one that has always been in weak executive constraints. I'm not going to look at the switches here. I'm just going to look at those that have always, the US is going to be here, UK is going to be here, Germany is going to be here, and many countries are going to be here. And what is this showing on the y-axis? On the y-axis, showing the rate of inflows in all flows, in global flows, that goes on average to these countries. So I have normed this picture by the global flows. Okay, so that's important because you see this is very stable, and that's very good news, because it means that despite the fact that we had this massive globalization taking off here, where absolute flows are increasing dramatically, the relatively, like as a share of global flows, these things stayed very stable. Okay, and the empirical strategy is going to use that. It's going to look at the rate of inflows, and it's going to compare countries before and after. So 33 countries changed constraints in our sample, and we're going to use this pseudo-performance framework where I'm just going to do this very quickly. We do country sector level fixed effects. So these are 1,800 fixed effects where we control for things that stay fixed for every country sector. Okay? And then we're going to look at the time variation in this dummy for strong executive constraints. So we're going to wonder, controlling for the rate of inflows into your country, what happens as you adopt strong executive constraints. And what we also do is we control for an exposure variable. In this framework, this is kind of looking as if you look at the rate. This is kind of replacing for time fixed effects, okay, or sector time fixed effect. We could do time sector fixed effects. Actually, there's a lot of debate that this is not the right way to do it. So we focus on the exposure variable. Okay, so the question is, did adopters kind of join this club? Right? Can you join these guys here on top when you switch from the low yellow red thing to the blue? Okay, and what this reduced level table tells you, yes, you can. This says that the kick to inflows is about 80%. So it's quite a massive increase in foreign investment flows into countries when they adopt strong executive constraints. We do lots of robustness checks. I'm not going to get into everything. One thing that I would like to point out is that we also look at the number of industries with any inflow. So we look at the extensive margin, right? So this is the intensive margin. It's like, do you have more or less flows? And the extensive margin is how many sectors with any flows do you have? And what you see here is that this is 30%. So it's actually the base, the industrial base, so to speak, or the number of sectors with inflows increases. So countries that diversify also when they adopt strong executive constraints in terms of the inflows they get from investors. Okay, now, of course, identification is a big concern for this kind of exercise. So what I'm showing you here is a dynamic exercise where I use lags and forwards around the adoption date to show you that there's not it's not that there's a strong positive trend before the adoption, right? You were worried about that there's a pre-trend where investment increases first, then they adopt something, and then this increase just keeps on going, right? So you don't have that. It's pretty flat here. It jumps 1 year after the adoption, and then it stays flat again. Okay, so these are averages. We see a diversification effect. It's really robust. You can control for GDP per capita, you can control for growth, you can control for human capital, you can control for other institutions. And so this seems to at least be robust to all the controls we made. And then we look at the sector level and heterogeneity across sectors, and we show that this is really coming from the fact that some sectors were politically connected and others were not. And the inflows are really in politically connected sectors. Okay, so at a sudden, the mix of inflows changes, and it comes much more towards sectors that were politically connected, where a foreign investor might be exactly very worried about erratic behavior by the government. But, of course, the question is, can we link this to volatility? Okay, so that's because I told you now we have a reduced form relationship, and the question is, can we link it to volatility? And here I'm going to be, it's partly theoretical and partly empirical, my argument. So the empirical side to this argument is coming from an incredible regularity in the growth data. And this is actually how this project started, that Tim came to me with this image, and he said, what do you think about this? And so what we see is we see much lower growth volatility in countries with strong executive constraints. If you order country years into strong and weak, and you just calculate the volatility in these two regimes, you see that quite clearly. And it holds within countries. So as a country adopts strong executive constraints, volatility goes down. and it holds between countries. I'm not going to talk about between here, so I'm much more interested in this within change. It also holds control for GDP per capita and time fixed effects and whatnot, so it's quite robust. And the following graph shows you the distribution of growth in weak and strong regimes. Whoops. So it's basically a mean preserving spread. This is the raw data. It's growth rates in country years. And what you see is that strong executive constraints kind of are around 2%, but the variance is very small. And weak executive constraints have a much higher variance around this. So if you're on weak executive constraints, you're much more likely to draw a very low growth rate or a very high growth rate. That's basically the message that comes out of this graph. And as I said, this also holds for controlling for country fixed effects. Or just focusing on countries that switched actually. So how do we use it? We use it in a model. So there's a big modeling exercise that is in the depths of this paper, the main part of this paper. I'm going to be very superficial in explaining that. There's a model of investors, the economy, and politics in this paper. Okay. Institutions determine the constraints on the executive, so they're either weak or strong. And strong constraints imply that default policies are sometimes imposed. And this reduces aggregate volatility. I explained this, the idea behind this before. And firm profits depend on aggregate productivity growth, okay? And there's irreversible investments, and that makes investors careful, right? So they don't want to invest a lot if there's a high volatility in this productivity growth rate. Okay, so then we take that to a learning model. And this is kind of the thing that I would really like to talk about now. Namely, what we do is, we now use a learning model that is built with the regularities that we see in the data and the empirics of it, and tries to understand the investment data with this learning model. Okay, so what we assume is that investors observe the growth history of each country and build beliefs regarding both the mean productivity growth and the volatility. Think of this as the growth rate and the volatility of growth, and these assume to be different for every country and every regime. So China, for example, has a different mean and a different volatility being in strong and weak executive constraints, and the United States has as well. And so, of course, some countries never observe the counterfactual, but for some you do, right? So for some, they switch. So there's a Bayesian updating happening here, where you always update with the new growth data that comes in. And the big question is, what happens when a country switches, right? Because now you're in the unknown. You don't know what's going to be the mean and the volatility, because it's a new regime, and we assume that the growth rate is going to be different across regimes. So what we assume here, and that's important, that's absolutely crucial in the paper, is that you take your prior from what you observe in other countries. Okay, so you're going to take the prior of countries that have strong or weak executive constraints, or actually we can even modify this and say that have adopted strong executive constraints before, and you're going to take their mean and their variance, and then you're going to update from there. So it's like investors take the strong kind of mean and the strong volatility in the first year, right? And then in the second year, they're going to receive new data, and they're going to update on this with the new data that they receive. So updating obviously depends on the strength of the prior that you put to these observations from the other countries. So that's a crucial choice of parameter we have here. So very high D means that you treat the data that comes from the other countries as kind of the facts of life. So for example, if you believe that weak executive constrained countries don't grow very much, then you think China is an anomaly, and eventually China will revert to low growth. Okay, so that will be one way of viewing the world. Another view of the world is where you say, let's give a lot of weight to the country. Every country is its own animal, and we just take the prior, but then we quickly update and we just adjust to that. And so what we can do is actually, this kind of, the paper is under revision. Now we do a grid search, and then we actually look what data fits best to the investment behavior we see. Okay? So I'm going to show, so this is the formal representation of this. So we fit the same investment data with the same model. Now on the right-hand side, I'm going to use these beliefs in each country in each year on the right-hand side. Right? I'm going to use the volatility belief and the mean belief. And you see that both of them have the effect that we expect them to have, right? So the variance has a negative impact on investments, and the mean has a positive impact on investments. And as we vary D, these coefficients slightly change, and the maximum, kind of the best fit to the investment data we find is for D equal to 6. So that means after 6 years of observing the country in its new, I'm out of time, right? So I'm done here. So after 6 years of observing the country, you give equal weight to that country and to the prior. Okay, so very quickly, I'm just going to run through this very, very briefly. Why use a model? Well, if you have a model, you can construct counterfactuals. And this is kind of the important exercise we can do, right? Because so we can ask, what would have happened to Polish investments if investors had not updated their belief on the volatility, and they had just believed exactly the same volatility would persist, right? And we do this for all the countries, and what you see is interesting is that the average for the mean, so if the mean had not adjusted, is very small, but the reason is that there's some very positive and some very negative numbers. And for the variance, they are all kind of in the positive area, and that's why they kind of come up to this kind of 62%, which is by design similar to the level we find in the reduced form. Okay? Okay, thank you very much.
Okay, our discussant is Young-Suk Yuk.
Well, thank you very much for having me here today. It's a really great conference, a very timely topic, and I know that Hannes, right? Hannes mentioned that the paper is not about political policy uncertainty, and he's happy to be here. But political uncertainty is really close to my heart, so I'm actually going to make the paper policy uncertainty paper. Okay, the usual disclaimer applies here. I'm a government employee, so I have to put this all everywhere I go. Okay, so the paper is about executive constraint. In my mind, strong executive constraint means policy swings are less likely, meaning that political uncertainty is lower. So that's how I view your paper when I think about policy uncertainty and the link to your paper. So my partner Brandon and I, we have a couple of papers about it, and the way we did it was we looked at election timing as an exogenous variation in policy uncertainty. And Baker, Bloom, and Davis, they have a really nice, cool index of economic policy uncertainty, which is based on newspaper word articles, word counts. So the way I see it, that this paper takes sort of a different approach to this policy uncertainty issue and try to get at how this policy uncertainty affects economic outcome, in this case, foreign direct investment. So that's sort of my interpretation. And when I put it that way, it seems like it's very close to this theme of the conference. And so they have two parts. In the first part, they basically have this empirical exercise using FDI data, which motivate their second part, where they build a model and try to explore a mechanism. Okay, so I stumbled a little bit at first. I was wondering, like, if the paper was really more about international economics or macro growth type paper. So I saw some elements of international economics in the paper. They use FDI data, obviously, and they also mentioned Roderick 1991, which is my favorite paper when I try and motivate FDI and policy reversibility. But as I continue to read, I realized that, well, there are a lot of FDI elements that are missing. You know, when I think about foreign investment, there is this additional layers of rules and regulations, say exchange rates, differential tax policies, tax treatment, etc. And also, these foreign investment is more sensitive to political elements than domestic investment, which I don't see here. And in fact, the authors do say that, well, this model is not specific to FDI. So going back to the previous page, so I was struggling a little bit because this, in my mind, this first part is very important to transition to the second part, and this is all about FDI. And when I think about the contribution, I'm thinking two contributions potentially. So one is that this executive constraint measure that's being introduced here as a potential candidate of another policy uncertainty measure. And then the second contribution is having this very cool, nice, intuitive model of about the mechanism. So I'm going to be putting this constraint measure a little more under microscope and kind of try to push a little bit more so that we can kind of think it as a possible policy uncertainty measure. Okay, so about your assumption, so I'm kind of getting at a little bit this executive constraint measure. The paper mentions that they treat that the constraint measure as the core measure of political institutions, and they show executive constraints affect FDI flows more than other democracy components. They have a couple of other components of democracy, openness and competitiveness of executive recruitments. And then they went on and said the correlation between FDI investment and the executive constraint doesn't seem to come from the fact that executive constraints are proxy for other political institutions or economic factors. So they control for those couple of democracy measures and GDP, schooling, fixed effects, but I guess I was struggling a little bit here. Well, can we really make this a statement at this point that this is a core measure of political institutions, and then when you control for this the democracy measure and GDP, etc., can we really say that this doesn't proxy for other political institutions? So one way for me to think about it was to step back and maybe just peek at the components that were used in constructing ICRG political risk ratings. And so if you looked at the tables, so the usual suspects are all here, right? Government stability is here, corruption is here, investment profile is here, and of course here we also have a democratic accountability as well. So yeah, so I see it as one of the many components. So in my mind, it wasn't clear right away why it was the core measure that you felt that it wasn't, it wasn't necessary to provide the additional explanation about why. Then I thought, okay, maybe I should consult foreign investment literature and think about it more from that context. So I went to the foreign investment literature. Say, for example, Way 2000 talks about corruption. Dowden Frederick talks about expropriation risk, property rights, government transparency, regulatory quality, control of corruption, and then we use election timing as a political uncertainty measure. We have a government stability, checks and balances. So it kind of reads like a laundry list in a way. That there is a really long list, and the literature has looked at these components of political institutions really extensively, and of course they have looked at it, looked at the aggregate measure as well, but a lot of individual measures separately. So then I started looking at it from more of from a empirical perspective. So maybe this measure is better than other political institutions measure because. So one thing I thought about was maybe the adoption timing is sort of exogenous, maybe. So maybe it's independently determined somehow. Probably not. So if some economic or political factors influenced the timing of adoption of a strong executive constraint, and at the same time, those factors influenced FDI decision as well, then there could be some spurious correlation there as well. So it wasn't clear to me at this point. Then I was, I was thinking that, okay, so I know that a lot of political institutions measures are highly correlated with each other. So, at that point, it's not very clear to me why this measure might, work better than other measures. So I just, speaking of correlation, I just pulled some data that I happen to have because I used these measures in GIE paper. And then I just ran a quick correlation, and not so surprisingly, there is a pretty high correlations across all three here. I mean, the first one is sort of understandable because conceptually it's very similar to the measure the authors are using. So, but the other two are not quite as much, and yet I do see quite a lot of correlation here. So then I started thinking maybe there is some, advantage, maybe some kind of attractive features in terms of explaining the time series variation. So again, easily I pulled the data, publicly available data. It's called Financial Accounts of the United States, but it used to be called Flow of Funds Account. And so here we have this red line that's a flow, FDI flows to the United States, and the blue dotted line is flows from US to the rest of the world. So you see that there is really a high volatility here that you easily see. For example, here in 2014, it's about $100 billion. And then it shoots up in 15, and it's pretty close to $400 billion, for example. So with this volatile series, I'm trying to think about it and then trying to link how does executive constraint can explain FDI flows. I mean, that's the data the authors are using. So one thing I was thinking about, which I actually had a chance briefly to discuss with Hannes right before, is that so we have they have a sample of 150 countries, about, give or take, and then about 30 countries switch regime, either from strong to weak or weak to strong executive constraint. And this is 30 years of data. And not many countries switch constantly. It's usually one time, maybe twice, right? So if I were to just take the average, it's kind of like having maybe one country out of 150 switching camp each year, right? So I'm United States, I'm getting FDI flows each year, and I'm thinking that out of 150 countries out there, one country switch regime. How is that gonna really affect when I do the updating? I mean, GDP growth, we all know that it's very volatile, and it has a really significant loading in FDI regressions. So that alone can explain a lot of movement in FDI fluctuations, time series fluctuations. Now, when you add this executive constraint measure, how much does it make it better? How much can it explain better? How much can you explain the economic outcome? Explain economic outcome better. So it wasn't. At the end of the day, it wasn't very clear to me. So it's just something that maybe authors can explain better, and how this measure, out of all sorts of political institutions measure, can really tackle explaining the economic outcome. Okay, so just really briefly, a few minor empirical suggestions. I'm an empiricist, so okay. So they use pseudo-Poisson regression that they took from the trader literature, and because they're using Poisson regression, they have to have outcome variable to be non-negative. So what they do is to use a gross gross FDI flow data. So if you think about a simple example, so U.S. parent company send money to its subsidiary in Korea and then get some money back. So the net amount is really what you're sending. But when you're when they're looking at gross, they're only looking at this blue line, the money that's going to subsidiary, and then they're sort of ignoring the money that they're getting back, the red dotted line here. So of course they have done some robustness checks where they set negative values to 0 so that they can use net flows. I mean, sometimes the net flows have negative values. Sometimes you get more money than you send to a subsidiary. And so for them to stick to this regression setup, they had to set the negative values to 0. That, in my mind, could potentially introduce a truncation problem, data truncation problem. So there was some minor concern. And then, again, because of that setup, they are sort of sticking to this ratio of a flow to a country to flow to all countries. But more standard measures that are used in the literature would be the flows scaled by population or GDP, and also you could be using flows to the previous stock, which is kind of like a capital expenditure to capital stock concept. And then the really minor point, when you talk about economic factors, maybe you could add some more standard measures that are used in FDI control, in FDI literature as a control. So overall, I really enjoyed reading the paper, and I really liked the element that you brought out. So conceptually, I was totally convinced that this executive constraint can really explain economic outcome through through this channel. I was. And I do believe what you're showing, the mechanism. I totally believe it. Just that there are some gaps in the series that you could probably fill and make it better. So thank you very much.
Thank you. Hannes, would you like a couple minutes to respond?
Okay, so thank you very much. First of all, I mean, omitted variable bias. I think that's one of the main concerns we have. I mean, and I completely side with you. It is a concern, and we cannot. It's a cross-country regressions. We cannot take care of it completely. We try, but that's definitely a concern. Every referee and every person in this room will probably have their favorite control that we should control for. We try openness actually now, and it doesn't change anything. And one reason I think that many of these controls don't do the kind of job that they do in many of the literature is that this is already controlling for a lot of fixed effects. So many of the kind of GDP per capita growth and all this stuff doesn't have an impact. So this is kind of really coming from the timing. Identification here really comes from these kind of sudden increases and changes in flows. So that's kind of, you believe that or not, that of course something else can exactly coincide with the adoption of strong executive constraints. I mean, that's definitely possible. So volatility is the point, and we're not, and I think we had this discussion before, we're not trying to predict investment. We're just trying to make the point that, executive constraints could be important. So of course, we only have 33 changes, and so we needed to make that choice, where we cannot do both, right? Of course, the between variation is massive, and some of that is, strong executive constraints attract more FDI, as I showed you in the beginning. But what we really want to show is that kind of, can countries join that club? So we need to make that choice and focus on switches. And of course, then you lose a lot of power on the between side. But there's no way out. It's either identification, but we will try to kind of push on that on that front. And then actually, thank you very much for the checks and balances measure. Actually, somebody else mentioned this to me before, and I tried, and it actually also works. It's really just what checks and balances by the World Bank does. And it's very interesting because I compared the two measures really in detail. I went through the different countries. It focuses much more on parliaments. So it's much more focused on kind of what's the composition of the parliament, and would this lead to a good control on the government, right? And so it's not, they don't coincide completely. There's actually another data set on judicial independence, and what we see is a very strong correlation with whether the Constitutional Court has tenure. So, and that also leads to these big investment inflows. So it seems to be that this is the weird thing, that it's executive constraints is really in the sense of checks and balances, really as a concept, and this is why we use this measure, because we think it captures exactly what we want to capture on the theoretical basis. Okay, thank you very much.
Thanks. Let me start out with, I got one clarifying question and then one suggestion. The clarifying question, I want to make sure I understand the basic thrust of the results that you talked about at the end. And so correct me if I'm wrong. Transition to a regime with constraints on the executive increases mean FDI, mean gross FDI somewhat, and shrinks the volatility a lot. And then it didn't, even though you had this model where you allowed the learning speed to vary, it looked like those two quantitative effects were not very sensitive to the speed of learning. So that's the clarifying question. I want to make sure I got all that right. On the suggestion, you mentioned you have 33 of these transition events. The downside is there's not very many. The upside is you could actually go and look at each one and do what I envision is you talk about 2 or 3 in detail in the paper and make the exogeneity case, and then you've got an appendix in which you briefly talk about the others.
and make the case that these are actually exogenous with respect to FDI. Because there is a reverse causality story sitting out there, which is there's latent potential FDI that you could tap into now that you couldn't tap into the past if you would just impose sharper constraints on the executive. I think you need to rule out that story. So an example, I've discovered oil in my country. And so now I want to bring FDI, I want to bring foreign investors into the country to exploit the oil, but they won't come in unless I handcuff the executives in some way. That's the mechanism. That is the mechanism, but that's not what I understood. Then the timing's not endogenous, not exogenous. You want the timing to be exogenous, and I think there's a natural narrative approach to make that argument. That's what.
Okay, so just to add to your comments, I'm totally with you. So that you know, one of the main concerns in the literature, foreign investment literature, is that a lot of political institutions measures, they're very slow moving. So it's very hard to identify the causal relationship over time. And so my concern, like you pointed out very clearly, my concern was that your measure conceptually it's closer to what we envision when we think about political uncertainty, but in empirical setting, it doesn't seem to really resolve the problem of this identification. So that kind of, yeah.
So it definitely. So I see that definitely there could be pressures on the government to adopt it. So the oil, basically the oil fine, in your case, the oil fine determines the timing by which the mechanism is still there, but like the time, and then of course what we have there is that the oil itself is driving the big investment gain, right? So I completely, now as I said, I think omitted variable bias is, this is really well point. I'm trying, of course my role here is to defend, right? And of course I believe in the findings, so I'm not gonna go all the way on the other side, so let me try to defend it. What we do actually is, what we see is that a lot of the findings we have coming from Eastern Europe, and of course there's a very exogenous change. And we try to instrument for quick changes in Eastern Europe from democratic histories. And the results were sometimes amazing and sometimes not amazing, depending on where you put in the timing, like when do you allow basically countries to change. So it was very manipulatable, and this is why it didn't become main part of the paper. And the reason again is that a lot of the stuff that we find comes from the timing, right? So, and unless somebody can give me a great instrument for the timing of changes on the country level, not like a block of countries that change, we're not going to satisfy you basically, right? This is not. It's very difficult to find good instruments for the timing. The big. If you run it by continent, the drivers of our result are Eastern Europe, to some degree Africa. Latin America is already lower, and we find no effect in Asia. So if you think of recent Acemoglu paper, for example, on kind of these democratic waves and our results mostly coming from Africa and Eastern Europe, I think that's kind of going in our favor. But I think it's like, I don't know whether I can satisfy everyone in the room.
Okay. So if I understood correctly, you collapse this kind of 7-point scale down to just kind of a 0-1 indicator. And this is probably why there are only 33 transitions, I guess. But I think it seems to be kind of important that even if the biggest effect is going from 6 to 7, if you're talking about a lot of more volatility in growth rates or something, I mean, one of those measures is presumably, or kind of 1/2 or one subsample is presumably maybe much more politically volatile just by your measure. So if there's one country that's going from 1 to 6 every other year, you might expect that that's not really a consistently kind of low governed country, I guess. It's still having a lot of variation that might induce. So I was wondering why you could put this in non-parametrically, or allow, put in a few, some quadratics or something that would allow that 6 to 7 to still matter a lot, but include a lot more of the variation that I think would presumably, I mean, nothing about this mechanism really means that only going 6 to 7 is the thing that matters, but I would think going from 1 to 6 would potentially matter a lot as well.
Let me answer that right. I think this is a very good point, and So the confusing thing here is that it's not monotonic. So actually you do find some decreases if you from I think 2 to 3, you find a decrease, and then from then on it keeps increasing. So then, like, I'm in this position, like, what how do you deal with this, right? I think, like, conceptually, of course, there's absolutely no reason to treat the change from 2 to 3 exactly the same as from 6 to 7. I think there is reasons to say, look, we really think that's a totally different animal if you give that institution as much or greater power than the executive, right? So I think there is something that justifies what we do. But then, of course, you cannot use that fine division. So what we do now, like, we are actually revising the paper right now a lot, is actually we really try to understand how do they code, but we really try to understand the coding decision. That's where we need to go then, because we really want to understand the content of it. And this is what I alluded to before. We compared it to checks and balances. We compared it to judicial independence. But I think I'm totally on your side. I think this is, like, we would gain a lot if we could use more variation.
I guess part of the concern with endogeneity is anything else that might be happening at the time in the country that might increase foreign direct investment towards the country. One advantage of using the foreign direct investment is that you don't necessarily have to restrict yourself to just inflows of FDI. You have lots of bilateral variation, and you have natural reasons why there'll be particular kinds of countries, and or industries in which the effects will be different. So think about exploring that heterogeneity, and basically what that also gives you is then the ability to control for anything that happened in the country at that point in time, that's correlated with this. So then you still have to rely on the timing of the shock, but you can at the same time control for other things that happened in the country. And and in the context of Eastern Europe, obviously there's some obvious sort of candidates for heterogeneity. Some of them are integrating into the EU. There are trade linkages and so on. So you can try to think about and explore some of that variation to possibly get at some of these endogeneity issues.
So one thing, of course, is that we use Dutch data, right? So we don't have a dyadic. It's not dyadic, the data. But what we did, and we pushed ourselves. I completely I was on the sidelines here. What we can do, of course, is look at the sector heterogeneity and actually control for country year fixed effect, and then just see what is really the sector that reacts. And this is what I try to allude to. We just use the very detailed coding by Faccio, which sectors are politically connected in each country, and we show that it's exactly those sectors that are politically connected where you see the big switches when executive constraints are adopted. Of course, if you would use the UNCTAD or the OECD data, you're completely right. We could do a lot more, but I'm not really sure whether we could back out the mechanism in a much better way, because then you need a theory about why some countries are not afraid of political risk, why other countries are. I think that would be then the big challenge, right? To kind of have an idea and a theory about that heterogeneity, where that should come from.
So I wanted to ask a little about the normative aspects of the executive constraints. And by way of example, there's a institution in the U.S., this Millennium Challenge account, which was put together as a way to guide U.S. Foreign aid in directions which were more pro-growth. And so I was involved in this. There were 17 different indicators for each country which we used. Things like rule of law, World Bank Institute, Freedom House measures, a whole bunch of things. And to be sure, that was there to not just to allocate the aid in a presumably non-political way, but to induce the countries to follow these policies, whatever they happen to be, which were pro-growth or inducive to growth in some sense. So your measure, in some sense, would be an alternative. You mentioned independent judiciary, which is a rule of law measure. Yours could be added to this, but it would be on the basis it would be a wise way to allocate funds, whether it's from Europe or from the U.S. But it also would be something that you'd think would be a good idea. So executive constraints would be a good idea for the country to work for. So do you have any thoughts about the normative aspects of this?
I think one important thing, I actually do think that having checks and balances is a good idea on a normative basis. I mean, I think we see this right now in many countries, that this is challenged and the way it works. Actually, this is part of a broader research agenda with Tim, where we try to make the point that you get a lot of kind of what we call robustness out of strong executive constraints, where kind of disasters tend to happen less often. And I think a lot of these political disasters become economically disastrous. And I think if you care about kind of these downside risks, then it's a good idea. Of course, the kind of what is the utility function here? What's the welfare function you have when you think about these things? You saw that mean growth is exactly the same, right? This is not a statement about mean growth I'm making right now. My normative statement is kind of coming from somewhere where you're kind of more concerned. You're either risk averse, or you admit that you have no idea what really growth looks like, and it's really like uncertainty in the true sense. Then you would care about the worst case, right? So then that would be another way of looking at it. One more comment. I think that what we try to do, I think the part of the exercise is really motivated in trying to find a mechanism, one particular mechanism, in this big package of great things, right? So lower corruption, elections, and so on and so forth. Theorize it and try to find as much evidence for it or not as possible, right? This is not saying that I don't think any of these other things might be useful or not. It's much more saying that let's try to learn about the world from one exercise, right? From one mechanism.
So following up on that, the comments, so I was actually wondering, maybe this is just a rephrasing of my discussion earlier on, but knowing that there are a lot of correlations among those measures, and also that you don't necessarily provide a whole lot of explanation as to why this one has to be the one. So what if you just create a sort of a dummy variable based on other political institutions' measures and feed that instead of this one single measure? Would that still have the same amount of the power, for example, in explaining this FDI pattern? So that's kind of one question I have, that coming from this correlation. And also the other one is that so we had checks and balances measure as a sort of a control variables in our test. The reason we didn't push it too far was I wasn't sure if I could really argue that this is a very exogenous measure that would explain economic outcomes. So I don't know if how you feel about that. So okay.
No, I think again, the exercise here is not to say that a bunch of institutions together, because there's a lot of papers now that say democracy is good, and they use an aggregate. They use the aggregate measure. We know these correlations. This is now it's accepted truth, I would say. Right. But what, like, if you're a policymaker, and especially on the World Bank IMF side, you need to understand the channels, because very often we have focused on elections, and it has led to sometimes fantastic outcomes, sometimes not so fantastic. So, we need to drill down to the channels. And of course, the moment you do that, you're in the mess, right? Because then, there's omitted variable bias everywhere. But I think, nonetheless, even though I'm kind of play the devil's advocate now, that I say, like, look, this is the channel, I think I do that because I think that's the way forward. I think that's the way we learn, by saying, look, let me try to defend this channel in front of a crowd and see whether I can convince you or not, and whether I can convince myself, right? And I think that's the way we need to learn, because if we just use always these kind of, whatever, like 20 indicators aggregated in a non-transparent way, I don't know what we can learn really about the channels.
There's a good deal of casual evidence that in the advanced democracies, especially the United States and Europe, checks and balances have become markedly less effective in recent years and decades, and that policymaking is far more executive centered. Part of this is delegation, the growth of regulations, which is lawmaking by executive agencies, which is not exact. You're looking at the chief executive, but I think that the two are related, and especially in recent years in the United States, we have a long succession of political controversies over the president taking actions that don't have a statutory base, conflict, and then Congress rises up but is completely ineffectual, and it doesn't use budget and appropriations. It does not moderate the executive as it did in the past. In Europe, the story is a little different, but I mean, we see a lot of delegation of what had previously been legislative decision-making to Brussels and other EU institutions. But we also see a lot of migration, I believe, to heads of government. In the several years of response to the Greek crisis, the coordinated national responses were heads of state getting together every month or two over the weekend and making these enormously important decisions, and then going back home and their legislatures dragged kicking and screaming into ratifying what the chief executive did. So this is casual, but there's a lot of it, and I've been looking for it in your data. I can't really find it on your chart 2 after 2007. The top line of the developed, it kind of goes down a little bit. I'm not sure how to interpret that. What I've been thinking is in the Polity 4 measures, it somehow doesn't pick these things up. You get to 7, and we're talking about some important changes that just aren't being measured in your data. Does that sound right? Does what I just said, I'm trying to turn this into a question. Does that sound right to you?
Thank you very much. In Germany I have the opposite. It's again very casual, but I have the opposite feeling that a lot of decisions are pushed to the Constitutional Court. The Constitutional Court had heavily intervened in policy making.
But it always says yes.
No. It doesn't always say yes. Well, I don't think it always says yes. But anyway, so anything I think in any case it's dangerous. I think it's dangerous. Both the idea that we need a kind of a free executive that can do whatever it wants, and the fact that institutional changes slowly happen in that direction. And the reason is I do believe in checks and balances as an important safeguard. So, but on the measurement side, France is actually not at 7, but so UK, Germany, they all go to 7 and they stay at 7, and that's it. And of course, kind of the question would be, could you get to much more finer coding, right, for these countries, and would that do something?
If you did it, would it pick something up?
Yeah, exactly, right? That would be very interesting. And I think also like just the intention to change things. I think what we have with Erdogan in Turkey is incredibly interesting in that regard. Like, what do investors think about this situation right now? Apart from like the violence and all that, what do they think about the institutional things that are happening, right? I think South Africa is an incredibly interesting case of exactly the same kind of honing away of the powers of the Constitutional Court. And I think if we want to have a great, quote unquote, country of warning, Zimbabwe is a very, very, very brutal case of economic decline that came after a strong man having free hands. And I think that's the warning sign. These cases are the warning sign for weak executive constraint.
Okay, we got time for one last question, a brief question and brief response.
Okay, you said at the beginning that when you were defining that, it may not just be. Oh, thank you. It may not just be the legislature or the courts that are the checks and balances, but also the military. So, do you see differences in where the military has equal or more power than the executive versus the ones where the courts or the legislatures have equal power?
I love this question, and it actually goes back to kind of what you said also. I would love to be, these 3 questions, they're very much in line. I would love to be able to know how they coded things so I could kind of unpack it again and then answer that question. I can't. Like, there is some justification given for why 6 or 5 or 7 is given to a country, but it doesn't say, then we notched it up for 1 point because this. Then there's one really interesting thing. I have a paper on textual analysis, and I use that data to look at what happens when you adopt executive constraints. What you see is that news on the parliament increased by a lot when you adopt executive constraints. So there really seems to be something happening. I don't know whether this is a temporary thing or whether it's a constant thing, right? And with the court, it was very complicated. Like, it was not non-monetary, non-monotonous. So I think it could be that, there's a phase in kind of institutional development where you start to challenge the constitutional court. And then when the constitutional court survives this, you get a score of 7. But then you don't see anything, right? It's also like, how do they code it? Do they code a non-challenged constitutional court as 7? Or do they only code one that has been challenged and has defended itself as 7? Right? And what does that mean? I think there's a lot of coding issues around this, which are really interesting, but I cannot answer that question, basically, is the short answer.
Great. Thanks, Hannes and Youngsuk, for a very interesting presentation and discussion. We've got a short break now, and we will resume at 2:45. Okay, let's pick up again. I feel like especially blessed for this next session because we've got one of my co-authors and one of my colleagues speaking. So kicking it off will be Tarek Hassan, and Scott Baker will be the discussant. Go ahead.
Okay, well, thanks very much. I'd like to thank the organizers for putting this together and for giving us the opportunity to present here. This is about aggregate and idiosyncratic political risk, joint work with Stefan, who's sitting here. He's responsible for all difficult questions. That's our internal system. Lawrence from Lent, who's not here, and Ahmed Tahoun at London Business School. So political decisions on regulation, taxation, government expenditure, as we've heard today, have a major impact on the business environment. And outcomes of these decisions are often hard to predict. Yeah, just thinking about Brexit, US government shutdown, healthcare reform, all this kind of stuff. Lots of uncertainty associated with these political decisions. Now, I think one of the reasons why we care about political uncertainty is because it might be that the effects of the risk associated with the political decisions on the behavior of households and firms is so large that it sort of undoes any kind of positive or that it might undo even positive upsides of well-meaning reforms. Yeah, so how important is this effect? And one kind of small question on the way to try and answer that bigger question is, how do firms react to political risk? Now, that question is somewhat hard to answer, mainly because we don't have good measures of firm-level political risk. Yeah, so how much is a given firm exposed to political risk at a given point in time? Now, what we try to do in this paper is to develop a novel firm-level measure of political risk that's based on textual analysis of conference call transcripts. So we're going to look at these transcripts, and they're going to tell us something about how much are managers and analysts concerned about risks associated with political topics. We're then also going to be able to decompose the political risk by what is it about? Is it about healthcare? Is it about immigration? What topic is it about? And then we're going to try and study reactions or statistical associations with both aggregate and idiosyncratic political risk. Here are the main findings of the paper. The first main finding is that idiosyncratic political risk is associated with retrenching of hiring and investment. So firms that are more affected by political risk hire less and invest less. And we find the largest effects of risk associated with corporate regulation, healthcare, and government reform. So these, during our sample periods, appear to be the main sources of political risk that also affect behavior. The second main finding is that firms that devote more time to discussing risks associated with a particular political topic, such as healthcare, for example, then go on to lobby on that topic. So we find an association within topic between lobbying expenditure and how much people are worried about risks associated with that topic. So we call that active management of political risk, as opposed to sort of more passive management of political risk where you just retrench.
The third main finding, and this kind of speaks somewhat to the causality debates that we've had today, is that we generally find smaller associations of stock return volatility and investment, but not hiring, with idiosyncratic than aggregate political risk. So once you have sort of a cross-sectional measure that varies over time, you can try and start kind of disentangling some of these causation issues. Although we find smaller effects of idiosyncratic political risk, 2/3 of the variation in our data is idiosyncratic. Yeah, so the time series variation that we've been talking a lot about today actually only accounts for something like 0.7% of the variation. I'm going to call that aggregate political risk. Most of the rest of the variation is sort of in the between time and firm dimension. Further to this, the dispersion of idiosyncratic political risk. So think of like the cross-sectional variation in how much firms are affected by idiosyncratic political risk varies significantly over time. And what's more, it appears to be largest whenever aggregate political risk is high. Yeah, so that kind of speaks to an additional potential transmission mechanism of how aggregate political risk matters. It might matter by pulling apart the cross-section. You guys know all this. So here's what I'm going to do. I'm first going to carefully introduce our measure of political risk at the firm level. Then we're going to talk about validation, about idiosyncratic political risk, and then about some of the effects it might have. So here's our main source of data. These are complete transcripts of conference calls that firms or the firm management has with analysts and other interested parties of the public. These are 90,000 transcripts, or just written down what people said on the conference call, and typically they are after earnings announcements. So the firm announces its earnings, and then in the following week you can call in and have them explain it to you. This is 2002 to 2010. And it's typically a management presentation where the management kind of like says what they think happened, and then people ask questions about it. Yeah? And this questions part is kind of neat because it's not something that's completely scripted by the management, yeah? So people can intervene. Now I want to be very clear about what we are trying to measure, and then later we can talk about what it means. So what we're trying to measure is the share of the conversation between management and participants that centers on risks associated with political topics. Yeah, so that, in my ideal data set, that's what we want to figure out. So here's the measure. So we're going to start with two what we call training libraries. So these training libraries contain all two-word combinations of two archetypical texts. One that's typical of a political text, and one that's typical of a non-political text. So think, for example, an undergraduate American politics textbook. That's going to be my political text. Now let me extract all two-word combinations, those are called bigrams, from that political text and put them into a set P. This is the set of political words, basically. And we're going to have a non-political library, that's a financial accounting textbook, for example, where you take all two-word combinations and put them into the set N. Now the word combinations that we're interested in are those that are in P but not N. So what are we going to do? We're going to count the number of occurrences of exclusively political bigrams, so elements of P, not N, in conjunction with a synonym for risk or uncertainty, and then divide by the total number of bigrams in the transcript. That's the idea. So here's the formula. So the thing that we're constructing is political risk of firm I at time t. And that's going to be the sum of all the two-word combinations that appear in a given transcript, where I have an indicator variable here for a word that is political but not non-political, an indicator variable for this word is used close to a synonym for risk or uncertainty, and I'm dividing by the length of the transcript. Now, it turns out that the measure kind of works a little bit better if you also weight with the relative frequency of the bigram in the training library. So for example, the Constitution is a word combination that appears only in the political text but not the non-political text, and it appears a lot in the political text. So we're going to give a little bit more weight to that, but it's not super important. This is our measure of overall political risk. Now you can go and decompose that by topic in the same way that we just did. So rather than having one political training library, I'm now going to have 24 political training libraries that are in this set Z. This set Z is going to have 24 subsets, each associated with one political topic. And all you need for that is just a text, one text that is archetypical of discussion of gun control, foreign policy, fiscal policy, blah, blah, blah. So then we again count the number of bigrams associated with topic T, used in conjunction with a synonym for risk or uncertainty. But now we weight also with what's called the inverse document frequency, which is a complicated word for just a factor that adjusts for how unique is this bigram for this specific political topic. So for example, the Constitution will be a bigram that appears in most of our 24 political training libraries for the political topics. But Second Amendment will be, oh, that's gun control. Okay, so that's going to have a bigger weight here. That's all the adjustment. And the topic-based measure is then called P-risk IT for topic capital T. That's the idea. Now, we give this content simply by defining what these training libraries are and start running the algorithm. So the training libraries I've already mentioned, the non-political bigrams, the non-political training library is going to be a textbook on financial accounting. There's also we do some more complicated stuff with getting speeches on non-political topics from a different source. It's not super important. The political training libraries for overall political risk is going to be a textbook on American politics. And then we have topic-based measures that are the text contained in 24 topics from a charity called ontheissues.org. This is like a charity that's meant to inform people on what is candidate X saying about topic Y. So they have 24 topics like gun control, abortion, healthcare, and so forth. And they just put speeches that different candidates put on, give out, or statements that candidates give on these various policy issues and list them there. We use those as our training libraries. Okay, so that's it. So now we let this thing run. And now the first step is I want to convince you that this measure of the share of conversation that is associated with risks associated with a particular political topic actually picks up political risk associated with these things. We have a whole list of things that we do in the paper, and I'm going to do them all on one slide. The first piece of evidence is that the bigrams, so the two-word combinations that our algorithm says is most indicative of political text versus non-political text, makes sense. Okay, so it says the biggest scores like the Constitution, public opinion, interest groups, the FAA, but it's a long list, so it's 50,000 two-word combinations, but these have the highest score, and there's kind of a nice table in the paper. Then we spend a lot of time looking at, you can actually program this thing to spit out which passage of text convinced the algorithm that this particular transcript has a high political risk score. And we just look at the snippet. Let me just kind of show you an example of that. So here, for example, applied energetics of products and the uncertainty of the timing and magnitude of government funding. Okay, done. Chance for national tort reform, and I don't see the Constitution of Congress changing. Okay. Was an accurate metaphor and really given all the uncertainties of government involvement. Okay. So it looks like it works. Not perfectly, but it looks like it works. The other thing that we thought was really cool is that now let's take this data set and take the mean across firms. So that's going to be a measure of aggregate political risk. And that time series that comes out of there has a correlation of 0.83 with the measure in Baker-Bloom-Davis. Yeah, so it seems like it kind of breaks down at a quarterly frequency very nicely to something that is highly correlated with what other people have found. Political risks is significantly higher around federal elections. That's also a nice feature. Then you can look at which sectors have the highest political risk. That also lines up with your intuition, finance, construction, and so forth. The thing that I want to spend a little bit more time on is that both aggregate and idiosyncratic variation in political risk are significantly related to realized and implied volatility. So we're taking the firm stock return volatility, projecting it on firm and time-fixed effects, and then we have our measure of political risk here. That's this specification here, when you see a positive and significant association. Interestingly, I won't have time to talk about this, but interestingly, this association is much smaller than the association that you find in the time series. So if you look at only aggregate political risk, the association is much higher, and I think that again speaks a little bit to part of the variation in the time series might well come from politicians are worried about, you know, the economy collapsing, so they spring into action. Yeah, so that would be consistent with finding a bigger coefficient there. What I'm going to call idiosyncratic political risk is the political risk that's left over when we have a time fixed effect, a firm fixed effect, and the interaction of a sector and time fixed effect. So this is within sector variation in which firm is kind of affected by political risk, and we're going to look at that. So I'm going to call this idiosyncratic political risk. Now, one major concern here is that executives might use language associated with political risk as an excuse. I'm doing really badly, and I'm going to blame politicians for it. And indeed, if you control for the stock return around the earnings announcement, the coefficient on our political risk variable here goes up slightly, which would be consistent with some of that behavior. But the change in the coefficient is not huge. Similarly, you can control for the earnings announcement surprise, but that doesn't do much. Okay, so I hope to have convinced you that at least our overall measure for political risk picks up stuff that looks like political risk. Now, we have the same kind of validations for our topic-based measures. I'm not going to drag you through that now. One of the nice things that you can do with this measure is you can think about, sorry, how much time do I have? Okay. You can think about idiosyncratic political risk as opposed to aggregate political risk. So don't really look at, okay, don't look at this. So let's take, so we have a panel now of political risk. Now let me do like an ANOVA variance decomposition. I want to know how much of this variation is in the time series, how much is in the pure cross-section, and how much is between time and firm. And the answer is 67% of the variation is between time and firm, 0.7% of the variation is in the time series. So even if you allow for like massive differences in measurement error in these two dimensions, I think what that means is that idiosyncratic political risk is quite important, maybe more important than kind of my prior was. Why is it important? I'm going to show you later that it correlates with outcome variables, but the other thing that's kind of interesting is we can now go, here's what we're going to do. We're going to take our panel, project it on firm, time, and time times sector fixed effects. What's going to be left over, the residual, is I'm going to call idiosyncratic political risk. Now at every point in time, let me take the cross-sectional variation in that thing. That's the cross-sectional dispersion in idiosyncratic political risk, and now I'm plotting that over time. This dashed line here is aggregate political risk. The solid line is the dispersion in idiosyncratic political risk. These two things are highly correlated. So what this kind of means is that when aggregate political risk is high, the cross-sectional dispersion in idiosyncratic political risk is also high, which might be another reason why this thing matters. Yeah, because it affects different firms very differently. Okay. Now, I want to talk briefly about managing political risk. What are the associations with outcomes that we care about? The one that we like best is lobbying. So lobbying is nice because I can use that to verify the economic content of our topic-based measure of political risk. The reason is that the lobbying data, when you lobby, you have to disclose to Congress how much money did you spend on which topic in which quarter. So I can see which firm is spending how much money on healthcare this month and which firm is spending how much on foreign policy this month. We can map between these topics and our 24 topics, and now use the within topic variation in lobbying to figure out is something going on or not. So this is the lobbying of firm I at time t on topic big T, firm, time, topic fixed effects, and you can also put firm times topic fixed effects if you like, and our measure of political risk associated with this topic. And what you see is a positive and significant association where a 1 standard deviation increase in political risk associated with a particular topic, such as healthcare, for example, is associated with a 4% increase in lobbying on that topic. Yeah, so I think that's kind of cool because you can then, so take this apart and see whether this elasticity of lobbying with respect to political risk associated with a particular topic varies across topic. And you see here the topics that firms think they can influence: healthcare, corporate regulation, environment, energy, oil, war and peace, education. Those are the main things where lobbying then moves in response. Finally, this is something that mainly big firms do. So mainly big firms have this elasticity with respect to lobbying, whereas small firms don't. We have some stuff in the paper about like probing more the causality of this thing. I'm not going to talk about that. Am I out of time?
1 minute.
Okay, fantastic. Okay. So that was the topic-based thing. Now the other thing is we have a whole other range of outcome variables that others have looked at in the literature. And the question there is, do we find, for example, an effect of idiosyncratic risk that the firm faces on investment? Now the big drawback of that is that investment is just the firm does give us one number for investment. They don't invest by topic, right? So now we're back to having a firm times quarter data set. So we only use our overall measure of political risk. Dependent variable is the investment rate of the firm. Now we're going to have time fixed effects and firm fixed effects as before. And we see a negative and significant association, meaning if there's a 1 standard deviation increase in overall political risk, that is associated with a 0.19 percentage point decrease in the investment rate. That's a small effect, but nevertheless statistically significant, meaning that there's some content to this idiosyncratic political risk variable. This is also true if I condition on a sector times time fixed effect using only within sector variation. And moreover, this seems to be kind of the same for small and large firms. For employment, there's a much larger association. A 1 standard deviation increase in political risk is associated with a 1.12 percentage point decrease in the growth rate of employment. And what's kind of fun is that that effect is smaller for large firms. So remember, the large firms, in response to political risk, they start lobbying. The small firms, in response to political risk, they start firing. Essentially, that's what this says. Okay. So conclusion. So we introduced a simple firm-level measure of political risk that can also be decomposed by topic. Firms that are more affected by idiosyncratic political risk experience more volatile stock returns, retrench hiring and investment. Firms that devote more time discussing risks associated with a particular topic increase lobbying on that topic and not on other topics. 2/3 of the variation in political risk appears to be idiosyncratic rather than in the pure cross-section or the pure time series. And then finally, the dispersion of idiosyncratic political risk increases when aggregate political risk is high. That's it. Thank you.
So I was going to say that, I mean, I can tell this is a very fast-moving paper. I only got it recently, and I think between Friday and today, some significant differences already, which is fine. I think there were originally 5 points. I was going to tell you to focus on 3 and get rid of 2, and you already got rid of 1. So I don't, I could have waited till Friday and just not given this at all. Yeah, it was fun. Okay, so yeah, thanks for having me. Thanks for letting me discuss this paper. I think it's quite interesting, and I think one of the more unique papers in the kind of largely rapidly expanding literature about policy uncertainty. Just to kind of reiterate, if you've forgotten in the last 5 minutes, what this paper. And I don't even know if this sentence is still in the paper, but we propose a new measure of political risk faced by individual U.S. firms based on a textual analysis of earnings conference call transcripts. Okay, so basically the paper tries to go through several things. It develops a new measure of firm-specific political risk. They try to demonstrate a relationship with firm-specific stock vol and kind of other metrics to show that this is actually picking up some amount of uncertainty or risk. They think about topic-specific linkages in quite a bit of detail, and then they look at these outcome variables, many of which, some of which we've seen before in other papers, investment and hiring, and then I think going on to the most interesting part of the paper, which is looking at these lobbying activities. And so, we've seen papers today. We've seen lots of papers in this literature that, and I think someone asked a question in the first, in response to the first paper. That's, why do we care about this subset of uncertainty? Couldn't we just
kind of replace every time somebody says policy uncertainty, could we just say uncertainty and have kind of the effects be essentially the same? And I think for a lot of the measures, myself included, our paper, we look at investment and hiring. There's papers on FDI and trade and asset prices and all sorts of different metrics that you'd associate with normal types of economic uncertainty or macro uncertainty in general. And I think this paper is really one of the first ones that kind of gets at, well, we often motivate why we care about policy uncertainty because of its sources, right? It's somewhat interesting to think that especially, people in the city can have some role in directly influencing the amount of, this particular category of uncertainty. But then they just go through and look at the outcome variables, common macro and financial market variables. And here, this is really this unique view, and I think the authors don't stress this enough, that one of the reasons that policy uncertainty is interesting kind of in and of itself and not just as a component of overall uncertainty is because there can be these different responses. There can be these lobbying, I like this like risk or uncertainty mitigation, risk mitigation coming through this political donations and political lobbying. So I thought that was one of the nicest parts of the paper, and I think that they should stress it more. Okay, so I'm going to talk about a bit about the measurement, a bit about some of the problems that I saw that could be potentially worked on, some areas to expand, and free disposal. This is the nice thing about working on a paper that's still very much a work in progress. Is hopefully you can integrate some things. I have to be a bit careful because some of my criticisms are going to be criticizing my own paper as well. Hopefully we've taken care of at least some of them. Okay, so let's think about the measurement. All right, this is coming from a conference call transcripts, and this kind of incorporates a number of things. I think you try to define, the authors try to define exactly what this is picking up, and I think we could use a bit more help in interpreting exactly what this is. Okay, so this kind of incorporates this aggregate level of political risk, the exposure of the firm to economic uncertainty in general. If they do a lot of fixed investment, for example, the exposure of the firm to regulatory risk, and maybe even the composition of investors. Right, this is a kind of a Q&A session. So things that to the extent that different firms have different investors with different priors or different worries, that could be a component as well. And so maybe just some clarification on what exactly we are picking up there. And so, how should we think about this measure? Is this the level of political risk? I think you kind of termed it as the kind of level of political risk as a component of, or as a fraction of overall, discussion. But again, if this is a Q&A section where they're really asking about uncertainties or risks, maybe it's a political risk as a fraction of overall risk or as a fraction of overall financial news. And so kind of like what's the exact denominator, or how should we think about the denominator in this fraction? Okay, is it that more political risk is just displacing questions about first moment worries, or is it actually kind of a purely in the numerator? Okay. A couple things about the way they measure things. I think this is a nice strategy, and we've seen kind of an increase in kind of machine learning and computational linguistics tools kind of in this area to try to maybe be a bit more impartial and easily kind of scale up some of these measurements. We do get some, you kind of end up with some kind of questionable bigrams or sets of terms. I mean, that's maybe to be expected. And I think, there's still a lot of dimensions of discretion on the author's part. And so I don't think it's, necessary to claim that you're being, completely impartial. I think, hopefully we're relatively bright people that can use some of our judgment to kind of make the right calls. And I think you largely do. But just in terms of kind of what you stress about the measure in the paper. Okay. So this is one thing that is totally endemic to this literature and is very difficult to think about. So first moment shocks, wider levels of firm-specific uncertainty, so just economic uncertainty rather than policy uncertainty. Increases in kind of first moment levels of political action, if there's a new regulation being discussed, or if there's a kind of non-political risk, this is going to kind of mechanically increase their measure. So they look at this intersection of bigrams, or this intersection of terms, and thinking about just an increase in one of those sets of terms is just going to just purely mechanically increase the probability of finding intersections. So I think you can do some work to look at the various subcomponents of this. So we've done a bit of this, breaking things down instead of like economic policy uncertainty, look for a time series of economic discussion, about political discussion, and about risk or uncertainty discussion. And that at least might help kind of clarify and enable us to interpret some of these movements about which component is really driving, say, a change in the time series. Okay. Another thing I think would be nice, and again this is maybe going to be beyond the scope of this paper, but thinking about some of the dynamics. So generally the authors are only considering really contemporaneous effects, but there's really some strong predictions about the timing of lobbying and donations, and if we're trying to get at really some strong causal inferences, it could be nice to see exactly some of the timing here. And I think you do know a fair amount about when exactly these conference calls were took place. The relation to some of the other, I don't know all of the lobbying data, but maybe if those have particular dates as well, we could get more granular and see which really causes which. Okay. And this is one thing that made me think about why some dynamics could be helpful. So you say taking full advantage of the decomposition by firm and topic, we show evidence of a causal effect of political risk on lobbying activities. I was definitely convinced that there is a strong relationship between lobbying activities and this measure of political risk, but I could see this still as kind of reverse causality, right? So if you think, if I'm a firm, I don't like a particular regulation that's been in place for 20 years, I could start, sending money and lobbying for it to be changed, and then, a senator, my favorite congressman starts to bring it up in Congress to try to get rid of it, and that's really what induces the uncertainty. And I think, that's probably not true in all cases, but certainly could be there for some of these events. Okay. So one of the nice things about developing lots of new data and lots of great new data is that you get asked lots of new questions, and why aren't you extending the data even more and answering all of the questions that might come up. So you look at the authors look at a lot of different fairly specific topics, some of which you wouldn't necessarily think would be associated with changes in corporate investment, like abortion, church, drug policy, things like that. And there is a lot of heterogeneity in the kind of effects, looking at investment, looking at lobbying. I think you showed just the lobbying graph by sector, where healthcare was the highest, the most elastic. But in some of the topics, we also see a strong positive effect. Okay, and so I think the most positive effect was, for example, for foreign policy, and this really made me think about these first moment effects that are being captured by kind of nominally this uncertainty measure. Okay, so if there's a big increase in uncertainty in foreign policy and Lockheed and Boeing stock goes up, I mean that's probably because Singapore or Saudi Arabia is about to order a lot more F-15s, not because there's it's really about the risk per se. Okay. And I think you could look at potentially some contract data there, maybe for one direct first moment measure. Okay, so thinking about, again, going back to what I think is maybe the most interesting part, and something, again, just hoping to get the authors to provide a bit more of clarification in terms of how to think about some of this. Okay, so when we think about differences in lobbying across firms or differences in lobbying across different industries or different topics, what should we really take away from these different levels of say, lobbying elasticities? Is it that for these firms or these topics, the cost of uncertainty is the highest? Is it the cost of marginal lobbying dollar is the lowest? Is the elasticity of political action highest or political results highest? Is the impact of the marginal regulation highest? Or is the ability to capture the marginal regulation the highest? So, you see really big effects for the biggest firms, and maybe that's because they're the ones that are kind of writing the legislation, and they can really capture the benefits because it's a very consolidated industry. It's something that's much more dispersed. You could look at HHI or something. maybe it's not going to be worth it. They're not going to be able to capture as much of that. I mean, in some sense, I kind of think of this as there could be periods of time where regulation or laws get a lot less sticky, okay, like in a crisis. And so in that sense, during those periods of time, that's when your kind of marginal lobbying dollar is actually going to have an effect, whereas usually laws are very sticky and hard to change. Okay. The last thing I want to mention is about the aggregate risk and the spread across firms. I wasn't totally convinced how non-mechanical this is. So, for instance, if some of these firms just don't talk about political risk at all, and then you kind of scale up everybody's risk proportionally, it seems like the spread would go up mechanically. I don't know if you can use logs and levels. Or logs would at least be kind of the minimum I think that you should check. But I wasn't exactly sure. I mean, the graph you showed was just remarkably correlated, the spread and the aggregate level. Okay, and this was a result I think you already removed or stopped talking about. So in short, super about corruption, which I wasn't totally convinced the state level measure is really a good one. We can chat later. But in general, yeah. The weekend made you see much more clearly, I can see. Yeah, this is a really great paper. I think thinking about why we actually care about policy uncertainty in particular, because of some of the outcome variables and not just because of some of the kind of inputs or drivers of it. And I really welcome. I really look forward to seeing the next draft.
If policy uncertainty generates lobbying expenditures and political donations, that's an attractive feature for politicians. They become more important. Their chances of re-election rise with political donations and so on. And I just raise this because it points to some of the institutional challenges of actually addressing policy uncertainty, even when it has harmful consequences. I don't know if you have thoughts about that, but.
So first of all, I'd like to thank Scott for sacrificing his weekend.
I forgot to give you a chance to respond. Sorry about that.
So this paper is 3 days old. So thanks a lot. Just a few things. So we struggled a lot about the question of the denominator. So there are certainly some conference calls that go up to their time limit, but you can set the time limit in advance depending on. I guess that once you start thinking about that, it gets complicated. There's this sort of like how. So some do go against the time limit, others don't. We kind of like having the denominator in there because mainly it's mainly going against us, because the longer you talk, the more trouble you're in, essentially. So that's why we just took it out. There is sort of like, we struggled a lot with like how much should we interfere with the algorithm, and as you might have guessed, as we experimented a lot with different training libraries, and we kind of then erred more on the side of just leaving it as it is, like so that or something, I guess, is a bigram somewhere that has weight, and the further down the list you go, the more of that you find. But the reassuring thing is that the biograms that get a lot of weight make a lot of sense, typically. So
you should only show this top 10 instead of the top 30 or something.
Right. Actually, so we were going to be very honest and like show all 50,000 in an online appendix. We kind of, yeah. So I don't know. So it's kind of a matter of taste of like how much you want to interfere, basically, with the thing. But it works in all kinds of different variations. First moment effects. So I think one advantage of being at the firm level is that we can actually do some stuff about that. So changes in government contract would certainly be something that we should look at. We kind of relied a lot on this sort of like stock return around the earnings announcement to basically see, recently did you embarrass yourself or not. We haven't thought as much about sort of distinguishing it from other types of risk. My general feeling, and maybe Stefan can elaborate on this, is that basically, so this conditioning on being close towards risk and uncertainty certainly like makes things more intuitive, but you can run these regressions without that conditioning and get somewhat similar results. And I think the reason for that is that in order for anything to be raised, particularly in the questions part,
it has to be associated with some kind of uncertainty. So you're resolving some, like there's information being transferred, so some uncertainties being being resolved. But we need to do more with that. What I didn't show is that we actually have like I think 1 or 2 tables on donations and lobbying, and you kind of see the more political risk you're exposed to, the more likely you are to donate to both parties, and the larger are your donation expenditures as well. So I think that's very much in line with what you were saying. Overall, just to conclude, like one thing that we're struggling with is like there's many different directions to go into, and we're not quite sure, you know, which one to pick. Maybe you guys have opinions about that.
So if you could elaborate on the following, how do you distinguish idiosyncratic heterogeneity in responses to area political risk from individual political risk? Because I could imagine that that I, as a firm, face some particular law, and there's uncertainty about that law, which is targeted towards me, versus some firms respond to this area political risk in very different ways than other ones, and that itself could be fluctuating over time.
So in a very primitive way, so essentially I didn't show you, that was the table I skipped, but basically we did like the really sort of like lowbrow thing where we actually took your guys' index and we regressed every firm's daily stock returns on EPU. Then you get an EPU beta, and you control for the interaction of that beta with EPU. So that's controlling for static heterogeneity and exposure to aggregate risk in that sense, and it basically doesn't change any of the regressions. It doesn't account for all that much of the variation. So.
But that's invariant over time.
Invariant over time. That's right.
So there's kind of fluctuations in the.
So we could do the same thing with kind of like rolling betas, but I guess that's sort of, and there comes a point where like these two things are going to be mechanically indistinguishable, I guess. I think the point that more surprised me is that I thought that most of the variation would be in the time series, but that might have been a dumb idea. I'm not quite sure. So the way I think about this is this. So let's say we'd done this in Egypt. So in Egypt, you would think that idiosyncratic political risk is much more important than in the US. And the fact that we found like effects of idiosyncratic political risk, if you're comfortable with that term, in the US, and the fact that it moves so much compared to the time series was kind of surprising to me. I guess if we do it in Egypt, it's going to be even more like that. But much of that might be measurement error, who knows?
I'm wondering about this denominator stuff and so on. Do you know the paper by Gansko and Shapiro in Econometrica where they do the slant thing? The slant?
Yes.
Right, they have one way of kind of, you have this very stark way of saying this is a political term, this is not a political term. And I think you could easily do a kind of more nuanced way that also would have kind of lead you to have an automatic, because they have this measure of kind of distinguishing between democratic terms and
so I didn't talk about this, but every bigram has a score, and we weight by that score. So not all 50,000 bigrams have the same score. In fact, sort of like things that are more indicative of political text get a bigger weight. So it's not like a stark distinction. It's just that how I explain the.
All I'm saying is that you don't have to defend it. Well, you have to defend it less usually if you just use an Econometrica paper and say, look, we do it like they do it, right? I'm just saying that buys you a lot of discussion.
I thought the issue was you take certain terms that appear in the accounting textbook and they're just completely off the table.
Right.
Whereas they might actually appear 100 times as often in the political text as they do in the accounting text. And so you might think about including those, but downweighting them as well.
Right. So basically, yeah.
There's zeros and then there's all kinds of weights.
Right.
Simon. Oh, you've got the mic already. I'm sorry. Go ahead. Go ahead. Good strategy.
So if you just construct a measure of policy uncertainty using their algorithm, is the problem that essentially the measure is constant because there's always going to be a mention of any of the keywords they use? I mean Baker, Bloom, and Davis use in order to construct their index? Say you search exactly the set of 3 keywords and then aggregate.
So we did that, but you can, as you can imagine, with like a method like that, you're going to run out of power like very quickly. So mainly because it's so you know, then you suck data out of 5 words
rather than 50,000. So we did try a version of that. We didn't get any traction at the firm level with just like looking for uncertainty and, I don't remember. There's basically 5 words.
That's because there's too little text density in the earnings conference calls?
Well, so you guys have, I guess you guys have like, you have many newspaper articles that you search across.
Right.
It's like
You're
looking
saying
in
you just
one.
use one.
It's like looking in one newspaper article.
Yeah.
So you need to use, especially if you want something more than a 1-0 classification, you need some intensive measure at the text level.
Right.
And that's why we did this.
Okay. You need to go down to like the question level.
Right. But we should probably explain that in the paper. That's archaeology, but so that's how we got there.
It was like 2 weeks ago.
Okay, my turn now. So 2 questions, as you can imagine. 1 technical question, 1 less technical. Technical question is when we talk about decomposition into aggregate plus idiosyncratic risk. So how do you do this decomposition? Is this what you have panel data setting? You just do a total sum squares decompose total sum squares into aggregate and cross section. This is one way you do decomposition. Another way is I'm thinking about there's a paper by John Campbell in Journal of Finance. So what did he talk about? What is the uncertainty or the volatility of a typical stock, right? If you randomly pick up a stock, right, with each of them with equal probability be chosen, you can also measure the uncertainty of a typical stock into 2 parts. One is common or market volatility, another is idiosyncratic volatility. I'm wondering which decomposition you are taking.
So usually when I said idiosyncratic, what I meant is so it's basically the variation that's left over after you have a firm fixed effect, a time fixed effect, and a time times sector fixed effect. So it's within sector variation. We did then the same thing, basically removing the time and sector fixed effect and replacing it with these heterogeneous loadings on betas. That leaves over pretty much the same variation. So in other words, the differences in static loadings on EPU vary largely at the SIC2 sector level. And once you take that out, the variation over time, you end up with what we call idiosyncratic risk. I think regardless of, so there's different ways of doing that, obviously. But this is sort of like the lowbrow way that we did it.
Okay, second, less technical question. There's a large literature in accounting and finance. People talk about earnings uncertainty or earnings forecast uncertainty, right? So one of the literature look at, the lack of readability in the conference call. Basically, when they make this announcement, they will tell you like what
lack
of readability.
Yes.
Right. Basically, they will tell you either the quarterly earnings will be 3%, or they will give you a range between 1% and 10%. Or sometimes simply they say, my forecast for earnings will simply go up, right? So there is a there's a paper on that. There's a whole literature on using lack of readability. So I think I'm wondering how you measure correlated with this measure, and also econometricians used to fit
our measure of earning surprises.
Yes.
Yeah. So I'm gonna defer to my accounting colleague. Okay. This question.
To answer that question directly, so we didn't measure readability in the way that you just described it, but have you ever read the politics textbook? I mean, that's not readable either. I mean, and that's the strength of our approach. I mean, we got these bigrams, and as long as they show up in a transcript, whether it's readable or not readable, we get a load. And that's how our approach works. I'm not really sure what kind of readability measure that you have in mind. I do know there are some textual computational linguistic measures available, like fog index or something, but I don't think it will intervene with our results. I mean, if at all, I guess it will work against us documenting what we find, but at this stage we haven't looked into that. So what we do have, we've got earnings surprises. That's one of the measures that Tarek showed in the presentation, where we got this quarter compared to last quarter, so that's the earnings surprise scaled by price. So that's the measure that we have. And again, yeah, we can do much more work if we need to or have to. Yeah.
I'll show you a couple of references.
Oh, please. Yeah, thank you.
So you talked about how you pick bigrams that are in the politics textbook but not in the financial accounting textbook. So just so for me to understand. So you would not consider something like financial regulation, right? Which a bigram would appear in both the politics and the...
So that's the whole point, right? So you want to focus on bigrams that are indicative of discussion of a particular topic. Let me just say one thing. When we go to the topic-based measure, there's different ways of doing this. You don't have to assign 0 on the non-political bigrams at all. It's just making things manageable. So if you have a large enough training library, you end up with 5 million bigrams, right? And then you're going to have a long tail of ones that have 1 over 5 million score, right? So basically, what you weight with is the relative frequency and the interacted with the discriminatory power. So it's log over the number of things that you're trying to distinguish divided by the number of libraries in which this bigram appears. That's the more general formula. I'm kind of comfortable with just assigning 0 to like the 4.5 million, mainly because it makes things manageable, and then I can look at the list, and then Scott's not going to tell me that 2B shouldn't be in there. But these are judgment calls that we made.
So you showed us some firm level implied volatility regressions where you regressed, I guess, the option implied volatility at the firm time level on the political risk index that you constructed. And you stressed that the coefficient on the political risk index basically fell by an order of magnitude once you threw in firm and time fixed effects. And I think that was important for your inference that the idiosyncratic component dominated. Is that, do I follow that correctly?
I guess like so the first thing that's striking is that once you put in the time effect, the coefficient falls a lot, which basically means we have like one specification where we just control for the mean across firms in political risk, and that has almost exactly the same magnitude that you guys have in your regression. So one standard deviation increase in the mean of political risk across firms is associated with 0.4 standard deviations increases in volatility.
But this is the thing.
So one thing, and then but the remainder, so the within time variation, I guess. The within time variation has a smaller coefficient.
Yeah, but this is what I wanted to get to, because we do that. We do the same exercise with our measure, where we throw in firm and time level fixed effects, and in our setting the coefficient only falls by half, and yours it falls by a factor of 10. So I'm not quite sure what to make of that, but I just wanted to point that out that we don't find we don't soak up as the empirical elasticity of volatility with respect to the political risk measure doesn't fall nearly as much in our setting when we condition on firm and time effects.
But it's beta times EPU, right? Or government contracts time EPU.
Contract intensity.
Yeah.
Well, that's how we do it. So we have a cruder approach to constructing firm level time varying political risk. I'll grant that, but
I think so. Here are 3 things I can come up with. So one is just at least going from the mean to like whatever your measure of idiosyncratic effect goes down. One interpretation of that is there's reverse causality in the time series, where politicians start regulating as soon as stuff goes wrong. So that's one. Number 2 is differential measurement error. Yeah, that's I think relevant in our case. And number 3 is there might be some multiplier that comes out of that you treat political risk that affects other people also, that you're more sensitive to that because you think there's going to be demand effects. So those are 3 things I can come up with.
Okay.
But I have no idea how to distinguish, but maybe we should talk more about that. I also don't know what happens with our EPU beta times mean. I don't know how big that coefficient is. Do you remember, Stefan? So that would be parallel to what you were saying.
Okay. Any other questions, comments? Okay, very well. Then we're going to move directly to the last paper, so no break this time. We've conditioned you to expect a break after each paper, but no break this time. Thanks very much. All right, so the next paper is going to be presented by Kaveh Majlisi, Importing Political Polarization, the Electoral Consequences of Rising Trade Exposure, and Nolan McCarty will be the discussant. And I'll let you introduce all your co-authors. Go ahead.
It's a pleasure to be here. This is a joint work with David Otter, David Dorn, and Gordon Hansen. Well, Well, the impact of trade, and especially trade with China, has certainly been a touchstone issue in this election cycle. And candidates from both left and right have kind of slammed trade and trade agreements as a source of all sorts of issues for US workers. Right? And there is certainly a context for that. So the share of China in world manufacturing export grew rapidly between 1991 and let's say now, and especially picked up after December 2001 when China joined the WTO. And it is, as you can see in the blue graph here, it's also reflected in the import penetration of China in US manufacturing. So recently, there have been a couple of studies that have looked at the effect of this rising import exposure on industries and basically the economic effects of it. So we know that in more trade-exposed industries, we have observed a higher number of closure of manufacturing plants. People who lived in labor markets that were exposed more to trade with China experienced lower employment, higher labor force exit, etc. And you can see it even at the individual level, right? But it is important to keep in mind that these anti-trade sentiments precede this election cycle, right? So although the previous literature has not been able to convincingly match labor market shocks with election outcomes at the congressional district level, but there is some evidence that congressional representatives from trade-exposed districts are more likely to vote against trade bills and also more in favor of anti-China foreign policy legislation. In this paper, we do match labor market shocks originating from trade with China with congressional district outcome and go kind of beyond voting on specific issues and ask if trade exposure kind of affect the ideological composition of the Congress itself. Okay? Now, thinking about rising trade exposure and political division in Congress, we ask three distinct questions here. One is anti-incumbency effect. There is a large literature that kind of claims that incumbents tend to be punished for bad economic outcomes. And we kind of check that in this context as well. Then we move to check party realignment effect. Is it the case that as a result of these shocks, one of the two major parties in the United States kind of benefit more, right, in terms of vote shares? Right? And finally, we look at this third outcome, polarization, that has kind of been ignored in a way in the economics literature, at least, right? And the idea here being that in response to these adverse trade shocks, beliefs of those who are leaning right might move even further to the right, and those who are leaning left might move further to the left, right? And there is a theoretical, actually, background for it. There is this nice paper by Avinash Dixit and Webel that kind of characterizes this hypothesis, and then there are other papers that have followed that path. Having answered those three questions, we also ask whether trade shocks are different from other type of economic shocks. And particularly, we look at two different shocks here. One is general labor demand shifts across labor markets that we capture through like a Bartik type measure. And also we look at the effect of post-Great Recession housing market bust, which is not, by the way, correlated with our trade exposure across labor market. Now, well, the empirical strategy here and the challenge here is to match local labor markets in which exposure with trade with China happens and congressional districts. The challenge here is that because of gerrymandering and some other issues, some congressional districts can have very extreme shapes that do not correspond to any definition of local labor market, right? So this is an example, for example, so this dark green here is a 12th district in North Carolina. It stretches over 100 miles, and at some points it gets really, really narrow, and it covers some parts of Charlotte, Winston, and Greensboro. commuting zones. By the way, I use commuting zones and labor markets interchangeably here. Now, the question is, if some shock happens in the Charlotte area, how does it exactly transmit it to this dark green area of the map? So this gentleman is a member of the North Carolina House of Representatives, and he once said that if you drove down the interstate with both car doors open, you would kill most of the people in the district. And he's, well, of course he's exaggerating, but not by much, because at some places you would kill people if you do that. Well, so what we do to actually address this problem, we do our analysis at the county district cell level, right? So we divide the continental United States into county by congressional district cells. And of course, you can only do that if you have voting data at that level, and we have it. So, and then we attach each county to its corresponding commuting zone, labor market, and then weight each cell by its share of congressional district population, right? So that each congressional district has the exact same weight in the final outcome, which should be the case because each congressional district sends one elected official to the Congress. So the result of this is a mapping of commuting zone shocks to district political outcomes, and we use trade shocks from the previous work by my co-authors to kind of measure political outcomes. To examine electoral outcomes, we do it over 2002 to 2010 period. Now, the reason for that is that after each census, the borders of congressional districts are redrawn. So if you want to do it like across consistent congressional districts, you need to kind of do it, you need to examine intercensal periods. So we are kind of limited by that anyways. Fortunately, these are non-presidential election years, and again, 2002 is exactly the year after China joins the WTO, and we see this rise in trade with China in the United States and the whole world, actually. So data sources that we use here to examine the polarization of the Congress, we look at the actual political behavior of congressional representatives by looking at their nominator scores. Now, I won't have time in this presentation to go to the details of how nominator scores are constructed, but this is a score between -1 and 1. -1 being the most liberal one can be, and 1 being the most conservative one can be, right? And it's estimated using all the votes that the official actually cast in the Congress during the 2 years, right? So it is estimated for each legislator in each Congress. The nice thing is that you can compare across Congresses, and it's averaged almost around 0 if you look at all Congresses through time. So we tag 2003-2005 score, which is 108th Congress, to the winner in 2002 election, and 2011 to 2013 score to the winner in 2010 election. And as I said, we make use of vote shares at the county district cell, and this comes from David Leib's Atlas of US Presidential Elections that actually does provide this data at that level, fortunately. And we also use campaign finance score data, which tabulates kind of campaign contribution by donor and recipient for all accounts in excess of $200. So to measure exposure of commuting zones to trade with China, so we look at the change in import penetration of each manufacturing industry between 2002 to 2010, and then we weight it by the share of that industry in the employment of the commuting zone in a pre-sample period, right? Well, of course, the change in US import demand could contaminate this, and because of that, we IV for US imports from China using other developed, imports from China to other developed countries to kind of get around that problem. So this is a geography of trade exposure in the United States, the darker places being the more exposed ones. So the main the main empirical specification we use in this paper is something like this. On the left-hand side, we would have 2002 to 2010 change in electoral outcome for County J District K, and then we have import exposure in commuting zone for County J, of course, and a bunch of controls, including political conditions in 2002 for County District JK, economic conditions in year 2000, demographic composition, and as I said, we weight by the share of this JK cell in District K. So let me show you some results. So first we look at vote percentage for party that won in 2002. So by the way, to interpret any of these coefficient estimates, if you compare, like, let's say, a district at the 75th percentile of the exposure to 25th percentile of the exposure, the difference in that exposure level is almost 0.5. So if you multiply any of these numbers by 0.5, you get a sense of like the effect for more versus less exposed district. So as you can see now, in the first column, we observe that vote percentage for party that won in 2002 goes down more if it was exposed more to trade, which is consistent with this anti-incumbency effect, and also might indicate like more competitive races. Okay? Now, to kind of look into it in more detail, this more competitiveness, we also look at the probability that both a Republican and a Democratic candidate run in an election. We also look at the number of votes cast, the percentage of registered voters, and the level of donations, right, by individuals and corporations. And overall, the results show that it is indeed the case that more exposed areas become more competitive. The race becomes more competitive, and then we move on to looking at party realignment effect. So this is vote share for Republicans and Democrats, and we see absolutely no effect, right? So it's certainly not the case that any of the two major parties gain in terms of vote share from the trade shock. So when we think about polarization, at least in the United States, it kind of highlights the value of looking at the actual kind of behavior of congressmen in the Congress, and not like how much vote they got, because it's not the case that red districts are becoming more red in the sense that they get more vote, and blue states blue districts become more blue. And this is exactly what we do when we look at the effect at a nominator score. So that number between -1 and 1, we have multiplied it by 100 so that it's easier to read. And that's what we see in column 1. We see that on average, when the shock happens, congressional districts move to the right, right? It's a positive and significant number here. But a move to the right could both mean that both initially Democratic and initially Republican districts are moving to the right, or we see a move to the right for initially Republican and move to the left for Democratic, but the move to the right is more is stronger, right? So to kind of shed some light on that, in column 2, we look at the absolute nominator score here. So we measure moving away from the center in a way. And we certainly see that there's a big kind of moving away from the center. And then in column 3 and 4, we decompose that into move to the right and move to the left. And we see that 75% of moving away from the center is because of moving to the right, and 25% of it is because of moving to the left. Right? To look into it in more detail, we define moderates, let's say, as those between 20th and 80th percentile of ranking in this nominator score. This is, of course, arbitrary, but we have, if you change this number, the results don't change. And we have also used a cardinal measure in the paper. The results go through. And what we see here is that in column 1, so this is the probability of picking a moderate. Right? As I just defined it, and trade exposure definitely hurts moderates. So if you define those to the left of 20th percentile as liberal Democrats and those to the right of 80th percentile as conservative Republicans, you see that trade exposure on average helps conservative Republicans. And it's also evident if you look at just the effect on picking a Tea Party member in the Congress in 2010. You see that here as well. But there is a lot of heterogeneity actually that, going on here. So when we divide our results into initially Republican and initially Democratic districts, we see that when we look at initially Democratic districts, losses of centrists is compensated by gains on the left and on the right. So some districts move to the left and some districts move to the right. But for initially Republican districts, we see a move to the right only, right? This is kind of consistent with that 75%, 25% number that I just talked about. And more interestingly, I believe, when we divide counties by race, we see some really pronounced effects. So in panel A here, we have counties where more than half of the voting age population is non-Hispanic white. And then in panel B, we have counties where less than half of voting age population is non-Hispanic white. And you see that in the top panel, it's certainly the case that the loss for moderate Democrats and moderate Republicans is only compensated by conservative Republicans and also, of course, Tea Party members. But for counties where less than half of the population in non-Hispanic white, we don't see any move actually to conservative Republicans. It's all compensated by going to the left, right? So we have less of these counties in the United States actually. Again, this is consistent with that 3/4, 1/4 result that I talked about earlier. And finally, we look at impact of other economic shocks. So what we do here, we add measures of two economic shocks to our baseline specification, as I said before. One is a Bartik measure for the predicted change in commuting zone employment based on national industry changes, and then the peak to true log change in local housing prices, right? So what we find is that, first of all, the results for the impact of trade exposure remains unchanged. So that doesn't affect the results that we saw before. Changes in housing prices are strongly related to changes in electoral outcomes, but we only see it in initially Republican districts. We don't see anything in initially Democratic districts. And then when we look at the effect of the Bartik shock, which kind of captures the overall demand in labor, qualitatively the effects are similar to trade shocks, but they are not nearly as pronounced, right? Which might be because trade shocks are much more localized. And these Bartik shocks, the way it's constructed, it is not. But this is just a guess, of course. Let me conclude by saying that, so we have observed this rising political polarization, but honestly, it's not very well understood. And so the coincidence with widening income inequality and wealth inequality kind of naturally leads to this conjecture that they are related, but we don't have many much concrete evidence that supports this. And I think this paper kind of speaks to that hypothesis. Now, why would trade shocks contribute to political polarization? One idea, and this is of course an idea, is that this is consistent with this theoretical background that people have talked about. So under some conditions, the beliefs of those who lean to the left could actually lean more to the left, and those who lean to the right could lean more to the right, especially if they have already diverged, as it is the case after 2004. So this could be one hypothesis, of course. And we saw that the employment consequences of trade are accurately recognizable, right? This is through previous work. So because of that, it could be that it's also politically actionable. This is not necessarily the same as general labor demand shocks. Thanks for your attention.
Let me thank the organizers for the invitation. I was really delighted to have the opportunity to discuss this paper. Obviously, as you could tell from its first slide, it's like ripped from the headlines. It may well have a lot to do with things we've all been reading about in the newspapers the past few weeks. Okay, so what I want to do in my time, I'm not going to get into lots of the details about the paper. The issues of kind of measurement and everything I think are quite well done. What I want to do is to try to lay out a different interpretation, one that focuses less on importing polarization, but one that's much closer to the thrust of this conference, which is about the role of uncertainty and what role it can play. So to do that, I want to lay out some kind of data and some stylized facts, most of which are in the paper. About half of this is in the paper, but he didn't talk much about it in the presentation. But I think it helps to underscore why I have a slightly different interpretation. So the first is the measure of polarization that's implied by the DW nominate scores that he uses to measure ideology. So again, DW nominate scores are measures of legislative voting records, which are scaled from -1 for very liberal to +1 for very conservative. You can typically construct measures of polarization based on taking the average differences between the two parties. The first takeaway point here is that polarization in the United States has not been a constant. There's been lots of historical variation over time, but the most recent episode began taking place sometime in the late 1970s. So, just a thing to flag at this point, we should question whether we can think of trade exposure as being kind of an ultimate cause, given the timing being much earlier than what we're talking about here, which is like 2001 and onward. The other thing to take away is there's some pre-existing trends in polarization that take place before the measurement of trade exposure in this paper begins. A second important set of facts, again, these are in the paper, you didn't talk about them now. If you decompose the polarization measure by party and just show the average position by party, two things are kind of striking. The first, again, is we have this kind of pre-existing trends going back to the 1970s, but they're almost all exclusively within the Republican Party. So we have a situation where the Republican Party has become much more conservative over the past 40 years. Now, for reasons, some of which are methodological in the way these scores are measured, there's some smoothing that has to take place, but also behaviorally, the movement of returning members of Congress is very small relative to the repositioning of new cohorts. Okay, that's another important thing to remember. So much of this trend in the Republican Party is being driven by new cohorts of legislators being elected each time. The existing members have moved a little bit to the right, but each new cohort is considerably to the right of the previous cohort. So within the Republican Party, the younger you are, the more conservative you are. And that's just a fact that's been there for about 40 years. Okay, so these facts are in the paper. Here's a fact that's not in the paper, and it's actually it's almost not anywhere, because we've been programmed to believe that there's no competition in congressional elections, that incumbents get reelected all the time, and it's just the same old guy, same old gal after another. That's actually not been true. In fact, the period in which we're primarily focused in this paper, 2002 to 2014, has actually been one of the largest periods of volatility in terms of parties and swings since the 1930s and 1940s. So basically, beginning in 2006 through 2012, we had the largest three-election absolute party swing. We had a big swing to the Democratic Party in 2006, a big swing in 2008, a huge swing back to the Republicans in 2010, and then a slight swing back to the Republicans in 2012, and then 14, it started to taper off. So it's important to remember that despite what you hear, that gerrymandering's taken all the competition out of elections, it's just not true. There's a lot of volatility in congressional elections over this period, and I think this has a lot to do with the story. So let me just kind of restate, remind you what the findings are from a few minutes ago, and try to, for me to kind of construct an alternative story. So again, the first is employment shocks associated with increased imports for China had a polarizing effect on congressional representation. Kind of moved Republican districts to the right in terms of the representation, smaller effect for Democratic districts to the left. Important thing, it wasn't really focused on in the presentation, it's in the paper, I think is a very important thing, is the effects is concentrated in Republican seats that turned over during the decade. So again, partially because of this fact I mentioned, which is that existing members don't move very much, but new cohorts move a lot, you're going to get an effect that's highly concentrated in the seats that turned over, in particular because of the previous graph I just showed you, the seats that turned over in 2006 and 2008, and I'll explain why that's important in a minute. And then other economic shocks have much smaller effects. I won't have much time to talk about that. Okay, so the first thing, again, another thing I just want to point out is it's hard to reconcile these results, I think, with a story which says that this Republican movement to the right is in some sense driven by anti-trade politics, populism, and so forth. So there's a citation to an important paper in the paper showing that at least in the early 2000s, the parties were all over the place in terms of trade. Sometimes Republicans were more pro-trade, conservatives were more pro-trade than liberals, but that had basically sorted itself back out by the time that this paper is measuring. Same paper, if you look at regressions of DW nominate score on trade, they're very consistent. The more conservative you are on this DW nominate score, the more pro-trade you are on average. Now, of course, this paper is a little dated, so I wanted to look at a couple of recent and very important votes on trade to see if things have switched, at least recently, on the most highly salient votes. So I took two important, what I think are kind of important votes here. One is going to have to do with part of my story, and then one is kind of more recent. Here I'm just showing you the coefficient of the DW nominate score in a linear probability model of whether they voted in favor of the trade bill. So the first one is CAFTA, the Central American Free Trade Agreement, 2005. Extremely controversial vote. It passed 217 to 215. So you can find more conservative scores are consistent with voting for CAFTA, especially among Democrats. There's zero correlation in Republicans, but Republicans were much more likely. So within variation of the Republican Party, there wasn't much, but it's not the case that these most extreme Republicans were voting anti-trade. You find something similar in the recent Korea, Colombia, Panama authorization. Again, the higher the DW nominate, the more likely they were to support the trade bill. The within-party effect of the Republicans is a little bit smaller. Here's a plot of the CAFTA vote, plotting the DW nominate score by their vote, and the vote in favor, and the vote against. I won't show you the one for Colombia because only one Republican voted. Only one Republican voted against the Korea, because only one Republican voted against. But you can see the story is, again, Republicans are more likely to support it. There's no variation within the Republican Party. They're both equally likely. So the story that's kind of the trade exposure has driven Republicans to the right, away from moderate Republican positions to conservative Republican positions, that doesn't quite seem right. So that's another point I wanted to make. So here's, I think, my interpretation of what's going on, and I'm going to invoke a little history and political agency, some proper names. One of the things that, so in 2006, you might remember, was kind of when Bush became kind of a lame duck president. Katrina had just happened, the Iraq War had gone bad. But a third thing happened, which was they voted on CAFTA, which was very controversial and barely passed. So in terms of strategizing for the 2006 election, Rahm Emanuel, and to a lesser extent Nancy Pelosi, devised a plan which was to put candidates, high-quality candidates, into red state districts to try to knock them off. So the plan was not to take liberal, San Francisco liberals and put them into North Carolina districts. They were to find candidates that could win in North Carolina, Pennsylvania, and other places that were kind of brown in this previous picture. So here's what they did. They found some candidates that were pro-gun. They were anti-marriage equality. In some cases, maybe even anti-gay. But they were mostly pro-union and anti-trade. So here's just a kind of a journalistic quote about what Emanuel did. So here's to put a face on it. Here's the most popular face in this town. So this is Heath Shuler. He not only was a 3-term member of Congress, but he was a quarterback of the, I guess I'm supposed to say now, the national football team from Washington. But he's an interesting case because he was exactly one of these guys who ran in North Carolina. And his opponent was a guy named Charles Taylor, a 12-year member, whose vote got lost on CAFTA. It was a district that was totally against CAFTA. It was 217 to 216. If Taylor had voted against CAFTA, against his party, it would have sunk it. So somehow the vote went missing, and this was like the key issue in this election. So the conventional wisdom, I won't have time to read it all, is that the CAFTA vote played a really big role in these 2006 elections, in addition, of course, to Iraq and Katrina and scandals associated with like House pages and things like that. But CAFTA was very important. So this strategy paid off especially well in those districts which were trade exposed. And this is very consistent with the findings of the paper, which is that in initially Republican districts that had turned over, the effects are much larger. And my argument would be that you have this turnover associated, again, where trade exposure was an issue among many, and then an election in 2010 where much of those gains were completely reversed due to the other shocks. So I am very sympathetic, that the claim that they find strong evidence that districts held by Republicans in 2002 impacted by the China shock in 2010 had much more conservative representation. But I'd argue for a slightly different mechanism. The mechanism was kind of this political uncertainty caused by this confluence of trade, guns, gays, Katrina, Iraq, which led to lots of Democrats representing kind of unusual districts for them, who were then replaced by Republicans. And recall my third factoid, which is that each cohort of Republicans is just much more conservative than the previous cohorts. So trade sped up polarization in the United States, but it did it in a very particular way by throwing out older, moderate Republicans in districts which they might have maintained a moderate voting record because they are areas that are more pro-union and more anti-trade, but then ultimately replaced them with the Tea Party types that Kava mentioned at the end. Okay. Thanks.
Want to respond briefly?
Quick comments. So on this, the way I read your main comment here is that trade has this destabilizing kind of effect, and then there is this secular trend for replacing Republicans with more conservative ones. It certainly could be true, but I mean I don't think it's the whole story because of two reasons. In one of set of results that I didn't show actually in the presentation, so this Bartik type shock that we introduced to the empirical specification, in some specifications that too has this destabilizing effect. So it does kind of lead to replacing the incumbent, but then it doesn't lead to any polarization. So my point here is that if like any type of shock that kind of results in having a different candidate would result in having a more conservative one, then we should have seen it in in that specification as well, and we don't. The other thing is that this move, a slight move to the left that we cannot ignore, right? There is a set of districts in which we do observe that as a result of these trade shocks actually move to the left, at least when we divide along the racial lines. Now, of course, it could be consistent with the story that too is a part of the secular trend, but certainly I don't know. But that the Bartik thing is a bit kind of difficult to reconcile with the story that you mentioned. Although I can't believe that. I can't believe that. One more thing is that we certainly don't think that this is like so that the electorate kind of picking their representative so that they go to the Congress and vote against trade. I really don't think this is the story that we are observing, although they are hit by trade. Because voting on trade is just like less than 1% of the votes that a congressman or a congresswoman actually cast during a two-period Congress, and it's just hard to imagine that the electorate pick their officials on that number of votes, and it's certainly the case that, as you mentioned, like as you go further to the right, it's not as obvious that they are actually pro-trade. I mean, we know that some of the Tea Party members are actually at least anti-trade agreements, although they could be like conceptually pro-trade. So they are suspicious of some of the trade agreements at least. These are the only comments that I wanted to mention.
Let me start off with a question. It seems to me you've thrown away a lot of information about the impact of import competition by restricting your attention to the DW nominate measures and outcome. And so you're forcing everything on the same left-right political spectrum. Right. And it'd be nice, I mean, I think the question that we want to know is if it is the case that import competition led to, populist surge and that led to turnover in the representation of Congress, well, they might become, the newly elected members as a consequence might become more right on some dimensions and less right on others. So why not look at outcome? There are all these groups out there that code legislators on, you can get as narrow or as broad as you want, social policy, or you go down to abortion policy. And there's no particular reason I can see why the wave of people who come in on a populist wave in reaction to trade has to conform to the pre-existing pattern. So you could look instead at the outcome at the district level, what happens to the outcome by various measures of voting behavior. You could do that both for the ones who stayed in office and the ones who changed, and then characterize the outcomes that way.
Yes, sure.
And all that's being suppressed now.
Sure. So actually, we went through that exercise ourselves, and we coded all these different kind of nominated scores based on category ourselves. So if I can I have that clicker? Actually, let me show you a table. It's in the appendix. We have that in the paper actually. So if you do that, so we have estimated the one that you described for 7 categories. This is it. So budget regulation, domestic social policy, foreign policy, globalization, tariffs and trade, immigration and naturalization, and then we have in panels A and B, we have looked at the correlation of that nominated score with the nominated score that we kind of use in the paper. And as you can see, it's strikingly high. So for 2002, for example, the lowest you get is 93%. You see, and in 2010, the lowest you get again, I think, is 93%. Right? Yes. Which is interestingly on tariffs and trade, because I believe that some of the far right candidates.
Is this just restricted to the seats that turned over?
No, it's for everybody. But a lot of them actually were turned over in our country.
But it's dominated by the ones that didn't turn over.
But we can do that as well.
Nolan said earlier, there's.
But we had that actually, but we dropped it.
Okay.
Yes, but this is what you had in mind, right? Or not?
But I'd like to break it down between those, the seats that turned over in terms
Okay.
of legislature, you know,
Okay.
new legislator, and those that continued,
I
because
see.
you expect most of the action to be concentrated
It's
on
a-
the seats that turned over.
Exactly.
So Kava started with the two photos at the front, the two photos, but in fact your empirical work has nothing to do with that, and Nolan's interesting counter, which is very appealing, has nothing to do with that. So actually this is maybe for both of you, but is there something different? If you say take Nolan's story, something really different seems to be happening now. It's more consistent with your story, but what can you say anything? Can you say anything about that?
I have a thought on that. I think it actually does. I didn't have a chance to draw this connection, but I think it does have a connection. And that what this 2006 story I told was it showed a kind of a vulnerability in the Republican coalition, which is that if the Democrats ran candidates who had this issue position plus anti-trade, they could win. I think Trump is kind of reverse engineered that a little bit, which is to say I can take the standard Republican issue position, I can change the trade position, and I can be very popular in exactly these parts of the country. So I don't know that, I don't give this sort of forethought to Trump, but he could have just sat there and looked at the 2006 House election results and said, you know, this is the way that the Republicans have to go forward, because if we don't, then the Democrats, you know, can take an anti-trade strategy and unravel our coalition from the other side.
And consistent with that, actually, we have run our empirical specification on the primary results, and the results are striking in the sense that it has a lot of power in predicting like Trump's wins, where Trump wins. But we decided against actually putting it in the paper because it was not really clear how you want to compare that election with this nominator score type story.
So there's a lot of conundrums here because I'm looking at the Pew Research poll on what are the top issues in this election, and trade is not in the top 10. It's number 11. The economy is just at the top, far and away. So I wonder if the anti-trade rhetoric isn't a code for this economy is bad, we're not the problem, foreigners are the problem. I'm just throwing that out.
I actually totally agree with that. I really don't think that the electorate are sitting there thinking that so trade agreement with China happened, now I don't have a job. It is more about like a very acute kind of economic shock that I feel bad about, and then I have a reaction to it. That's how I think about it, and it's kind of reflected in the picking representatives that are not all of them anti-trade.
So just a follow-up. You may have seen that today they released the household income data, which was up very sharply and more sharply at the bottom. So the income inequality has fallen. So once again, we're fighting an election over yesterday's problem.
Yes, okay, that's interesting.
We have to do about that.
But if that's your interpretation, Kavi, then why don't the Bartic demand show up the same way?
So the reason being that the way I think about it is that trade shock is much more recognizable. So the Bartic type kind of shock covers everything, right? It covers trade shock with China. It covers like technological shock. It covers changes in federal, etc., etc. And I think it's more homogeneous across labor markets.
Yeah, but if the
But
manufacturing
this one-
plant shuts down because of automation or
Right.
because of trade with Mexico.
But it's not as concentrated the effect in a particular kind of labor market area. That's what I'm saying. Because if you think about, for example, furniture building, it is basically Carolinas and Tennessee. There's nowhere else that kind of builds furniture. But that's not the case about automation.
It's also because of the issues related to foreignness and so forth. It's easier to politicize trade than it is to politicize a general shah.
Scott, you got the mic, so you go ahead. I'll pass it on.
The question, I think, the question I have based on Nolan's response is that do your results hold it in the 2006 midterm, right? So 2002 and 2010 are both Republicans swinging, Republicans gained in both of those midterms for a variety of reasons. So if you picked a different midterm election, do you have the same within the same decade to keep the same districts? And I think kind of moving on, kind of building on this point is I think even in the 2006 elections, there were some surveys done that said that the CAFTA vote wasn't all that salient. And in fact, a lot of times people didn't even know how their members voted on that. So is this, just something, I think, as people have said, just something completely different, and it happens to be that these two elections that we picked seem to correlate with this trade measure. And finally, I know you mentioned the Bonica donation-based score. So how do you use that? How do you use them, and do you use them in terms of primary challengers or? Yeah.
So about the first question, so we have done 2002 to 2008, but we haven't done 2002 to 2006. So the results actually go through for 08 as well. For 06, the reason we haven't done it yet is that we thought there hasn't been enough time, maybe. So we haven't looked at it yet, but maybe we should. Maybe we should, and to see if the results are consistent. So we haven't done that, but for 08 it is consistent. For the campaign finance, so we have done a lot of things, but so this is the only thing that we have in the paper on dividing between individual and corporate, and this is not the primary election. It's the general election actually. So we had also looked at the kind of what do you call the score that there's also a score assigned to both to the donors, right? Like how conservative or liberal they are, and we see some effect again for individual. When we look at corporate donations, we see some effect on corporate donations that goes along with kind of the story we are saying, that becoming more conservative, donations from corporations coming from more conservative corporations. But we don't have it in the paper yet, or I don't know if we are going to have it actually in the paper. I hope I answered the question.
So I had kind of a data question just about the nominate scores in general. I don't know if either of you.
Nolan should answer.
Yeah, so essentially it's about kind of the accuracy, how the kind of interpretation of the nominate scores could change over time. So they're based on kind of the relationship between votes between members of Congress, right? So if there's been changes, and I think there have been changes in terms of kind of how the party sees defectors, or how the party may punish defectors, or understand when people are going to vote differently than the party position, maybe that would change kind of the revealed votes, or the votes that actually take place. And if a lot of the kind of horse trading and differences in say conservativeness or liberalness are kind of hashed out in the run-up to the vote, and the only votes where everyone's kind of aligned actually kind of come to pass, it's going to seem like there's a lot of polarization when maybe there's not as much. I could be reading that completely wrong, and I'm wondering, maybe some political scientists have looked at this. I know they use the nominee score a lot as well.
We looked at it a lot. I mean, this is one of the things you obviously want to be concerned about. Here's one thing that I'd say. I put that vote on CAFTA was not atypical of a vote that you would see even now, even as lots of polarization in 2005. Yeah, you see a vote that still splits both parties, and so the idea that the politician is just purely well-disciplined with party line voting, you still, within the contemporary U.S., you still see variation within party that's pretty consistent with what we saw in Canada.
So it's a question, I guess, about the mechanism from trades to this outcome. So is this, so first of all, if it's a trade effect, is it going through labor demands? And, you know, if it is a trade effect, is it really kind of a general trade effect, or is it a China-specific effect? For example, you know, some of the specific examples that we were discussing before, it might be easier to identify, you know, if it is China. And I wonder if you thought, since part of what you're trying to do is explain a change in polarization, here you're just focusing on the import side. But of course, you know, this also opened up export opportunities. And so if the mechanism was working through labor demands, then, you know, and if it was similar on the import and the export side, you should find the flip side of this. So one question is whether you do. And I guess one interesting thing relative to what your co-authors had done in previous work is that they stopped in 2006, 2007. Now you have a huge other kind of exogenous shock that happened in your sample, which is, you know, the Great Recession, the Great Trade Collapse, which had huge impacts on trade and certainly differential across different areas. And so I was wondering, you know, so I would think about the effect maybe during the 2006 election, you know, as being sort of the China effect. Right. But you could potentially look at what has happened, you know, in the second period as being something that's completely distinct. So anyway, so have you thought about distinguishing this? And in particular, I guess I also worry with that measure that, you know, there's a huge endogeneity problem, that the things that China is exporting to the U.S., even after instrument for what other countries are importing from China, you know, they're going to be these low-skilled manufacturing products which were already in decline in the U.S. This might have sped it up, but, you know, there would have been these regions in the U.S. that would have eventually had these declines, and that kind of the shock that you're using, the China shock, even after instrumenting, is really not you know, as powerful in terms of instrumenting for these declines in low-skilled manufacturing that were already happening in the U.S.
Okay. So I think there are a number of questions here. I try to be disciplined in answering, but let me know if I miss something. One thing on this kind of opening up opportunities for exporting. So one thing to keep in mind is that it was not nearly as close as the import shock, right? So so exports from United States to China did not go up dramatically after China joined the WTO, but it did go up. Now, so the problem with estimating the effect of exports is that we do not have good IV for it, right? So that's one problem. However, one way that trade economists have looked at it is by doing this Bartik shock, but then splitting between college-educated and non-college educated. The idea being that kind of that positive export shock for the United States happened in like more technologically advanced industries. So we should, if there is anything, we should see it in this Bartik for college-educated people, demand for them. And we have done that actually in the paper, right? And we do not see any effect. We do not see an effect. It could be because of two different reasons. One is that the magnitude of the shock is pretty small, right? So you might expect this magnitude to be big enough so that it's politically actionable. The other thing is that I'm not 100% sure that you should see exactly the flip side for a positive shock, right? So it could easily, I can easily imagine that negative shock could kind of help with like polarizing the political scene even more, but a positive economic shock just keeps the status quo, right? That is also an option. So I think I have answered two of your questions. About the last question that you mentioned about after 2006. So I think we kind of addressed that with that last exercise, actually. Right? So the thing is that the correlation between trade exposure and decline in housing prices is very, very small, right? So we do not see like the same type of shock in the same type of place. That's certainly not the case. And even after controlling for all this, the effect of trade shock remains unchanged. And there was a fourth question that I don't remember. Sorry for that. Oh, okay. Sorry. So, well, you know, the thing is that so China joins the WTA, exports from China to the world goes up, right? So we have 8 countries here, right? That we use as instruments for the United States, and the relation and the correlation for import penetration between each of these 8 countries and the United States varies significantly between like 0.48 and 0.96. Now, to think that all the demand shock that happens in the U.S. is exactly the same as the demand shock that happens across all these very different countries is a bit difficult for me to kind of imagine, but who knows?
So let me thank the speakers and discussants here. I'd like to make a few additional remarks. I want to first thank my co-organizers, John Taylor sitting over here and Lars Hansen standing up over there for organizing this conference with me. It was great to work with them. It's great to be here at the Hoover Institution. I want to thank the Hoover Institution, thank the Becker-Friedman Institute. I also want to thank the MacArthur Foundation that generously provided funding for this event. And lastly, all of the staff at both Hoover and BFI that made this happen. Okay, so we're reconvening here at 5:30 for the evening panel session that John Taylor will moderate. So I look forward to seeing you then.
Okay, thanks, Mike. Thanks everybody for coming. We have had a long day. This is kind of the culmination of a topic on elections and uncertainty in the economy. So we're looking forward to this. We're fortunate to have my good friend Alan Greenspan, former chair of the Federal Reserve, of course, but someone I used to work for long ago back in New York. So good memories.
You were an honored employee.
Honored employee, yeah. Chris DeMuth used to run the American Enterprise Institute, and he's going to, I think, focus on his research on regulation or whatever. And Steve Davis, also a good friend who's been a co-organizer of this event along with Lars Hansen. It's a kind of a nice combination of the Hoover Institution and the Becker-Friedman Institute collaborating on issues that we all think are very important. So what we're going to do, I'm just going to moderate here and sit here and listen, maybe ask a question, but you think of your questions too. But we're going to start, each of our panelists will make some opening remarks on 10 minutes or so, and then I'll see if there's some questions I will ask, and then we'll go to the audience. We have a good hour and a half here to look into things. So without further ado, let's begin with Alan Greenspan, and Chris, and then Steve. I have a little thing of this if you'd like to use it.
Okay, well, this is the worst economic, political environment that I've ever been even remotely related to. And it's going to end up less than we would like it. And my general view is that what has happened is that the long basic history of the United States, where we started off, as all of you know, back in British colony, and the issue of British common law was a relatively important issue, and indeed continued to be so even after we were an independent nation. Mm-hmm. But what happened basically over the years is a dramatic shift from what the founding fathers basically structured was a republic with democratic characteristics in which certain parts of the society were there by suffrage and voting, but nobody ever presumed that democracy was going to work, because democracy had never worked, and one of the reasons is the definition of democracy in its pure form is where 51% of a majority can legally annihilate the remaining 49. And that's the reason why there's been a collapse throughout history in everything which was a pure democracy from basically 1789 in France up until a huge number of various different types of political arrangements. And we're now at where we would be if one extrapolated that particular trend that has evolved really over, it turned in a very important way when the basic view of a republic, which was what everybody considered we were and acted that way, ran into the issue of populism in a way which we never thought it would arise. And the crucial turning point was 1896 in the Democratic Convention, where William Jennings Bryan basically confronted, that's probably not the right term, he just vanquished Grover Cleveland, who was then President of the United States, strong advocate of the gold standard and sound money, as were indeed all of the previous presidents, going back to my favorite laissez-faire populist, it's Andrew Jackson. What happened at that convention in 1896 was what I consider the most brilliant speech, political speech, which was the Cross of Gold speech of William Jennings Bryan, which captivated the convention, which, remember, had just previously nominated a gold standard advocate, and one who clearly was utterly antithetical to everything Bryan stood for. But Bryan won hands down, and fortunately lost in the general election, and then again next two times he ran. But that was the basic turning point. And we're now in a position where, as populism and democracy as a value was never put in the form in which the Founding Fathers essentially viewed it. It was a major aspect of political freedom. And so long as you had a Bill of Rights, which, remember, did not, first 10 amendments, as I recall it, were not accepted. Let's just say the Constitution was not accepted until the first 10 amendments were promised to be in it. And we have a series to this day in which there are certain rights which individuals, which the government cannot abrogate, and in fact has not in an official sense, but there's been a significant erosion which has led us to what we have today, the two major party stalwarts, neither one of which is even 50% considered to be somebody people would want to vote for. And this is where we are. And how we came from the Constitutional Convention to today is a very sad story. And where it leads, I do not know. But it's very evident that we are headed first in economic terms, I think, to stagflation, which we're beginning to see the signs of. And politically, I haven't a clue how this comes out, but we're not in a stable equilibrium, and we're very different from what anything we've seen in American history. And I hope we can all find a way out of it, because this is too great a country to allow it to be undermined by, shall I say, crazies. I was going to make a speech on, I have a whole series of charts which I'll get to eventually.
You want to talk on
Well,
them now?
it's almost too technical economics that I'm afraid.
After what you just said.
I mean, I mean, just to tell you.
Okay, well.
Just very briefly, I can give you my best view about the issue of uncertainty by what I think the best measure of it is, which is essentially the ratio of cash flow which corporate management has chosen to invest in long-term fixed assets. All uncertainty is of that characteristic. In short, what you're looking at is a period now when the proportion of cash flow which business wants to invest and chooses to invest has been back in 2010, I believe, it was at the lowest level since 1938. And we haven't recovered all that much, and if we stay at this level, the capital structure is going to be undermined. I'll go over T-values.
Okay, so we can be back. I do want to say about the famous Cross of Gold speech, which I agree is amazing. There's a recording of that, believe it or not.
At the time?
There's a recording, it was made then, at least it's the man's voice. And I play it to my students in Economics 1. It's a beautiful speech, the Cross of Gold speech. Thou shalt not crucify mankind on a cross of gold. It's pretty remarkable.
It is remarkable. I mean, as you know, I'm an old gold standard type. I was very impressed with that, and I said, I don't like the content, but that is the most beautifully structured political speech I have ever heard since I've been listening to such things.
And you won the nomination. So, Chris, you want to?
Sure. I'm going to talk about uncertainty and regulation, and I'm going to get at a culprit that is similar to that Alan has identified, although I'm going to move the inflection point up to a more modern one, and I'm going to try to describe a progression, a secular progression in increasing uncertainty as being from consensus to rules to essentially unfettered discretion, uncontrolled by anything other than immediate politics. And I believe that it applies much more broadly than regulation, but I'm going to focus on regulation. Regulation seems to me to be certainly a growing cause of private economic uncertainty. First, the sheer quantity of federal rules and mandates has increased significantly in recent years and decades. This has added new contingencies to management, marketing, investment decisions. The rate of rule production has also increased. That has reduced the durability of any given legal regime, shortened the time horizon of current expectations about the future. Third, and most of all, I think regulatory agencies have garnered much greater discretion over both their procedures and the scope of the decisions they make, which has made legal obligations much more unpredictable. The increase in volume and scope and pace, I assume, has had greatest uncertainty effects in the highly intensely regulated industries such as banking and finance, energy, communications, healthcare, transportation. I think that these developments are the result of deep changes in American political culture and governing institutions, and I'm going to move up the date to the last 50 years, since roughly the 1960s. In that time, compared even to that of William Jennings Bryan, our politics has become much more populist in spirit and atomized in structure. By that I mean this: growing education and affluence, advances in the technologies of communications and transportation have greatly reduced the costs of political organizing and transactions, both on the supply side of government policy among politicians and officials and bureaucracies, and on the demand side, voters, lobbyists, interest groups, activists, and so forth. The result has been a tremendous increase in the past 50 years in political participation and into the quality and variety of demands for government intervention on behalf of various groups. Before then, the national policy agenda was mostly mediated and limited by consensus groups, broad-based labor and business organizations, political parties, strong local bosses, the strong committee system, seniority-based in the Congress. These modern developments have completely disestablished those old constraining elites. Affluence, technology have replaced them with new forms of organizing and seeking favors from government and government provision that are much more individualistic and entrepreneurial and unmediated and far-ranging. These changes have made government policies less predictable, less stable, in two distinct ways. First, Congress has delegated a great deal of lawmaking to executive branch agencies in order to accommodate political demands that have grown far too numerous to be managed through traditional representative, horse trading representative lawmaking. But representative lawmaking is relatively stable as a source of law. It's cumbersome, it's slow-moving, it's constrained by the need to find a wide consensus. Executive agencies, by contrast, are specialized, unconflicted, hierarchical, also because they combine the making of law with its enforcement, surveillance, administration. They're much more protean, mercurial, subject to abrupt changes. So they generate law at much greater speed, in much greater profusion. That's the whole point of delegation. But they're also much more flexible, able to adapt, to execute abrupt policy pivots. They can single out individual firms for punishment or reward. This is a new form of lawmaking. The second complementary change over the past 50 years has been the decline of the once uncontroversial idea that government action ought to be constrained and delimited in some sense. The original source was consensus among the elites that now no longer exist. This included the judicial consensus on constitutional limits on federal action that began to unravel during the New Deal. But it also included political consensus among various elites on the structure and purposes and limits of policy in their own field. And these consensuses lasted until the elites themselves were disestablished, beginning at about 1970. When those old informal consensual constraints evaporated, there were various efforts to replace them with more formal constraints in the form of rules, legislative rules, administrative rules. But these turned out to be much shorter-lived, much less effective in delimiting government policy. And in regulatory policy and other fields, we've now moved beyond consensus, beyond rules, to largely freewheeling discretion. Let me say what that means in regulatory policy. From the birth of government regulation of any scope or size in the progressive era and on into the New Deal era. From those beginnings through to 1970, regulation was the control of entry, prices, and services in major industries: transportation, power, communications, banking. Not entirely, but almost all of regulation consisted of that. These programs were dominated by incumbent firms. Regulation was clubby. It was stable. Indeed, its purpose was stability. It was to restrict excessive competition, unconstrained market competition. And it succeeded. The Civil Aeronautics Board did not permit a single new airline to enter service in the United States throughout its entire life. Banking, power, and communications regulators were similarly protectionist. Beginning in 1970, the forms and purposes of regulation changed radically. It was no longer forced on regimenting production, but on promoting consumption. Environmental quality, personal health and safety, broad measures of welfare, individual dignity, group participation in the workforce, and other areas. The New Deal programs were abolished or substantially liberated. They were replaced by EPA, a host of agencies concerned with product and workplace safety, energy, anti-discrimination, affirmative participation, energy efficiency, did I mention? And the new programs differed in that they were not restrictive, but were open-ended. They were aspirational. They were missionary. Moreover, they operated through something called informal rulemaking, which was vastly more discretionary, flexible, and potent than the narrow, court-like adjudicatory procedures that the old New Deal agencies had employed. A much greater share of the economy and society came under the sway of federal regulation. For producers, regulation became much more costly, intrusive into their business operations, and unpredictable, uncertainty creating. Now, these new open-ended forms of regulation did prompt a counter-reaction. We saw the development of two forms of constraint that hadn't existed before in the form of rules to limit their operations and constrain their scope. A legal rule enforced largely by the courts was that agencies had to announce in advance what their plans would be, welcome and consider commentary that was submitted to them, and explain their final decisions after a waiting period in terms of the evidence and arguments that they'd received, confined by the purposes given them by statutes. Beginning in the Carter and Reagan administrations, there was also an economic test which persisted on paper, at least, through the Obama administration to today. Presidents required by executive orders that agency rules had to address identified market failures, had to produce benefits greater than their costs, and had to produce the maximum net benefits among the alternatives that they considered, a constraining economic test. These had modest but observable effects in the late 1970s and in the 1980s. They became less effectual in subsequent decades, and in the past 10 years, one would have to say that they've fallen entirely by the wayside. Agencies have found ways to evade restrictions on advanced notice, commentary, executive order, economic review by a variety of expedients, including unheralded guidance documents, dear colleague letters, sometimes even recently by internet postings. When they are in the grip of the economic orders, they have pretty much done away with the need to identify a market failure that they intend to cure. Through an enormous expansion in the idea of what benefits count, the benefit cost ratio test has essentially been abolished. Greater benefits than costs now include benefits of protecting consumers from making decisions that they really want to make in regard to be perfectly rational, but the regulator, for example, the Secretary of Energy says, we are protecting citizens from making the bad choices that they would otherwise make on their own. So it is migrated into a tool of economic planning and paternalism and essentially public relations for agencies to announce how they are going to improve our lives. And in recent years, I'd say since the last couple of months of 2008, we have the new phenomenon of major policies made by outright announcement. No, you can't predict it in advance completely by surprise, that have no predicate in statutes or often contradict statutes. And that's the source of a lot of the current controversies about the unchained executive in America. Examples include the use of TARP funds to bail out automobile manufacturers, and a long succession of policy strokes in the Obama administration concerning immigration, greenhouse gas regulation, a series of very large changes in what would have thought were going to be the contours of the Obamacare program, university procedures for dealing with he said, she said, sexual assault allegation, bathroom rules for transgendered persons, and many, many more. Big policies are simply made by abrupt announcement. So the transformation of policymaking is transferred to the executive. It's increasingly abrupt nature operating outside of legal procedures, and the falling away of efforts to confine regulation to economically justifiable rules all have led us in a world with very, very large executive discretion and accordingly, I believe, increasing uncertainty. Do I have time for two final points, or shall I save them for later? If I put it that way, I'll save it for later. So I'll save them. Very fine.
I don't know if we can stand the wait, but okay.
Good.
But
Please
actually, when I'd like to hear from Steve. And
yes.
then
Good.
I also ask some questions about what we do about all this.
Yes.
Steve.
Okay, great. So that's not the slide.
Is that your picture?
No, that's not my picture.
I think that's Alan's.
That's Alan's, yeah.
I'll start here. And so it's my pleasure to be here with Alan Greenspan, Chris DeMuth, following them, and William Jennings Bryan in memory. I won't achieve those levels of eloquence, but let me put some numbers, some quantitative shape to the discussion we've been having. We can get
it up there.
Slide up there. So what I want to show you is a measure of an economic policy uncertainty index. There it is. That's based on work I've done with Scott Baker, who's sitting right up here, and Nick Bloom, who's not with us today. So I want to tell you briefly what this is, and then I'm going to use it to organize many of my remarks. So this is a GDP weighted average of policy uncertainty indexes for 15 countries around the world, including all the G10 economies. So we've got most of global GDP captured in this picture. How do we construct these indexes? We basically, for each country, look at domestic newspapers, and we construct frequency counts of newspaper articles essentially expressing concerns about policy-related uncertainty. Lots of details, but that's the basic idea, okay? Now, I'm going to talk a little bit about some of the contours in this picture, but there's two kind of things you might be asking yourself at this point that I want to address very briefly, and they come up all the time in the academic literature as well. One is, why should we trust newspapers to get things right? It's kind of like amateur economists at best, writing for Joe Public. And so one way to address that is to look at other text sources. We saw one paper that did that today, a paper by Tarek Hassan presented, looking at expressions of concern about political risk factors in earnings conference calls by, I guess, mostly CEOs and other senior executives in these conference calls. They show a very similar pattern. You can also conduct a similar exercise using the beige books put out by the Federal Reserve System, which have been put out in essentially their current form
every 6 weeks, going back to the early 1980s. And when you do that for the U.S., the broad picture is very similar as well. So, for those of you who aren't familiar with the beige books, think of them as being written by expert economists for experts, I hope, members of the FOMC, Federal Open Market Committee. So those are two very different text sources, and Scott and Nick and I look at yet other text sources that tell broadly similar stories. So I don't think the newspapers are capturing something that shows up in other sources. A second kind of issue you might worry about is, okay, well, is there really any signal value in any of these measures? Whether you're looking at newspaper text sources or other text sources. And we try to get at that at several ways, but I think probably the most convincing way, and you saw that again, today as well, but take firm level versions of these policy uncertainty indexes and ask whether they have any explanatory power for firm level movements in stock price volatility, either realized stock price volatility or option implied volatility. And the answer is yes, they do. So there's no doubt lots of noise in these measures that come out of text sources, but I think there's also at this point pretty compelling evidence that they have some signal value. Now, with that, let me point out, let's take a look at the pattern in this picture. This goes back to 97, it's monthly. First thing to notice is the last several years, are well above the average. Everything is averaged here to 100 over this whole period, are well above the average. That's consistent with, I think, the theme of both Chris's remarks and Alan's remarks that the current moment is unusual. I didn't bring it in my slide deck, but we've got a version of this for the U.S. that goes all the way back to 1900. And if you look at that, there's been a gradual upward drift in essentially the last 50, 60 years, which is also consistent with what we heard from Alan and Chris earlier. So I think there is some quantitative backing from this kind of analysis for the, let's say, somewhat gloomy take you heard earlier. I think that has some support. There's some other things I want to point out about this picture. You can see at least 3 of these major global episodes have to do with financial crises. Okay, and one of the papers we heard today looked at elections in 20 countries around the advanced economies, 800 elections in the last 140 years, and documented that there's a systematic empirical relationship between major banking crises, that's their notion of financial crises, and fractionalization of participation in the parliament. And think about European economy countries in particular, fractionalization of the representatives who get elected to parliament, kind of more representation from the tails of the political distribution, especially the right-wing tail. That might have something to do with Trump and Sanders doing so well in the current election cycle. Now, you see that in this picture, the global financial crisis, and especially the series of crises in Europe and that coincided with fiscal fights in the U.S. and a major leadership transition in China. They're episodes with extended periods of high levels of volatility, suggesting at least that some of the reason why we're in this current moment, not the entire reason by any means, because I think the things Chris talked about were quite distinct in origin, but some of the impetus behind the recently high levels of policy uncertainty in much of the world might be a legacy of the financial crises we've had. Now, the last set of things I want to talk about, in some respects the most complicated and which is very, very much on the frontier of academic research, is trying to sort out cause and effect. That's very challenging, but I do want to make a few remarks on that in that context. There are systematic cyclical patterns in these policy uncertainty indexes. There's a tendency for policy uncertainty to rise during recessions or in the wake of recessions. You can see some of that in this picture, although I also want to point out that the recent high levels of policy uncertainty in the U.S., which according to our indexes were especially pronounced in the 2010 to 2013 period, came well after the major parts of the crisis were resolved and well after the end of the recession. So I don't think it's a simple story. Nonetheless, there's a lot of the academic work is trying to sort out cause and effect here. Here's the subtlety that I think often gets overlooked, and even in much of the academic work. it's not so simple. We should not expect to find a kind of simple universal relationship between bad shocks hitting the economy like the financial crisis or the global financial crisis in 2007, 2009, or the serial Eurozone crises and policy uncertainty that comes along with it. That connection itself, the connection between economies getting hit with bad shocks and the extent of policy uncertainty that follows in the wake of that, which itself might lead to bad policies, that itself is a consequence of the institutions that we set forth for ourselves in advance. And I want to make that point with some examples. So let's start with what I think is the leading example in this regard, in my mind, in recent years, which is what we've seen in Europe. Think about the serial crises in the Eurozone area. They were initially precipitated by major fiscal malfeasance in Greece. Greece is a tiny part of the Eurozone, but it was part of the common currency. And the common currency was set up without many of the predicates that economists argued in advance you want to have if you're going to have a successfully functioning common currency. Free labor mobility, some type of fiscal union. I think we've learned in retrospect some degree of harmonization of banking. On top of that, there were other aspects of the policies and the governance arrangement in the Eurozone that I think amplified the negative effects of the crisis in Greece and created a great deal of uncertainty. So I'll point to two. First, there were policies, bank regulation policies that encouraged banks to hold the debt of their own sovereigns. So you created this kind of so-called diabolical loop between sovereign debt crises and banking crises. That was not inevitable. That was a consequence of policies that had been put in place in advance. And then finally, you just think about the cumbersome nature of the political and policy-making process that emerged in the Eurozone area to try to deal with the Greek crisis and the later stresses that came in Spain, Portugal, and Ireland. None of that was inevitable. So to my mind, one reason the Euro crisis has been so pronounced and prolonged, even though the initial event was quite modest in economic terms, is because the Europeans set themselves up a set of institutions that were not well equipped to deal with the kind of crisis that emerged. Now, I think we suffer from this problem as well to some extent. So let me give one example. So, John Taylor and others have been pushing the notion that we need to reform the bankruptcy process for financial institutions. And the idea is, the way I think of it anyway, we don't want to put the financial regulators in the position of having to decide what to do when Lehman Brothers fails or is on the verge of failure and has the potential to create broad systemic negative effects throughout the financial system and the economy. Okay, so at that point you're screwed in some sense. As a regulator, there was no easy answer to what to do with Lehman Brothers when it was on the cusp of failure. What you want to do is design the policy institutions in advance so that there is some less harmful way to resolve that type of crisis so that you don't have to bail them out, but the alternative isn't causing profound problems throughout the economy. So I think there's a lot of room for economists and for political scientists to step back and ask the question, how can we better design our institutions and our policy arrangements so that when economies get hit by negative shocks, and they will inevitably get hit by big negative shocks, they are more resilient, not just in the structure of the economy itself, but in the way that the policy-making apparatus responds to the shocks and can respond to the shocks. So I could give more examples along these lines, but maybe I should stop here.
Okay, thank you all. Lots of points, a little pessimism there, but that's okay. One thing I'm always interested in when we hear what the problems are is what we do about them. What can we do? It's an election season. It'll depend on our democracy, as Alan was saying. But there's bills floating around. There's a bill just went through the House Financial Services Committee that would basically major regulatory reform and repeal Dodd-Frank. There's proposals for a more rules-based monetary policy. There's proposals for cost-benefit analysis in the regulatory area. There's proposals to go back to a regular order in the way our Congress works. But if you could maybe comment a little bit on that, maybe starting with Alan and Chris and Steve. Yeah.
Well, can I go back to what I think is the fundamental economic problem confronting the United States? And let me use
Charts?
clicker.
Okay.
Here you go.
There you go.
Yeah, put the other charts up. It'll take a minute.
Why don't you put the one on the sum of the gross domestic savings and entitlements up?
It's coming up soon.
What you're seeing here is history going back to 1965. And the red line, let's start at the bottom. The bottom line is the percent of entitlements of all sorts that are shown here as a percent of gross domestic product. The red line is gross domestic savings as a percent of GDP, and the top line is the sum of the two. The stability of the top line suggests that of those two other variables, one must be displacing the other dollar for dollar. That's just the straight algebra of the issue. But the question here is what is pushing which, and what does it all mean? Well, first of all, entitlements are a legal issue and have nothing to do with the state of the economy, whereas gross domestic savings is a wholly economic phenomenon. And the consequence of that is entitlements are basically, of necessity, the independent variable in this relationship. So as entitlements have gone up, and remember that they really started in the beginning when Roosevelt signed the 1935 Social Security Act. Social Security never became an issue because until we got into the 60s, all you had was people who might eventually retire, and the Social Security system was really quite small. But as the years went on and we began to add entitlement after entitlement, we find ourselves currently in the situation where we have the decline going on in gross domestic savings, and gross domestic savings with a very small adjustment for a current account balance, that is the net foreign borrowing, we end up with a gross domestic investment. And gross domestic investment is the critical determinant of output per hour. I mean, there are a lot of other issues here got to do with education and the quality of the individual. I would say the quality of capital investment is a function of the educational capabilities of the society. So what we have here is a situation in which, as entitlements grow, and they will continue to grow as the population ages, we are going to get a continuous decline in gross domestic savings and ultimately gross domestic investment. And I might say parenthetically that gross domestic investment has been running significantly higher than gross domestic savings, largely because of the current account borrowing from abroad. Now we're now at $7+ trillion. I won't get into the details, but that's going to be ever more difficult to continue, which means that gross domestic investment is going to go down and going to be under significant pressure, which means that output per hour is going to slow up, if it can slow up any more from where it is today. But this is a phenomenon which is not strictly in the United States. I just ran through 30 countries, and they're all showing very similar patterns. 2/3 of them have a growth in output per hour of less than 1% a year, and the United States is down at 0.5%, and some of the bigger countries and most effective countries in the world. This is all over the last 5 years. And what this essentially says is that we're going to get an ever-slowing rate of growth in the economy. This notion of 2% growth rate, which CBO uses, is a nice number, but it's going to be hard to keep even that up because we don't have the resources to do it. In other words, GDP is fundamentally a function of, one, the total number of hours that exist in a society, which is a demographic issue to a large extent, and output per hour. The combination of those gives you the GDP. You can't get around this. In other words, everybody is looking at the issue now of the economy seems to be going higher. It will for a short period of time, then it's going to dip back down again. But the reason I think this is critically important is this is where the real problem lies. And unless we find a way of addressing the entitlements, which incidentally is turning out to be a nonpartisan issue, because over the last, I guess going back to 1965, the proportion of entitlement expansion, which has averaged 9% a year, going all the way back, virtually stable. Republican administrations, where one would think you would get some constraint, are actually on average expanding entitlements more than the Democrats are. So, strangely enough, Bill Clinton has turned out to be the best Republican president I know. But you've got a terrible situation here which it seems to be insurmountable because everybody wants more and more entitlements. And the third rail of American politics, as everybody knows, is anybody who argues to restrict or prevent gains or cuts in entitlements is playing with the third rail of American politics. And meaning you touch it and you lose. And there hasn't been a single discussion in any of the debates that I've heard or been exposed to, unfortunately, in many respects, on this issue. And nobody wants to discuss it. If we don't address this issue, everything else we're talking about is irrelevant. There's an argument out there that says, well, how is it possible that you're getting crowding out of capital investment when interest rates are so low, because it's interest rates which are supposed to do the crowding out? Well, the answer is yes and no. The interest rate that matters is not just the ordinary interest rate, but you want to hit the next one? I don't want to impose heavy econometrics on you, but unfortunately it's necessary. Well, what this regression shows basically is that the dependent variable, which is investment as a share of cash flow, and the two independent variables, both of which have about the same explanatory power, are one, the cyclically adjusted deficit. For those of you who are involved in econometrics, this is you'll understand what we're doing is to get the covariation, the basic tendency for the independent variables to be correlated or any of it. The point and issue that I want to make is that what this shows is highly significant coefficients, which basically say, in effect, that what is driving the crowding out is not the existing interest rate, but basically the slope of the yield curve, which from the 5-year Treasury note yield to the 30-year Treasury bond yield, the extent of that difference explains with a very high degree of statistical confidence a very important part of why the crowding out occurs. And then, of course, you have the deficit, the ex-ante federal deficit that appears in what President basically proposes, turns out to be the ex-post deficit, because the U.S. Treasury Department is the 800-pound gorilla in the financial markets and will pay whatever yield is required to get the amount of borrowing, get the amount of security sales that are required to close the deficit and essentially to fund expenditures. We're in a position now where, unless we confront this, and the question is, it is a crowding out, and that crowding will continue unless and until we revise the issue of entitlement growth. And unless that happens, we're going to find that gross domestic savings, gross domestic investment, output per hour is going to continue to slow down and reach a degree of stagnation which will become politically intolerable in this country. So I don't know where it's heading, but I don't like where we've come. Unless you can argue against this relationship, which I have not heard a substantial academic and conceptual argument of, when you get t-values, adjusted t-values of 10 and 12, which means that the probability that the coefficient that is involved here is not significant, is 0 or close to 0. So that there's clearly the process going on. It shows up if you look at the fact that savings and investment in any economy ex post must be equal. And if you define, for example, in the United States, our current account balance in terms of the fact that it is, instead of using the standard views, which is how does it look from the foreign point of view, redefine it, and it's exactly the same term, just changing the sign to make it a domestic part of our savings investment balance. That must of necessity be equal, with the exception of a small adjustment and statistical discrepancy, which isn't very large. And so what happens is, if you get a very large increase in government deficits, you are of necessity crowding out private capital investment. There is no way around that analysis as far as I can see. And while nobody likes the relationship, all I get is this issue, how, if interest rates are too low, how is it possible there's any crowding out? They're missing the point. The fact is that it is crowding out, and the only issue is why. And the data related to, for example, a combination of these two variables, independent variables, explains a very high multi-correlation. And that's as much as I have to say on this subject. If anybody wants to discuss it, I'm more than glad.
So,
what does this have to do with William Jennings Bryan? I don't know. But
I wasn't going to ask you that. Fixed entitlements, it seems like the answer, which I can't disagree with that. The question
I
of
would
what
say
do
it's
we do next?
necessary. I don't know it's going to be the full solution. I would just say
No,
it's
I
a
understand.
necessary
I
condition.
understand. So, Chris, what do we do about it?
Let me make 2 points about what
That'd be
might
good.
be done. The first is that I think we need to focus on government structure and institution rather than rules. I'm impressed by the weakness of ideas of rules, good rules, the Taylor rule, the cost-benefit rule for regulation. Since the decline of the old budget balancing consensus, Congress has been awash in rules that people like Phil Gramm propounded, and revenue neutrality and budget neutrality, and they've been entirely ineffectual in addressing the entitlement spending problem and the annual budget problem. So I think that we have to look at building up countervailing institutions within the government. The one regulatory reform bill that I like, there are a lot of them that say things that it would be if we did them, it would be wonderful. But I don't believe we're going to do them. If you had a cost-benefit test that was enforceable by the judiciary, that is, it wouldn't be something that just the regulator had to say, I'm convinced that this is going to be beneficial, but that a group of judges from an independent branch who weren't reporting to the president would make the judgment themselves. We've seen what countervailing power can do in antitrust policy in the past 35 years, and I think we should apply the same approach in regulatory policy. On entitlement spending, I think that there's no. The big change, I think, was the political transition that I've described, and the complete dismantlement of the appropriating committees and the power structure within the House and the Senate. I think that we have to have a stronger Congress to stand up to the executive on all of these matters, and I think that the sine qua non is a Congress that is more hierarchical. One of the reasons the power structure was disassembled was that the powerful seniors were all Dixiecrats. Well, the memory of the Civil Rights Revolution and the hold that the South had on the House and Senate is so far in the past that I think that the barriers to resurrecting a meritocracy, so to speak, in the House and Senate, I think that there are possibilities there. Okay. So I think we want to think about institutions. On the matter of I think particularly on the spending problem, but I think it applies in monetary and regulatory policy as well. The disappearance of the idea that constraint is a good thing, I think has very, very deep cultural roots in music, in art, in architecture. Breaking through barriers, acting without constraint is a part of the modern ethos, and you see it in politics. The conservative Republicans are for the opportunity society, be all you can be, taking individual virtues and trying to translate them into government. Old-fashioned ideas of designing a budget for the public or a rule, it's not like writing a poem, you know. The reason we act within constraints is not for aesthetic purposes, it's to protect the public that the government's supposed to be serving. I think that the problem of entitlements spending is almost certain to end in a crisis, and I mean a big crisis. The sooner that aspiring politicians start grasping third rails, talking about the importance of reform and constraint, are booed and heckled and made fun of, those are the people who are going to seem like heroes in the wake of a large crisis. And I think that so this is a rhetorical or a political point. The reintroduction of the idea that constraints and limits in government are a virtue and not something that we should be delighted that we have freed ourselves from.
Steve, you want to add a few points?
Yeah, couple things. So lots of good points made already. I want to add two things. One, and they're both somewhat related to Chris's remarks. There has been this tremendous expansion of the regulatory state, and much of it outside the regular oversight of Congress, the delegation to regulatory agencies. So I want to make 2 points on that. To some extent, the complexity and the burden of our regulatory system is a consequence of the way we design it, the architecture of it. So one example involves the way we deal with pollutants, whether it's carbon or other noxious byproducts of economic activity. By and large, we've taken an approach where the regulators tell you can do X, Y, and Z. They tell you what kind of light bulbs you can put in your house, exactly how you have to deal with emissions in energy power plants and so on. That's an approach. That approach is a recipe for complexity. Another approach, and can't implement it always, but is to rely on the price system. And it's a basic idea behind a carbon tax. So I think there's some areas of regulation where we ought to be replacing tax and price instruments, which still require some regulation, but a much smaller regulatory apparatus than we've adopted already. Another example along these lines is there's a trade-off between what type of capital requirements we want to impose on commercial banks and the complexity and extent of the monitoring and oversight system. So I do think there are many areas of regulation, not all, where think about designing the overall regulatory architecture to facilitate simplicity. And instead, we've often done the opposite. The tax system is another great example. We have a monstrously complex tax system. That's not inevitable in order for the tax system to serve its necessary economic functions of providing revenue to the government. So there's areas like that. The second thing I wanted to pick up is Chris's point about countervailing institutions. So I've kind of come to the same view, and I think Chris eloquently explained how the delegation of regulatory power to agencies that are not regularly monitored in any effective way by the Congress means there's all this unaccountable political power in the system. Chris suggested we empower courts to be the countervailing institution, and I'm somewhat skeptical that that's the right response, partly because the courts are a very cumbersome and expensive mechanism already for resolving disputes and righting wrongs and so on. And so that's led me to think maybe we need a different type of countervailing institution. And I'll just throw this out for discussion. One possibility is you set up commissions, independent commissions, so to restore the bite to, say, benefit cost analyses. And this commission has only one power, and it's a negative power. Anytime a regulator, whether it's the Environmental Protection Agency or the Consumer Financial Protection Bureau, wants to advance a new rule, a new interpretation of an old rule, or so on, they have to construct a credible cost-benefit analysis, and they don't get to decide whether it's a credible cost-benefit analysis as they do now by making up benefits or minimizing costs. Rather, this commission can either at its behest or at the request of some party that feels it's been injured, make a determination as to whether the regulator has put forth a cost-benefit analysis that meets some scientific criteria. If not, then the regulator can't enforce that new rule or that interpretation. And that would be the only power. And what I'm trying to get away from is the expense and the cumbersome nature of the judiciary. And I don't know whether this is a better or a worse solution, but it's prompted by the same concerns that Chris expressed.
So let's throw it open. And I have one question over here, and then.
Can we go back a slide, please?
Yeah. Go back, previous slide. Yeah.
Perfect. So there was this question raised about what relates to these three things, and it seems to me that the blue line can easily be explained simply by government increasing its expenditure on social benefits since whatever it is, 1965. The decrease in the red line can be explained by precautionary savings, as uncertainty of the economy has decreased, which is largely in line with expectations at the time. People saved less, which is why you see a sudden increase just after 2007 in savings, because suddenly there was much more uncertainty as well as non-performing loan concerns,
And so you actually see the situation there around between 2007 and 2010, where the blue line and the red line are increasing together, going against this argument that there is a one-for-one trade-off between savings and benefits payments. I actually see something very different going on, and this goes to your comment about how regulation is now geared towards promoting consumption. We have this situation right now where low-income financing starting in the 1990s was geared towards getting people homes rather than getting people education in order to address income inequality and social mobility concerns. So there's a paper by Francois Giroff in 2013 that shows that real estate investment actually drives current account deficits. And so we could easily show that it is the it's basically Congress's focus on increasing real estate investment has increasingly driven current account deficits as well as these domestic savings concerns. And if you go to the next slide and you see how fixed income has decreased, my argument would be that the simple explanation of this is that real estate investment has crowded out corporate investment. And this could easily be explained again by the continued focus on real estate investment as a cure to income inequality and social mobility concerns. This was originally proposed by Raghuram Rajan in, I think, 2008 in his book, Fault Lines.
You have any thoughts about real estate issue? Yeah.
Well, let me just respond. First of all, going back to the previous graph, how did we get there?
Already there.
Observe that the top line is not a straight line. If it were a straight line, it would be an exact one-to-one correspondent. But what is fascinating about the data is how that there is no trend, and that the variations across, say, the presumption of a straight line are really quite they're immediately reversible, as the data show. So to argue that there is a part of that which doesn't exactly correlate is really stipulating that the top line is not flat. But the fact that it has no trend means that in general this process of displacement is occurring with an error, say a discrepancy, related by the extent of the fluctuations in the top line, the sum of the two. But it doesn't get around the fact that the fundamental issue of crowding out is what is involved here, because you could see it not only in the gross domestic savings, which is a bookkeeping issue, but it shows up directly in output per hour and per capita GDP. So you can argue, if you want to, that that fluctuation of the top line is enough to obliterate the conclusion. I would seriously question that, because it's always returning over a half century back to the issue of stability. And so long as that stability, even approximately, is the case, the conclusion necessarily algebraically follows. But this phenomena exists everywhere in the developed world. You look at unfortunately, the data of the rest of the world are not as good as ours. But if you try to match, for example, so-called social benefits to persons, which is the way the category is generally used, and savings of the society, they all show the same inverse correlation, about the same degree of error that we have in the United States.
Okay, so excuse me, we're going to have to just go to Michael Bordeaux here.
Yeah, I want to get to back to William Jennings Bryan, Alan, and
he appreciates that.
and well, you know, I worked with Anna Schwartz for 40 years, so. And when I look at the history of the United States or other advanced constitutional democracies in the British tradition, okay, what I see is not. I see populism as part of in a sense, a wave. I see mean reversion there's long swings towards populism, then back towards sort of more conservative, sensible ways of doing things. And if we look at our history, okay, the U.S., we started out with Alexander Hamilton and all the great reforms that he did. Then we got the Jeffersonians. They dismantled it all. Okay, then we get in the post-Civil War period, and we get incredible advances, and that's when capitalism really took off. Then we get progressivism. Then we get a conservative wave. Then we get Roosevelt. So I really think that we're not sort of moving off into some new world which we've never seen before. And I would predict, and I won't tell you when, but we're going to be moving back again.
Can I respond?
Sure, absolutely.
I'd like to believe that, but I don't think the data confirm it. Let me tell you why. Throughout the first 100 years of this country, government did not, aside from state and local governments, the average person never even knew that the government existed. And the percent of federal government outlays as a percent of GDP was 1% all the way back to 1790. And even if you add in the state and local is a big part of it, it's still very small. In other words, the actual trend in expenditures, government expenditures, as a percent of GDP has been remarkably stable throughout the 19th century. But as you begin to look at the data we get beyond the turn of the century, you end up with Woodrow Wilson, who is first, well, actually, it's, Teddy Roosevelt was not. I mean, Teddy Roosevelt's inaugural address sounded like some right-wing crazy. He morphed to where he was looking for all sorts of various types of government controls of one form or another, which is, of course, the basis of until the Interstate Commerce Act of 1887, there was no regulation of business in the United States. But as you go beyond and look as a proxy at the percent of non-military spending as a percent of GDP, it's been going steadily upward. And I mean steady. It's not the Coolidge period we went down. That was the last of it. We got into the Roosevelt area. To be sure, Truman was not as liberal, so to speak, as Roosevelt. And Eisenhower was technically a Republican, but sort of really in the middle. But even the last 50 to 100 years, what we see is basically an ever gradual moving upward in the percent of GDP that is, I should say, percent of federal spending as a percent of GDP. It is not turned down, and it did not turn down during Republican administrations. And I've seen none of that reversion to the mean concept which you imply. I'd love to believe it's so, but looking at just newspapers of the last few days, it's scary.
Fascinating. So I think there's a question in the back. Any other questions, let me know.
Great, thank you. So, Steve, you wrote a book that inspired me when I was a grad student, Job Creation and Destruction, and I thought that might be a good taking off point because technology is reshaping the economy. And I feel like I've gotten a pessimistic note from all of you. I'm really surprised, Mr. Greenspan, your notion that growth is stagnating, maybe even slowing in per capita terms. So I wanted to ask the question, in U.S. history, we've seen growth worldwide, let's say from 1820 to today, accelerate from 0 to this 2%. And now, is it going to peak, or will it continue to accelerate? And I ask that in the sense that can GDP measure all the intangible benefits that are being produced in an information-heavy economy, and maybe a regulatory economy that is making the air a little bit cleaner and the water a little bit cleaner. So there are these intangible benefits in our society that aren't captured by GDP.
Why don't you,
So
yeah,
Steve,
why don't you
maybe-
let
GDP was constructed basically in the 1930s. There were all sorts of arguments about how to measure what we now call a GDP. It basically ended up as marketable goods, anything that went through the market, and then they, in addition, had so-called imputed items which had market characteristics. But it has never been an issue of trying to find out what the secondary effects of that are going on in the economy, because there are all sorts of qualitative things, changes which are not measured by the GDP, were never meant to measure the GDP. And the question is, should we change it? Well, it's very difficult to say. I mean, Facebook, for example, does that create economic value? Well, in a sense, you can say people interacting with one another is like the telephone. I mean, the telephone, everybody agrees, was a major advance. Well, this is an advance, but how do you measure it? We have the same problems that we had back in the 1930s when the real big debate was how should we evaluate women's or other householders. They were virtually all women back then. And you ended up with the issue that it was concluded that we would not include the production of householders, largely because it was very difficult to measure. But that was as big a change as I could conceive of, much greater than any of the various major changes that people are talking about, that the GDP is not measuring it correctly. The answer is yes, it is not measuring it correctly, but what has that got to do with the relationships, which are very good, between the GDP and employment and a number of the critical issues we consider we want to measure for economic policy purposes?
I mean, so, go ahead. There's a question right here. Yeah.
Seeing both John as well as Alan on the dais, I can't help asking this question about the conduct of monetary policy uncertainty and whether the Federal Reserve should in fact take asset prices into account. I remember your statement when you were the governor and stock prices were very high, you warned against it. And later on, when you gave your mea culpa, I was wondering why you did so. Do you still?
I'm sorry, I did what?
Your mea culpa, that you regretted not taking asset prices into account at the time, because I thought you said the right thing as the governor, and when the market didn't respond, you did not repeat it.
Well, the problem basically was, this was incidentally at an AEI,
Right.
in 1986. Right. 1996.
96. 96.
Yeah. The basic reason is in a book that I wrote 3 years ago, is that I was becoming increasingly aware of the fact that the standard view that people act rationally and that all of their actions which are other than rational basically wash out. And what is left on the grounds that you do not get anything of value produced by irrationality. That statement happens to be true, but what is not true is that human irrationality is unsystematic. When I became aware of the fact that a long-held view that it basically washed out was wrong and that there were systematic relationships. For example, that fear has a much more radical effect on human action than euphoria. And you can see it in the business cycle. That is, if you look at it from the unemployment point of view, unemployment goes up sharply and then goes down very gradually, up and then down gradually. And that is true through all human experience. So that I eventually came to the conclusion that the best way to come at the issue is to change the institutions in a way. I mean, to have, I don't want to get into the details of this, but I did not believe that we could control bubbles. Bubbles are an inevitable effect of human nature. You can do anything you want, you will not prevent them from happening. But bubbles, by any definition, must burst, and they all do. The question which was uncertain is we had just been through at that time 2 bubbles bursting in which nothing happened. One in 1987, that famous 23% decline in one day in the Dow Jones Industrial Average. My view at the time was that the economy was going to be in real serious trouble. You cannot find it in the GDP figures. Then again, the 2000 bubble, it collapsed, and we had the most shallow recession in the post-World War II period. When you're confronted with that, you begin to wonder, do bubbles really matter? And it turns out in retrospect, because we had no real evidence until 2008, that what really was the issue is whether the toxic assets that create the bubble were leveraged. In 1987, they were not. In 2000, they were not. In 2008, like the 1929 broker loan problem, they were. And so the conclusion I reached after 2008, when previously I had no examples of that, led me to conclude that the critical issue is a degree of leverage. I didn't know that in 1996, and I didn't learn it until 2008, and what happened as a consequence of that, and where the problems came from.
Thank you. So do you either want to add something to that? It looks like there's one more question, sorry.
So, Professor Davis, I wonder if you could briefly expand, quantitatively on the signaling value to which you referred, and the signaling value.
Yeah.
And the reason why I pose the question is partly from a market player perspective, due to the fact that we start with Jean and Ken's three-factor model and Bill Sharp's ratio. How do you quantitatively take into account the signaling value and actually execute? Because I think at the end of the day, for a player, is it noise? Was it something I can act upon? And briefly on the question of Europe, I would like to some extent, with all due respect to my German friends here in the audience, misquote the late Chancellor Helmut Schmidt. Helmut Schmidt simply put it in a very crude fashion: the problems in Europe are a function of a lack of leadership. And I like to think that from the other side of the Rhine River, what we had was an approach very much against anything which will come from either the fiscal authorities or even any action on the part of the ECB. So we could certainly have that discussion when we are having a drink or two. But I think that the issue that we have in Europe has nothing to do with the institutions. It just so happens that the biggest player in the game, Germany, had its reasons, and I understand Germany's position, Germany is the biggest new payer, and so I would love to expand on that, when we have a chance. But I just wanted to push back a little bit on the issue of Europe.
So we can have a friendly disagreement over that, over drinks afterwards on the European situation. So let me answer your first question. So I showed you a version of one of these policy uncertainty indexes. So in my work with Scott and Nick, what we also do is we take, I'll describe two different approaches we take to quantifying firm level exposure to those risks. One of our policy risk exposure measures is based on how much firms sell of their output directly to the federal government or through an input-output matrix. So think about just quantifying each firm's exposure to government purchases of goods and services and also certain government expenditures like healthcare. And then you can add, so that gives you cross-sectional variation across firms in their exposure to the spending side of government policymaking. And the question that we then investigate is, in periods when policy uncertainty rises, do those firms with greater exposure to policy risk measured that way see bigger increases in their stock market volatility? Another way we get at the same issue is we go to the 10K filings. These are required by the Securities and Exchange Commission of all publicly traded firms. Since 2005, most publicly traded firms have been required to include in these 10K filings a section which is titled Risk Factors, in which the firm is obligated to elucidate what it sees as its main risk factors. So we can go through and write programs to essentially quantify the fraction of the sentences in those risk factor discussions that talk about policy-related risks. Okay? That gives us a different measure with more attention to the regulatory side, I think, a different measure of how exposed firms see themselves as expressed in their 10K to policy-related risks. We then go back and same kind of approach as before, look at movements in either the policy uncertainty index that I referred to before or kind of category-specific policy uncertainty indexes like healthcare policy-related uncertainty, financial regulation, and so on. These give us variation across firms and over time at the firm level in their quantified exposure to policy uncertainty. That variation helps you explain the cross-sectional structure of firm-level stock price volatilities and how that structure evolves over time. And the paper we saw earlier today by Tariq Hassan does a very similar exercise using a different measurement approach.
Okay. Well, thank you. We're out of time. Unfortunately, I can't have any more questions, but thank you, Alan. Thank you, Chris. Thank you, Steve. It was terrific. Appreciate it.
Thank you, John.